Good morning, friends. So welcome to the CA Final Advanced Financial Management Expected Questions Marathon. Okay, this we are doing for May 2026 examination. Initially, we thought we just publish the expected questions list or concepts list, but later we thought, why not we do a marathon? Okay, covering all the important concepts, concept clarifying questions. Okay, so we will discuss the question answers, predominantly the important adjustments related to these questions. Okay, so this marathon will be published in 3 parts. Okay, so first part will cover the bond valuation, equity and business valuation, then derivatives, futures and options, and then advanced financial management. These 4 or 5 topics will be covered under this part. Okay, see, initially here I have given here chapters list and concepts list. You can see that in the bond valuation segment, okay, the value, YTM, duration, volatility, convexity, and realized YTM, bond immunization, convertible bonds. These are all the core area for this attempt. I feel that, okay, we have done some research and I feel these are all the area, okay, which might get tested. Now, next is equity and business valuation chapter. In the equity and business valuation chapter, there are few topics related to dividend discount models. Okay, a few questions related to dividend discount model and free cash flow to firm, free cash flow to equity. That also we will cover. Then staggered growth. There is varying payout ratio. An RTP question is there. That is important for this attempt. Then there is rights issue, buyback. Okay, then business valuation question based on EV by EBITDA multiple and enterprise value. All these are important for this attempt. Next, EVA, okay, is always important. Most of the attempt, okay, if you see 4 out of 5 attempts, they ask from question from EVA, so inevitable. So we will discuss that also. Next, in derivatives futures, we have index futures with dividend yield question. Then futures arbitrage question. Okay, recently not tested for 3 or 4 attempts. Okay, they may test a futures arbitrage. Then margin account, even though it was tested 2 attempts back, still there is a high possibility that that gets tested. Small concept only, we will discuss that. Futures hedging, including risk-free security. Okay, how much of the risk-free security should be included? The beta, how much should be increased or decreased? All this we are going to learn there. Next, commodity futures hedging. One question is there now. Okay, regarding commodity futures, that is important for this attempt. Next, derivatives, options, option, break-even FSP. Okay, many years they did not test this break-even FSP. This January attempt they tested. And if you see the examiner's comment, okay, there many students did not properly, okay, couldn't answer this. So break-even FSP will cover briefly if possible. Then payoff with probabilities. Riskless hedge versus risk neutral. Okay, one comprehensive question is there covering both riskless hedge as well as risk neutral probability. We are going to cover. See, I am discussing briefly these topics because anyway I am going to run the marathon. Question answers we are going to discuss detailedly. Hence I am briefly discussing all these things which are going to get covered. Then 2-period binomial tree. One question is there. 2-period binomial model. That binomial tree we are going to cover. Then Black-Scholes model, of course. These option valuation model very important in this attempt because last 2 or 2.5 years they have not tested this. 4 or 5 attempts they have not tested. Hence very good chance that they might test it. Next, advanced capital budgeting. Okay, you have one basic capital budgeting NPV based question. How to calculate the NPV based on different assumptions. I will clarify this. Given in last RTP, I think Jan 26 RTP they have given one question, and even in examination if you see September 25 they have asked one question regarding September 25 or May 25, one question regarding the basic concept only. Next, replacement cycle, EAB, EAC, life disparity, concept called as EAB, equated annual cost or equated annual benefit. This we are going to learn. Next is sensitivity analysis. Okay, how much for the 10% increase in sales, 10% increase in cost. Okay, what will be the impact in NPV? So the sensitivity of the NPV to various factors we are going to discuss in sensitivity analysis. Then real options, very important for this attempt. Real options, okay, I'm going to discuss. Then we have Hiller's model, always important. Okay, Hiller's model, because capital budgeting entire topic is important because they have added this newly. Earlier before 2016 they had this, then they brought it back. So Hiller's model is a very good area. Next, decision tree. Decision tree is also to be discussed. So these are all the areas which I am going to discuss in this part. So bond valuation, equity and business valuation, derivatives, futures, options, and advanced capital budgeting. These are all the areas we are going to discuss. So let's get quickly started without wasting any time. We have just 1 week left now. So we'll start with the bond valuation chapter here. Value, duration, volatility. First question. Okay, shall we start? Good morning, friends. Okay, now we will start the marathon properly. The following data are available for a bond. Face value rupees 1000, coupon rate given as 16%, years to maturity 6, redemption value 1000, yield to maturity 17%. What is the current market price, duration, volatility of this bond? Calculate the expected market price if increase in required yield is by 75 basis points. See, this is a very good question covering 2 or 3 concepts together. So I am discussing this. See what happens. First, you need to find the expected market price, which means fair market price, fair value of the bond. So value you want to find out. Very simple. In any bond valuation question, you will have, okay, one side value will be there. Okay, it's a bond triangle based question, which means 3 values should be found out. One is the value, or I call it as fair market price. Then there is YTM. And then there will be bond cash flows. If you see the bond cash flow, fixed income security, hence bond cash flow will be always given, which means what is the coupon? Coupon is one of the cash flows. Then redemption value is another cash flow. So coupon, if it is redeemable bond, redemption value will be there. If it is a zero coupon bond, coupon will not be there, only redemption value will be there. If it is perpetuity bond, only coupon will be there, no redemption will be there. Are you all understanding? So assume that, okay, you have a coupon paying bond. Usually normal plain vanilla bond, you will have coupon for 1 to 5 years, coupon will be given. Assume 1 to 5 years, coupon will be given, and at the end of 5th year, redemption will happen. So bond cash flows, coupon rate and redemption, which will be given in the question. This I call it as bond cash flow. Then, okay, if they ask a question regarding value or fair market price, then they will give you the YTM. Are you all understanding? For example, in this question, YTM given as 17%. Okay, they are asking fair price of the bond. And if they ask YTM, they will give you fair price or market price and ask you to find out the YTM. Are you all understanding? Bond cash flows will always be given. And okay, either of these two, YTM or fair market price will be given, and you will be asked to compute the either one value or the YTM. Are you all understanding? This question is related to value, fair market value or fair market price, or okay, the bond value. Now they have given the YTM. See, very simple. YTM is the discount rate. What is the value of bond? Present value of future cash flows discounted at YTM. Which means 17% you will use. Bond cash flows. So coupon rate 16%. 16% always should be applied on face value. 1000 into 16. 160 is the annual. Years to maturity is 6 years. Now every year you receive 160 for 6 years. Then at the end of the period, 6th year, you will have a redemption value of 1000 rupees. Are you all understanding? In this question, okay, the bond is issued at par and redeemed at par, hence there is no capital gains involved. Okay, now find out the value of the bond. Very simple. Year 1 to 6 cash flow, present value annuity factor should be what? At 17%. This is nothing but YTM. Present value annuity factor at 17%. At YTM, if you discount, okay, you will get this is annuity factor you should use, because this is a recurring coupon. So that annuity factor, and at the end of 6th year, you will receive the redemption. This is nothing but coupon. This is nothing but redemption. Okay, 0.390. If you discount it, you will get the bond value. This is the fair market price. Fair market price, or simply value of the bond. Fair value of the bond. Next, they have asked us to compute duration. As I told you, okay, duration, very simple. You have these columns. There is a formula. You don't need to mug up the formula. Okay, tabular approach we can use, easily find out duration. Year, cash flow, present value factor at 17%, discounted cash flow, okay, proportion, duration, very simple. Till now, this is nothing great. Okay, valuation question, these 4 columns, you already did in the valuation question. Year, cash flow, present value factor and discounted cash flow. Now, in the duration, only these 2 columns, okay, additionally is added. This is nothing but, okay, see, till now, what is duration? Duration is the average time taken for the recovery of the principal portion of the bond. Very simple. Now, the bond cash flows you discounted and found out the bond value as 964.4. This 964.24 you have found out in the first step itself. This is the total bond value. Are you all understanding? Discounted value. So hence there is no interest involved. This is the discounted price. Fair price today. Agreed? Out, this is the principal portion. I call it as principal portion. Out of this 964.24 value, on an average, how much okay, see, very simple. First year, you are receiving a coupon of 160 rupees. Are you all understanding? Second year, 160. Third year, 160. Like the sixth year, you are receiving coupon. Apo, the value which you paid, 964.24, you may pay this amount. This is getting recovered. Something similar to in your intermediate accounts, average due date you have studied. Okay, something similar to the payback period in advanced capital budgeting. Okay, how much you laid capital, how much time it takes to recover. On an average, it takes to recover your capital. Very simple, yeah. The 964.24, entire 964.24, it is getting recovered in 1 year, 2 year, 3 year. On an average, so what is the duration? 4.243 years. Are you all understanding? Which means first year, okay, I am recovering 160 rupees. The present value of this 160 is 134.8. Second year, I am recovering 116.96. Like this, how many years it takes on an average to recover my principal portion, to recover my value of the bond? Are you all understanding? This is what duration is. What do I do? Now, this is the discounted cash flow every year. I find out the proportion to the total value of the bond, which means 136.8. First year I recover. Okay, this divided by 964.4. I recover. What is the proportion? 0.142, which means what is the understanding? 0.142 means what? Okay, 1.42%, which means out of total 964.24, 0.142%, not 1.42, this is 14.2%. Are you all understanding? Which means out of 100%, 14.2% is getting recovered in the first year. Are you all understanding? Like this, I am getting recovered. So, proportion you need to find out. What is the proportion for this one? 116.96 divided by 964.24. The denominator will be same. You find the proportion to the total value. Then, after finding the proportion, multiply with the number of years. So, this is the column number 1. This is proportion, column number, see, 2, 3, 4, 5. This is column number 5. The sixth column is nothing but, okay, fifth column into first column, which means proportion into time taken. Proportion into time taken. So 0.142 into 1, you get 0.142. Okay, 0.121 into 2, you get 0.242. Like this, okay, I'll find out the weighted average time. And total, if I do the total, summation of this total, I get as 4.243, which is in years. Duration should be always computed in years, which means, okay, the first year I recover 136.8 and last year I recover, what is that, 452.4. On an average, it takes around 4.243 years to recover my amount. Are you all understanding the important adjustment? See, totally it takes 6 years. Years to maturity is something different. Duration, this duration is called as Macaulay's duration. I already told you. So this is how you will compute. Are you all comfortable? Okay, this is also called as optimum holding period. Optimum bond holding period. Okay, you should only hold the bond. What is the importance of this duration? Very simple, sir. The life of the bond is 6 years. Duration of the bond is 4.243 years. What is the importance of this duration? Okay, very simple. What they say in bond immunization, I am going to explain. At that time, I will explain it. What they say is that don't invest in the bond till maturity of the bond, which means the life of the bond. If this bond is 6 years. Don't invest a bond till 6 years. Only invest till 4.243 year for optimum result. Optimum bond holding period is nothing but, okay, the okay, period. The period which you hold the bond to, up to which you should hold the bond. Ideally, you should not hold the bond beyond or below this period, 4.243 years. Next, volatility is nothing but, okay, duration divided by 1 plus YTM. Volatility formula in duration. What is the formula for volatility? Duration divided by 1 plus YTM. Okay, this alignment issue, duration divided by 1 plus yield in YTM. 4.243 duration divided by 1.17 will give you 3.63. What is the understanding of volatility? For every 1% change in YTM, what is the percentage change in, okay, bond price? This is percentage. 3.63 is percentage. Volatility is always expressed in percentage. This is also called as modified duration. This duration, 4.243, is called as Macaulay's duration. Question, why this is important? Question, they may mention Macaulay's duration. They may also ask modified duration, by which they mean volatility they are testing. Are you all understand? They mean volatility. Okay, so volatility, how to find it? Duration divided by 1 plus YTM. What is the understanding? For every 1% change in YTM, increase or decrease, what is the corresponding increase or decrease, okay, in the bond price? Always volatility, always the YTM and bond price are inversely related, which means, what is the understanding? I'll tell you. For every 1% change in YTM, okay, 1% increase in YTM, what is the decrease? Okay, approximate decrease in bond price, which means volatility, okay, it goes in the opposite direction. YTM, if you increase, the value will reduce. If you decrease the YTM, value will increase. That is fine. Okay, now what they say, this is the approximate measure. This is also an approximate measure, not accurate measure. Accurate measure I will compute in convexity. That's why we have convexity. That also I'm going to discuss. Are you all understanding? So next, this is what is volatility. Market price when YTM increased by 75 basis point. BPS means basis point, which means 100 basis point, 100 BP na 1%. Okay, 75 basis point means what? 75 basis point means 0.75%. You tell me, children, volatility captures, okay, the percentage change in bond price with regards to percentage change in YTM. How much my bond price changes with regards to YTM? This is what we found out as 3.63%. Correct? Now, this is for every 1%. Up 1% if 3.63% is changing, how much for 0.75% it will change? Simply 3.63 into 0.75, you will get 2.7225. Are you all understanding? This is how. So the new bond price, okay, will be 938.14, 97.2775, huh? Because 2.7225, okay, already gone, okay, decreased by 0.75. Are you all understanding? Which means the balance out of 100 will be this much amount. Are you all having the clarity? Okay. Next, question number 2, YTM related question. Today being 1st January 2022, Ram is considering to purchase an outstanding corporate bond having a face value of 1000 that was issued on 1st January 20, 2 years back, which has 9.5% annual coupon and 11 years of original maturity, i.e. maturing on 31st December 2030. Now, since the bond was issued, the interest rate have been on the downside. It is now selling at a premium of this much. Very simple. Interest rate, if it is going down, the price will increase. The bond price will increase. Naturally, okay, 100 rupees worth of bond became 125.25. It is trading at premium because the interest rate has dropped. YTM will be dropped. Next, determine the prevailing interest on similar type of bonds if it is held till maturity, which shall be redeemed at par. Now, see, determine the prevailing interest on similar type of bonds if it is held till maturity, which shall be redeemed at par. Now, what they are asking, effectively prevailing interest rate means YTM they are testing. They are testing YTM. I told you, when see the bond triangle, which means three data will be given, bond cash flows in this question. All the questions will have bond cash flows. Correct? This question they have also given bond cash flows, and they have given the fair market price. Are you all understanding? This is 125.25 they have given. This 125.75 they have given as market price, and they have asked us to compute YTM. You see, my dear friends, for computing YTM, we have first two methods. First, approximately you should to find out YTM. Then you should, YTM is nothing but cash, IRR of bond cash flows. Now, in the advanced capital budgeting itself, you would have seen the IRR. Okay, IRR of multiple uneven cash flow only can be computed using trial and error method. I cannot simply find out, okay, the IRR as it is. What I need to do, I need to put some number at 17%. I need to discount the bond cash flows, and I will equate it to discounted cash outflow. IRR is equal to rate at which discounted, see, I also told you, IRR is equal to the rate at which discounted cash inflow equals to discounted cash outflow. This you would have studied in intermediate also. Correct? No problem. Even if you have not studied, here what I say, how to find out IRR is a question. What they say, okay, take some 6%. Like it will be given in the question, sir, how to find out IRR? Don't worry. They will give you 2%. For interpolation, they might give you 6%, 8%, which means you should understand that it is something in between 6 to 8%. First, you will find the bond value at 6%. Next, you will find the bond value at 8%. Are you all understanding? Okay, then you will equate and find the in-between number, okay, to find the exact IRR. Now, the 6-8% may be given, may not be given in the question. When they have not given in the question, what you should do? You should take the approximate method and do the, find the, are you all understanding? So, you should find out the YTM using approximate method. You will get the YTM around that number. See, approximate YTM when you solve, you got it as 13.5%, which means it will be something in between 13 and 14. Accurate method, if you solve using IRR, you will find it in between 13 and 14%. You will never find it 18% or 19%. Are you understanding? So that we will use. Here also, okay, the solution, first we will find out approximate YTM. Approximate YTM is nothing but interest. Okay, here we have interest plus amortization. Amortization, I told you, there are two sources of income from the bond. One is interest income, then there is capital income. So interest plus amortization means redemption value minus subscription value, RV minus SV, divided by how many years you are going to amortize. This capital gain you are going to amortize over a period of N, which means life of the bond. Okay, divided by RV plus SV, simple average, divided by 2 you will do. This you will give you approximate YTM, yield of the bond or return of the bond. Okay, here interest comes to 95. Why 95 interest? Very simple. Interest apply face value should be, the face value is 1000. Interest should be applied on face value. 9.5 into 1000, 95 is the interest. Redemption value, as they have mentioned, is how much? Redemption value is 1000. And purchase price, subscription price. Now here they have, okay, purchasing it from open market. Okay, what they have asked is prevailing interest rate, prevailing yield they have asked, which means when you compute prevailing yield, you should consider current market price. Consider current market price as subscription price, which means as if you are purchasing the bond today. If you purchase the bond today, how much you will pay? 1125 I need to pay. So 1000 minus 1125, capital loss divided by N. Okay, if you amortize over a period of the life, okay, the whole divided by 1125 plus 1000, RV plus SV divided by 2. If you solve this, you will get 7.62. Are you all understanding? This is approximate number. Why? Because this formula can be used for approximate method. This is not accurate method. Why this is not accurate? I'll tell you. The capital gains portion, okay, simply you are dividing it by N like accounting. You are not considering the time value of money, hence there will be a small difference. Okay, that you need to consider by IRR method. IRR is approximately 7.62%. Okay, now we will do, which means 7.62. Now we know that it's something in between 6 and 8%. We will do the interpolation and find out. Okay, interpolation, I'll explain. Hereafter interpolation comes now, you should manage. See. Now, here cash flows, present value factor at 6%, present value factor, present value factor at 8% and present value. Very simple. What they have done now, okay, all the bond cash flow they have considered and discounted using 6% first, then 8%. Are you all understanding? Now, if you discount all the bond cash flows using 6%, okay, then what happens is that you get the NPV as 112.37. NPV as 112.37. There are two ways of doing interpolation. You see, here they have considered the year 0 outflows. Okay, year 0 outflow. Without considering the outflow also you can discount, which means if you total this number, if you total these numbers, okay, if you total all this number, you will get discounted cash inflow. Are you all understanding? Very simple. I told you at IRR, discounted cash inflow will be equal to discounted cash outflow. This is one way of understanding. At IRR, NPV will be 0. NPV will be 0. Why? NPV is equal to nothing but DISCI minus DISCO. DISCI minus DISCO. Which means if DISCI is 40 rupees, DISCO is also 40, NPV will be 0. Here also DISCI is equal to DISCO na IRR. Are you all understanding? Which means whatever is the discounted cash inflow, if you equate the discounted cash inflow to outflow, obviously NPV will be 0 na. So IRR is the rate at which discounted cash inflow will be equal to outflow, or I can also say at IRR NPV will be 0. NPV will be neither negative nor positive. It will be exactly 0. Are you listening? So that is how they have interpolated after finding NPV. So target, I should make the NPV as 0. That also you can make, or you can also take, okay, the also you can take IRR as also you can take the discounted cash inflow equated to outflow. Are you all understanding? Now, very simple. They have computed NPV. Okay, they have computed NPV at a lower rate, 6%. NPV comes to 112.35. How they have computed NPV? Very simple. 89.59 plus 84.55, 79.8 plus 75.24. Like this, they have added everything. Minus 1125. If you do, you will find the 112.37 will be the NPV. Next, at 8%, what is the NPV? At 8% present value, present value of the cash inflows minus cash outflows. If you do this, NPV you will get how much? 32.26. NPV you will get as 32.26. Are you all understanding? Now, at 6%, I'll tell you how to compute it. Very simple. At 6%, okay, NPV is how much? 112.37. At 8%, NPV is how much? Minus 32.36. Very simple. You have increased up. What happened really? You tell me, children. You have increased the YTM. Up. Very simple. This is YTM. This is NPV. Okay. If you increase the YTM by 2%, how much is the NPV drops? YTM. Okay, discounted cash inflow will be reduced, value will be reduced. If value reduced, net present value, really speaking, it will reduce. NPV will reduce. Very simple. How much it is reducing? From positive 112.37. Okay, it is reducing by how much? Plus 32.36. How much is that? 144.73. Are you all understanding? Which means if I increase the NPV by, YTM by 2%, NPV drops by 144.73. But how much I need to? I need my NPV to drop. I don't need NPV to drop by 144.73. I only need to make the NPV 0. I only need to drop it by 112.37 exactly. Are you all understanding? If you want to drop it by 112.37, then what you should do? 112.37 divided by 144.73 into 2. How much is that? 1.55. 1.55 or 56%. Are you all understanding? Which means you should not increase the YTM by 2%. You should only increase the YTM by 1.55% to make the NPV drop by 112.37. Hence, making it as 0. NPV will become 0. It is coming in between this 112.37 and minus 32.36. That's how they have found out. Okay, this is what is that? 1.55. Okay, you should increase this 1.55. From where I will increase? Very simple. 6% is the starting point. From there only you increase to 8%. 2% you increase. Don't increase 2%. Only increase 1.55%. So 6% plus 1.55%. 7.55% is the accurate YTM. Are you all understanding? This prevailing interest rate on similar type of bonds is 7.55%. Next, shall we move on to the next question? Okay, YTM, duration, volatility, convexity. YTM, duration, volatility and convexity. Here, YTM or value already discussed. Duration also already discussed. Volatility concept already covered. Mainly I am covering this third question for the sake of the convexity. For convexity. Okay, November 2020, first time it was asked. Okay, then RTP also they have included. So this question is very, very important for this attempt. Okay, the following data are available for a bond. Face value 10,000 to be redeemed at par on maturity. Coupon rate 8.5% per annum. Years to maturity 5 years. Yield to maturity 10%. You are required to calculate current market price of the bond. Macaulay's duration. Okay. Volatility, convexity, expected market price if there is a decrease in YTM by 200 basis points by Macaulay's duration based estimate by intrinsic value method. Intrinsic value method, now this is nothing but okay, present value of bond cash flow, bond future cash flows you do na. Okay, this is the accurate method. This is the accurate method, intrinsic value method. Now, discounted cash flow method. Say, very simple. Now, see. In this question, you see the coupon rate 8.5% applied to 10,000, which means every year, how much will be the coupon? 10,000 into 8.5%, 850 will be the coupon. Years to maturity 5 years given. Okay, YTM 10% given. First, current market price means current fair market price of the bond, value of the bond. First step, you need to find the value of the bond. Okay, value of the bond is nothing but present value of all the coupons plus present value of the redemption. Coupon is 850, present value annuity factor for 10%, 5%. 1 divided by 1.1 is equal to 5 times you press GT into 850. How much is that? 3222. Okay, 3222 plus 3221 plus, okay, redemption value is 10,000. When, see, in this question, is there any redemption value given? Not given, which means normally if question mentions nothing about redemption value, now it will always be assumed to be redeemed at par, which means how much is you should redeem, the bond will be redeemed at 10,000. Upon 10,000 into how much is that? 5%, 10%, 1 divided by 1.1. For 5% present value, for 10% present value factor for 5 years. 1 divided by 1.1, 5 times 3, 4, 5, 0.620, 0.621 into 10,000. If you do this, you will get 6,210. Total of this present value of coupon plus present value of the redemption will give you 9431.5. Are you understanding? First step, value of the bond. Next, Macaulay's duration, year, cash flow, present value factor 10%. This is everything will remain same till value. This 9431 only you got, correct? Additionally, new 2 column will be opened. Proportion into time. Proportion, weighted proportion, just like you compute the WACC. Okay. Now, proportion, you find out 772.65 divided by 9431.5. Like this, you will find the proportion. Total of the proportion always should be 1. This is nothing but weight. You can either express in percentage terms or in decimal term. No issue. Proportion into time. Okay, this is weighted duration. You got it as 4.252 years. This is nothing but, okay, Macaulay's duration in years. Next, duration of the bond is 4.252 years. Next, volatility, duration divided by 1 plus YTM. This you already know. You are understanding till now. Shall we move on to the convexity? Yeah. Now, understand, friends. What happens in convexity? See, the duration, I told you, the Macaulay's duration is just an estimate, The volatility, okay, the Macaulay's duration, modified duration is just an estimate. Means for every 1% change in YTM, how much the bond changes approximately, inversely, approximately changes by some percentage, 3.865 in this question. This is approximately, this is inversely proportional plus this is approximate measure. This is not accurate measure. Why? Because, see, very simple. When YTM changes, really speaking, okay, the duration will also undergo change. Because duration, how you found out duration? Okay, proportion you will find out, very simple. If you discount the bond cash flows using 11% instead of 10%, YTM changes, you discount the bond cash flows using some other rate. Upper proportion will also change. When proportion changes, duration will also change. Are you all understanding? So the volatility formula, numerator I have duration. That duration itself will undergo a change. Hence this, if duration is constant, this I can use and assume that we can, for every 1% change, this is the change, real change. But the duration itself undergoes a change. Hence this is not constant. Okay, this itself is changing. Hence, this will not be a straight line. This will not be a straight line. This will be a curve. This will be a convex. That is why we call it as convexity. Are you all understanding? See, if you want to understand this, I have put a revision video, a comprehensive revision series, like fixed income security or bond valuation. Separately, 6 or 7 hours I have discussed. All the concepts elaborately I have discussed. There you can go through. Here I am trying to just prepare you for upcoming examination. Okay, how to solve the question? What is the logic behind it? That's what I am doing. Are you all comfortable? We don't have time to go deep into the concept since I am summarily discussing the question answer. See, so convexity adjustment, 2 formulas are there. One is that you need to find out C value. What is the C value? Okay, V plus V minus 2 into V0, the whole divided by 2V0, okay, into change in y square. Are you all understanding? Again, repeat with me. V plus V minus 2V0, the whole divided by 2V0 into change in YTM square. The Y is nothing but YTM. Now, what is this V plus V minus? Very simple. The value V plus, it is, okay, the value on the upper side of YTM. Which means at present, see, the question doesn't mention what is it. Very simple. In this question, there is a small mistake here. the fifth part, they have asked the expected market price if there is a decrease in YTM by 200 basis point. This actually should have been there while computing convexity. Are you all understanding? Convexity formula, you will use V plus minus V minus, like this you will use the formula. Na? This 2% is there. This should have been used here. Are you all understanding what I am trying to say? Okay, this should have been put here so that you can easily do. They have put in the next segment of the question. Sir, how to know how much percentage is to be taken? Now, change in YTM. Now, 200 basis point is nothing but 2%. This you should consider. Okay, anyway, to compute the convexity. So, what is the formula? V plus plus. Okay, V minus. Now, what do you mean by V plus? What they say, value. Now, at present, you are finding the value. What is the YTM? Current YTM? Current YTM is 10%. Very simple. What they say, current YTM is 10%. At 10%, what is the value of the bond? Okay, just now we found out 9431.5, some number. Are agreed? What they say, they are asking 2% change. Na? What you do? You find out the value at 8%. You find out the value at 12%. At 12%. Now what they say, this is the upper band, this is the lower value. Up V plus na plus 200 basis points value at 12% YTM. Value at 12% YTM is what they mean by V plus value at V minus na minus 2% if you do, value at 8%, bond value at 8%, minus 2 into V0. V0 means value today. Today YTM is 10%. I already computed what is the V0 value today, 9431.5. This I will use divided by 2V0 into change in YTM square. Are you all understanding? Now it will be very easy. See if you okay, now for this to actually find out, we need to find out this C value, but before that we need to find out V plus and V minus. Agreed? Apo, that's why we are recomputing here. Okay, year cash flow, present value factor at 8%. I am finding the value using 8% discounting factor. Then I will find the value using 12% discounting factor. Are you all understanding? So value of the bond, present value of the bond at 8%, I got the intrinsic value as 10,204.5. At 12%, if I discount the bond cash flows, I am getting at 8733.4. Now this is called as V plus. This is called as V plus. This is called as V minus. Are you all understanding the issue? Sir, why you took 8% and 12%? Because current YTM is 10%. Okay, the 200 basis point given in the question, even though in the convexity part they have not asked, that's why I told you there is an anomaly. They have asked in the next part. But they asked question in the previous part. So convexity question. But you read the whole question, then understand. If this question is asked, you should do that. If in the convexity adjustment itself they asked, then you use that and do. Are you comfortable? Now, what you should do, at 8% you discount the bond cash flows, you will receive 10,204 as value. You will get the 10,204 as value. This is the value at 12%. Now what you should do, apply the formula. V plus, what is that? 12%, what is the value? 10,204.5 plus V minus 8733.4 minus 2 into V0. Already we computed 9431.5 from the first step, value of the bond. Already we computed 2V0 divided by 2 into V0 into change in YTM square. Here you have to take in decimal. See, YTM 2%, na 2%. How we should write 0.02? That you should square it up. Are you all comfortable? If you do this, you will get C value as 9.867. C value as 9.867, and if you substitute it here, okay, convexity will get C into change in YTM square. Yes, convexity is equal to C value into change in YTM square, 0.02 square into 100. Okay, in percentage terms, I get it as, okay, 0.395%. Are you all comfortable? Okay, this if you solve, you will get 0.0, okay, 0395. Like this, you will get, I think, 9.867 into 0.02 into 0.02. How much is that? Yes, 0.0039468 rounded off to 395. That is how in percentage terms is written 0.395%. Are you all understanding? Okay, now expected market price if YTM decreases by 2%. This is how you will find out the convexity adjustment. Very simple. I told you convexity. Okay, it's a curve. Okay, and you see it will be a straight line, not this side. Okay, let's say how it will be now, really speaking. Okay, I've given in the okay, module itself, you can go through. This is the straight line. This is duration based estimation will come in the straight line. This curve will be there in the convexity. This gap, this difference between the curve and this is what is convexity adjustment. This 0.395, okay, you should add it or subtract it. If it is negative, if it is positive, now you will add it. If you add it or subtract it to Macaulay's duration of 3.68% something you got now. This is the real adjustment, okay, real change in value. All this we discuss in regular lecture. Here I don't want to discuss these things, okay. Simply how to compute, that alone is sufficient. Are you understanding? Now last part of the question, expected market price if YTM decreases by 200 basis points. Very simple. Now in the last question what they are asking, sir, I already computed. Now YTM decreases by 2%. Now 10% is the current YTM. If changes to 8%, already I computed as how much? Okay, at 8%, what is that? 10,204.05 already I computed, na? Yes, this is called as intrinsic value method. This you present value of the future cash flows, if you do, na, this method is called as intrinsic value method. Intrinsic value method. Okay, what they are asking? They are asking under both the methods. Now, see, you have found out volatility, yeah? Volatility, how much you found out? 3.865% you found out, na? By volatility based estimate. Now, that you multiply 2%, now 2 into 3.865%, if you apply, you have to get some value, na? That is called as Macaulay's duration based estimation. Duration based estimation, which means 9431.5 is current price into 2 into 3. See, very simple, 2 into 3.865%. How much is that? 7.73%. 7.73%. Very simple. Volatility 1%. What is the change? 3.865. For 2%, 7.73% is the change. For 2%, if 7.73% is the change, and existing value comes to 9431.5 na. So 100 minus, which means, see, very simple. If you increase now, YTM decreases na. If YTM decreases by 2%, bond value will increase or decrease or increase. Increase by how much? 7.73%. Apo 94, see what happens, 9431.5. If this value increases by 7.73%, how much it should be? 1 into 107.73%. Okay, 9431.5 into 107.73% comes to 10,160. 10,160. This is what they have done here. Are you all understanding? This value separately they have found out. Very simple. 9431.5 into this 7.73%, it comes to 729.5 plus the value. Why plus? Because, okay, YTM decreases now, bond value should be increased. Inversely related, 10,160.55. Next, this is how you found out the value using the, what do you say, intrinsic value method, volatility based estimate, volatility based estimate. Now by intrinsic value method, already we discounted, already we found out, okay, 10,204.5, 10,204.5. Hence the expected price as per the intrinsic value method is 10,204.5. Okay, next question, convertible bond, very, very important for this attempt. Question number 4. The following data is related to 8.5% fully convertible into equity shares. Okay, debentures issued by JSA Limited at 1,000. Okay, market price of debenture given, conversion ratio given, straight value of debenture given, market price of equity shares on the date of conversion given, expected dividend price per share given. You are required to calculate conversion value of debenture, market conversion price, conversion premium per share, ratio of conversion premium, premium over straight value of debenture, favorable income differential per share, premium payback period. Now, this is the question that is being asked. Before solving the question, first we need to understand 3 things regarding convertible bond. See, the convertible bond, what do you mean by? There are 3 types of instrument. First, you need to understand some basic things. Thereafter, we will understand the question. See, there are 3 instruments, namely bond, equity, and convertible bond. Convertible bond. Now, see what happens. If you invest in bonds, the good thing is that your return will be fixed in nature. Your return will be fixed. Okay, you don't have any risk. So it's more or less riskless security. Okay, or less risk security, or equity if you take, it is high risk security where, okay, you enjoy the profit in share. You enjoy the profit in share. That's the advantage of equity. But the problem is, okay, when company makes losses, share will be worthless. Okay, in that case, equity will be dangerous. Are you listening? Risky instrument. But in case of bond, what happens? See, if the company does well, bond has an advantage. What is the advantage of bond? Advantage of bonds is that the return will be fixed in nature. You don't have any uncertainty, no risk. But problem is that, okay, if you invest in bonds and the company does exceedingly well, company does very well, okay, the share price creates wealth, okay, it jumps up. In that case, what happens? You tell me. The company will give you share in profit. It will never give you share in profit. Are you all understanding? So the benefit you have in equity, share in profit, okay, but you have to bear the risk also. Bond, okay, you don't have any uncertainty, but you will not get any share in profit. Are you all listening? But in case of convertible bond, tries to, okay, mix both the advantages of these two instruments, which means convertible bond, what they say, the company, when in initial phases they issue the convertible bonds, what happens is, okay, you take the instrument, you take it as bond. Now you take it as a bond. See, now I don't know what will be the company's performance in the future. So what they say, if the company does well in the future, you convert it into equity shares. If the company does well in the future, you convert it into equity share. If company doesn't do well, equity share become worthless. Okay, you will become a bondholder. Are you all understanding? This is a bond which is having a conversion option, is called as convertible bond. Now, I have three prices here, my dear friends. I have three prices for convertible bond. See, now, what do you mean by these three prices? I'll one by one explain. I have first, you see, straight value of bond. I have straight value of bond, which means a bond, plain bond, which is having no conversion option, I call it a straight value of bond. Then there is share value of bond. This is also called as conversion value, Are you all understanding? This is called a share value of bond or conversion value. What is this? What is the formula for it? Conversion ratio. Okay. Conversion ratio, which means for every one bond, how many shares you get, conversion ratio into, okay, the share price prevailing on that date, which means, to put it simply, for every one bond, assume in this question, let's take this question as an example here. In this question, what happens? The conversion, CL, straight value of debenture given as 700 rupees, which means a debenture without having the conversion option will be having a value of how much? 700. Are you all understanding the first price? Okay, next, the share value of bond. Here, tell me children, for every one share, how many, every one bond, how many shares will be issued? 30 shares will be issued, which means, and the market price of equity share is how much? 25, which means if I convert the bond today, what is the conversion value? 30 into 25, let's say 30 into 25, how much is that? 750. So 750 is the conversion value. This is also called a share value of the bond or stock value of the bond. Are you understanding? Different names are conversion value, stock value, share value, everything. Okay, this conversion share value means the market price per share into conversion ratio. This is stock value. Next, I have market price of debentures, convertible debentures, which is nothing but in this question, how much is the market price of convertible debentures? 900, I think. Yes. Are you all understanding this? These three prices, very, very important. First, you, with any convertible bond question, segregate these three prices. First, plain value of bond, then conversion value, or I call it a stock value. Then there is market price of bond. Are you all understanding? You segregate this. Next, we will solve one by one each of the questions. See, conversion value of the debenture. What is the first question asking? Conversion value. Just now I told you this is nothing but share value or stock value. Very simple. If I convert my bond into equity today, what will be the value of this equity shares? Are you all understanding? Which means, okay, one bond I'll get 30 shares, 30 into 25 market price of the share, 750 will be the conversion value. Are you all listening? Here I have given the solution. Conversion value of the debenture, market price of one equity share into conversion ratio, 750 is the conversion value. Next, market conversion price. What do you mean by market conversion price? Very simple. What they say, okay, see, you have, what is the value of the convertible bond? 900 is the convertible bond. What is the value of the convertible bond? 900 is the convertible bond value. Okay, divided by the conversion ratio, which means this is nothing but, okay, very simple. Okay, share equivalent price. This is nothing but share equivalent price. Very simple, I'll tell you what happens. In the 900, how many shares can be allotted? 30 shares will be allotted. Are you listening? If you are converting, 30 shares will be allotted to you. Upon 900 divided by 30, what is that? 30 is the share price, which means, okay, very simple. Market conversion price means at what price of the equity share I will be indifferent between the convertible bond and equity value. Are you all understanding? Non-conversion. See, I will be indifferent between conversion and non-conversion. What is that price? 30 rupees per share. Are you all listening? That is what is given. Market conversion price, market price of the convertible debentures 900 divided by 30, which is 30 rupees. Are you all understanding what I am trying to say? Okay. Now, next. What is that? Conversion premium per share. Conversion premium per share. Very simple. This is per share basis. They have asked. See, the same thing you can also find out on total basis and per share basis. Very simple. Here, you tell me conversion premium. When I question, see, there are two premiums here. Very simple. Just now I told you there are three prices available for the convertible bonds. One is normal plain value of the bond. Plain value of the bond. Then you have share value of the bond, little bit more. Then you have market price of the convertible bonds. Highest market price convertible bond will be trading in the market at the highest price. Why? Because it has conversion option. It is, okay, it is giving you more choice, na? So it is having the premium. Now tell me children, there are two premiums available. If you notice, there is 700, there is 750. Here also there is a premium price, which means stock value of the bond will be more than straight value of the bond. Then you have market price of the convertible bond, okay, which is 900 more than 700 and 750. Which means when you compare the market price of the convertible bond, 900, you can also compare with 750. You can also compare with 700. Two things are there. Are you all understanding, carefully observing? So, when I compare the straight value of the bond, with market price of the bond, this is premium, na? 700, 900, upon 200 premium extra is there. This I call it as premium over straight value of bond. Premium over straight value of bond. This is one premium. There is another premium. Okay, premium over stock value of bond. Premium over stock value of bond, which is 900 minus 750. This premium over stock value of bond, okay, also is known as conversion premium. Why? Because this is also called as conversion value. Are you all understanding? Conversion premium means premium over conversion value or stock value of the bond, which means 900 rupees is my total price. Okay, 750 is the convertible, the equity value or stock value of the bond. What is the premium over the conversion value? 150 is the premium. Okay, this is 150 is the premium paid over and above what? 750. Are you all understanding? This is on a total basis. This is a premium. This is total basis. The 150 is the premium over and above the 750. You can also calculate in percentage terms. If it is calculated on percentage terms, 150 divided by 750, you will get premium of 20%. Are you all understanding? Now, if you want to calculate it on total basis, it will be in rupees. Now, 150 rupees will be the premium. On a per share basis, if you want to find out the premium, conversion premium on a per share basis, 150 divided by conversion ratio 30, rupees 5 per share. To put it simply, the share is trading at 25 and the convertible bond is on par, okay, with 30 rupees. Okay, this is the market conversion price is 30 rupees. Apo 5 rupees extra you have to pay. Very per share basis, every one share you have to pay 5 rupees, and 30 shares will be allotted to you into 5. Totally 150 rupees extra you need to pay to get the conversion option. Are you all understanding? This is what is conversion premium per share. Here I have given the solution. Conversion premium per share, market conversion price minus market price of equity share. This is on a per share basis asked, hence I did. This also can be arrived. Okay, on a total basis, 150 is the total premium over the conversion value divided by, okay, conversion, what is that? Conversion ratio. 30 shares will be allotted to you. Up per share, every share you have to pay 5 rupees extra. Are you all understanding? This is conversion premium per share. Next. You have ratio of conversion premium. That is also easily understandable. Ratio is 20%. Just now I computed, 150 is the total conversion premium divided by from where it jumped. From 750 you have to pay premium of 150. So base should be 750. 150 divided by 750, 20% you have to pay the premium. Okay, over and above the stock value to get it get the convertible bonds. That is what they have asked. The ratio of conversion premium 20%. This I have given here per share basis, total basis also you can compute. Per share basis now you had 30 rupees on par value of the bond, which means 5 rupees premium there. Premium divided by base 25. Or total basis, this is nothing but 150 rupees premium over and above the stock value divided by 750 will give you 20%. Are you all understanding? Next, go to the E part. What they are asking: premium over straight value of debenture. Now tell me, children, there are two premiums available here. One is that, okay, conversion premium, the per share, leave per share, anyway total basis, that is the premium. So conversion premium, 750 to 900, which is 150, is the conversion premium. Now, this is premium over straight value of debenture. Premium over straight value of debenture. What you should compare? This 700 you should compare with 900, which means 200 is the premium. In percentage terms, 200 divided by, what is that? 200 divided by 700, yes, 700, straight value of bond. That you should find out. Here they have given as a premium over straight value of bond. Can you see premium over straight value of debenture? Convertible price of the market price of convertible bond divided by straight value of the bond. Okay, 900 by 700 minus 1 means actually how they have computed. So 900 minus 700. This is the premium. Correct? Divided by 700. That's what they have done. 900 divided by 700 minus 1. 28.6. Are you all understanding? 200 divided by 700. How much you are getting? 28.57, rounded off to 28.6. This the amount of premium paid over and above the straight value of the bond. Note. Okay, here I have given whatever I said. This should not be confused with conversion premium. Conversion premium is the premium over and above the share value of the bond, i.e. in this case 900 minus 750, 150, whereas the premium over straight value of the bond shows premium paid over and above the straight value of the bond. Are you all understanding the 200? Which means the essence of this question is, whenever they ask about convertible bond, this you should remember, my dear friends, this segment, okay, you should remember how to segregate, okay, three prices. You should be very thorough with. Can you revise? Okay, next. You have two more adjustments. Favorable income differential per share. Okay, favorable income differential per share. Then you have premium payback period. Very simple. Now, favorable income differential per share. What it really means, very simple. See, you have bought convertible bonds. Correct? Now, bond will pay you some income. See, here I have bond. Here I have share. Are you listening? Now, bond will pay me some income. What will be bond paying me? Coupon will be paid by the paid by the bond. How much is that? 8.5% is a coupon paid by the bond applied on 1000, which means how much is the amount? 1000 into 8.5%. 85 rupees will be the income arising from the bond. If I hold the bond, the income will be 85. Agreed? In case if I hold the share, you tell me, if I hold the bond, I will receive the coupon. Up 8.5% coupon I will receive 85 rupees in total on total basis. Or what do you mean by total basis? Now face value to apply 8.5%, you will get the coupon. Agreed? Now, every year I will receive 85 rupees. If I hold the share, conversely, if I hold the share, what I will get? Dividend per share. This is given in the question. Expected dividend per share. If you hold the share, you will get the dividend. 1 rupees is the dividend. For every one bond, 30 rupees will be the dividend. Are you understanding? Every one bond will have 30 shares bundled up. For every share, 1 rupee dividend. 30 shares, how much is the dividend amount? Rupees 30. Are you understanding? If I hold the bond, convertible bond, I get 85 rupees as income. If I hold the shares, I will get 30 rupees as income. Okay, what is the income differential? Extra income I am earning by way of holding the convertible bond. It is nothing but 85 minus 30, 55 rupees. 55 rupees. Are you listening? This is in case of total basis. Correct? This is total basis. 55 rupees income I am earning extra. On a per share basis, how to find out? Very simple. On a per share basis, what you do? The total 55 rupees you have received, differential income divided by conversion premium. How many shares will be issued for each bond? Okay, this is totally you earn by holding one bond. If you, okay, per share basis, if you want to compute, what I do, divided by conversion premium, 55 divided by, how much is that? 30, 1.833. Are you all understanding? Okay, this is favorable income differential per share. On a total basis, if you compute, it will come to 55 divided by conversion premium per share basis, you will get. Last one, premium payback period. Now, this question is little bit tricky, you have to see. They have asked premium payback period. Where is this? Yes, premium payback period. Now, doubt will arise. Sir, there are two premiums here. Premium over straight value of bond and premium over conversion value. Which premium I should take? Are you all understanding? Okay, this doubt will be, you are having this doubt. Now, whenever they say simply premium, now always you should understand it to be conversion premium. Always to be understood as conversion premium and not premium over straight value of bond. For, okay, premium over straight value of bond, if they want to ask, they will always mention that it is premium over straight value of bond. Fully will be given. Just premium is given loosely, they have given premium. Now, you should understand that it is conversion premium and not the premium over straight value of bond. Are you all understanding? So, the conversion premium, which means 750, 900 minus 750, 150 is the, okay, total amount. Are you all listening? Now, this 150 will be recovered. How many years? In how many years? You tell me, children. You paid a premium. You paid a premium. Very simple. 150 is the amount. Okay, you paid the premium. Agreed? Now, I'm showing you the, here I have given on per share basis. Don't worry. Anyway, I will show you both the methods. Whichever you are comfortable, you can understand like this. See, 150 rupees you have to pay additionally. See, convertible bond price is 900. You have to pay how much? 750, 150 rupees extra you paid. Now, this incremental amount, how much time it will take to recover? Now, this will be recovered by the income. Now, income of the bond is how much? 85. But out of that, if I held the shares, okay, had I held the shares, I would have got 30 rupees as dividend, which means differential amount every year, additional incremental amount, how much I will earn? 55 rupees. This 55 rupees, okay, I used to recover my 150. How much time it will take for the premium to be recovered? Now, 150 divided by 55, you will get 2.73 years. Are you all understanding? This is on a total basis. Per share basis also you can solve. Very simple. Conversion premium, extra how much you pay? 25 rupees is the per share price, 30 rupees is the conversion value. So, which means 5 rupees extra per share basis, 5 rupees extra you pay, divided by income differential, favorable income differential, which means the earlier step, you computed 1.883 per share. Every one share, it will have a favorable income of 1.833. Divided by that number, you will get 2.73 years, which means on an average, how much the additional 150 rupees is getting recovered. This is what is, okay. What is that? Payback premium, payback period. Shall we move on to immunization concept? Okay, see here. Question number 5, bond immunization, portfolio of 2 bonds. See, I'll tell you the immunization concept, what it is, basic things I'll tell. I don't want to go deep into that. If you want to listen, I have put fully fixed income security, bond valuation revision. Okay, not many students know that I have put it fully. You can go and watch that. Anyway, I have given timestamp also. What I will do is that summarily I will discuss the concept, then move on. See, what is the concept of bond immunization? Just like you have vaccine for COVID, like this, okay, what I do, this is a way, this is a strategy by which I can immunize my portfolio or investment, okay, bond investment to actually, okay, reduce the risk from interest rate changes. Very simple. If I am a bond holder, okay, I told you, if interest rate changes, market interest rate changes, YTM goes up and down, agreda jumps up and down. In that case, what happens? You are exposed to interest rate risk. If you are a bond investor, you are always exposed to bond interest rate risk. If interest rate increases, bond value will decrease. If interest rate, which means increases, bond value will decrease. If interest rate decreases, bond value will increase and vice versa. Like this, okay, interest rate will have impact on the bond value. Are you all understanding? So, we are exposed to interest rate risk. How to hedge this position is subject matter of discussion, which means I need money after a period of say 4 years. Okay, during this 4 years, will my interest rate be same? It will be different. It may be different. Are you all understanding? So, how to hedge the interest rate risk in case you are a bond investor? This is the subject matter of discussion. What they say in bond immunization concept, I don't want to discuss fully. Very simple. I will tell you the conclusion of it. Okay. See, what they say is that you have computed Macaulay's duration. This is very, very important. You have computed Macaulay's duration. The year cash flow, present value factor, discounted cash flow. Then you have proportion, weighted proportion. Like this 6 column was there, we computed duration in number of years. This Macaulay's duration, what they say, when you invest in bond till duration, you will never expose to interest rate risk. Are you all understanding what I'm trying to say? Which means, suppose a bond's life is 6 years. Duration, Macaulay's duration is only 4.5 years. What they say, okay, don't buy a bond having a life of 6 years. If you want money after a period of 4.5 years, find a bond in the market having a duration of 4.5 years. Are you all understanding? Which means your investment horizon will be there. You will be requiring money after a period of 2 years, 3 years, 4 years. If you require money after 4.5 years, now what you do, go to the bond market, search a bond wherein you see that the maturity value of the bond is not 4.5 years. It should not be 4.5 years. See that the duration of the bond is 4.5 years. Are you understanding? See in the market whether any bond is available which is having duration of 4.5 years. Okay, that bond you invest, you will be immunized. This is the concept, how it happens. Okay, interest rate changes, now how value changes, everything I have explained detailedly in my revision lecture. Go through that if you want additionally. No issue. I don't want you to get distracted and go there. In the last 1 week of examination, don't do that. Just listen. You will understand. This is enough. Immunization strategy. Now I told you should only invest in the bond till the duration and not till the life of the bond. This is why. This is one of the reasons why we computed duration of the bond. Okay, this is the concept behind it. Now, sir, I say, one question is there. I go to the bond market. I want money after 4.5 years. I see that there is no bond available which is having a duration of 4.5 years. In that case, what I should do? Okay, I create a portfolio. Well, for example, one bond is having duration of 6 years. Another bond is having a duration of 2 years. Sir, I am not having any bond in the market which is having exactly duration of 4.5 years. What I should do? Very simple. You create a portfolio using these 2 bonds or 3 bonds if at all available. Okay, you create a portfolio in such a proportion, in such a way that, okay, your weighted duration will become 4.5 years. Are you all understanding? Weighted duration of the portfolio of bonds matches your investment horizon of 4.5 years. This is what is the concept of immunization. Individually, one bond will not be asked. Institutionally, they ask to create portfolio of bond. So what they will do now, one bond will give you duration which will not match your investment horizon. Another bond will be given which will not match your investment horizon. What you do, you create a portfolio in such proportion. The proportion only will be asked in the question. At what proportion you need to invest in, they will ask the question ultimately. Are you all understanding? So let us read out the question, understand the facts of the question, then we'll move on. See, Mr. A will need 1 lakh after 2 years for which he wants to make one-time necessary investment now. Very simple thing. You tell me, children, when he needs money after 2 years, he requires money. How much he requires money? 1 lakh rupees, which means today I require after 2 years. So I will need to invest for a period of 2 years. Maximum I should invest for 2 years because after 2 years I need money. Okay, I don't need to invest. I need money. So he has a choice of 2 types of bond. Their details are given below. Bond X detail given, bond Y detail given. Face value given. Coupon 7%, year 8%, years to maturity 1-4, current price is given, current yield is also given. Are you all understanding now? Current price, now it is to be understood as, okay, the value, fair value of the bond, current market price is given. Now, one single point here. First step, okay, you have to compute duration of the bond. First, you have to compute duration of the bond because immunization strategy, first step working note is duration. Computation of duration is the working note. See, advise Mr. A whether he should invest all his money one type of bond or he should buy both the bonds. If so, in which quantity? Assume that there will not be any call risk or default risk. No issue. Now, what they say, 2 bonds are given in the market. You need 1 lakh rupees after a period of 2 years. Whether you need to invest in one of the bond or both the bonds. So, I will compute the first step, I will compute the duration of the bond and I will see whether bond X is having 2 years duration or bond Y is having 2 years duration. If no bond is having a duration which matches my time horizon, what I will do? I will create a portfolio bond which by which the portfolio weighted duration, okay, matches with my investment time horizon. Are you all understanding? See what happens. Duration of bond X I compute. Year 1 cash flow 1070, present value factor. Only 1 year cash flow will be received 1070. What is this 1070? Now, very simple. First year end you receive the interest of 70 because 7% bond X will be the coupon. Next year redemption will be 1000. The same happens because 1 year is a life. So after 1 year I put it 70 plus 1000 coupon plus redemption, cumulatively discounted, you will get PV at 972.63, proportion 1. Entire thing is recovered the 1 year. Are you all understanding? A bond which is having a life of 1 year will also have the duration as 1 year. So the duration of the bond X is 1 year. Are you all understanding? Next step, duration of bond Y. Okay, I need to compute. So year cash flow, present value factor 10% present value, proportion of the bond value, proportion into time, weighted proportion, nothing new. Already you know how to compute, correct? 8% bond, so 1000 into 8, I get 80 as cash flow for 4 years. 80, 80, 80, 80. Last year, apart from that, redemption will also happen at face value. 1000 plus 80, 1080 into present value factor, I multiply, I get the present value. Proportion 72.72 divided by 936.52. Like this, I find the proportion. Multiply with 1, 2, 3, and 4. Okay, weighted duration comes to 3.563 years. Are you all understanding? So bond X duration is 1 year. Bond Y duration is 3.563 years. Sir, bond X is having a less duration than my duration, target duration. Bond Y is having more duration than my target duration. Neither of this bond is matching my 2 years of investment time horizon. What I should do? You cannot invest individually in these bonds. What you should do? You should create a portfolio of bonds. Portfolio, using these two bonds, you could create a portfolio in such a way that weighted duration becomes 2 years. And weighted duration becomes 2 years. See, very simple. I have given everything notes. He cannot invest all his money in one single bond because his investment horizon is 2 years and neither of these two bonds have the Macaulay's duration of 2 years exactly. Therefore, he needs to create a portfolio consist of these two bonds in some proportion. That is what is asked. Ultimately, we are going to solve it in some proportion so that the weighted duration of the portfolio matches becomes 2 years, which is his investment time period. Now, how to find the proportion? Sir, you told that you create a portfolio. You create a portfolio in such a proportion. But how to find that proportion? Very simple, logical calculation only. Very simple. See what happened. My weighted duration should be 2. Correct? Let the let the proportion be X. Proportion of the X be X, which means proportion of the X is assume P. Assume, let us proportion of X be X. You can take X and Y, you can take and solve, or let it X and Y, X and Y you can take and solve, or P and 1 minus P also you can take. Very simple, I'll tell you. Proportion of X be P. Let proportion of X be P, which means what is the duration of X1 into P. This will give you duration, weighted duration of XR plus what is the weighted duration of Y. Okay, duration of Y is what? 3.563 into 1 minus P. Are you all understanding? Because this portfolio, you are having only two security, two bonds. If one bond is 40%, now other bond will be 1 minus P. If one bond proportion 40%, what is the proportion of other bond? 60%. If one bond's proportion is 10%, what will be the proportion of other bond? 9. 1 minus 10% or 90%. Are you all understanding? So 1 into P plus 3.563 into 1 minus P, you equate it to 2. 2 is your target duration. Are you all understanding? If you solve it, you will get P is equal to, simple algebra, you will solve it 60.61 and 61%. What they say, P is equal to 61% means, okay, in bond X, we assumed bond X proportion to be P na. So in bond X, if I have, okay, 1 lakh rupees, assume some amount. This is not, it should not be 1 lakh. I'll tell you how to find out. You should invest 61% of money in X. You should invest balance 39% of your money in Y. Are you all understanding? Bond X and bond Y. Now the question, sir, how much you require? 1 lakh. But this 1 lakh you require after a period of 2 years. Sir, today, tell me children, today after 2 years, which means If I want 1 lakh after 2 years, I will deposit 1 lakh, present value of 1 lakh, present value of 1 lakh. Are you all understanding? So that it matures to 1 lakh after 2 years. I will deposit 1 lakh rupees, present value of 1 lakh, present value of 1 lakh. At what rate I should use? Current yield. Discount rate is 10%. I will use the 10% and discount and deposit the present value. Very simple. So what happens? 1 lakh is there. For 2 years, okay, I will discount this. Why? After 2 years, the maturity value should be 1 lakh. Now, what is the present value? Okay, what is the present value? See, 1 divided by 1.1 is equal to 2 times you press 0.826. Now, 0.826 into 1 lakh, 82,600. 82,600 will be the amount to be deposited in bond X so that it matures to not X, total amount. I need to total amount. Very simple. I'll show you here. Solution is okay. The presentation I've showed you. The one more thing I will show you here. See, 82,600. I need to deposit today so that it matures to 1 lakh after a period of 2 years. Agreed? This 82,600 is the present value. This I need to segregate because I need to invest 61% of my money in bond X, 39% of my money in bond Y. Are you all understanding? 82,600 into 61%. Tell me, children, how much is that? 50,000. 50,386. Here, 82,600 into 39%. 82,600 into 39%. 32,214. Are you all understanding? This is rupees I will deposit in both the bonds today. This is what I have given here. Present value 1 lakh for 2 years. Now you discount it into 61%. Bond X I will invest. That is, okay, 1 lakh into 0.826. Present value of 1 lakh into 61%. 50,386. Here bond value 1 lakh. Present value of 1 lakh into 39%. 32,214. Are you all understanding? First part of the solution. What they are asking. Okay. See. Yes, he should invest in one type of bond or both the bonds. One type of bond, both the bonds he should invest. Okay. First part. Next, if so, in which quantity? Assume that there will be no call risk. Now, they have asked, quantity means number of bonds. Ultimately, they are asking number of bonds to be purchased. Okay, to be purchased X and Y. For number of bonds of X, how much is to be purchased, and number of bonds of Y, how much is to be purchased, they are asking. So how should you compute? Very simple. Here, how much amount you invest? 50,386. Here, 32,240. Agreed? What is the market price? Market price of the bond. At what market price? Current market price. At current market price only you will invest. Upon respective current market price, you divide it, you will get the number of shares to be, number of bonds to be purchased. Number of bonds to be purchased is nothing but 50,386 divided by, okay, share bond price divided by bond price, 972 point bond price, bond X price 972.73. You will get 51.79 or 52 bond. Here bond Y, how many bonds I need to purchase? Total value should be 32,214 divided by what is the bond X price, bond Y price 936.52. I get 34 bonds. Are you all understanding? Here I have given the investor has to keep the money invested for 2 years. Therefore, the investor can invest in both the bonds with assumption that bond X amount will be reinvested for another 1 year on the same return. Okay, reinvestment of course. Okay, if you are finding the yield, yield will always assume that it is reinvested at the same rate. Okay, with this we are through with the bond valuation chapter. Shall we move on to the equity? Okay, now Walters and Gordon model. First model, Walters and Gordon model. I have combined cumulatively. I put a question, Walter as well as Gordon model. Okay, see, the following information is available given for QB Limited. Earnings per share given as 12. Dividend per share, this is clearly given as D1. Dividend per share. Now, upcoming year dividend per share. Very simple, I'll tell you. Sometimes the question, okay, here you need to segregate it is Z0 or D1. The company has paid a dividend, okay, last paid a dividend, or the company has recently paid a dividend, company pays a dividend. All this, okay, shows that this is D0. D1, what means? A company expects to pay a dividend next year. The company is going to pay dividend. Okay, the company is thinking of paying this much dividend next year. Like this, if details given, it is D1. Why this is important? Very simple. When the question asked related to, when there will be questions related to growth models, what you should do? The D1 is equal to D0 into 1 plus G, which means they will give D0 data and growth rate. You should convert it to D1. Are you listening? Sometimes they will give you growth, but they will give you directly the D1. Okay, they will give the data to confuse you. At that time, you should not be again doing 1 plus G, then it will become D2. Are you all understanding? So this is there. Anyway, here clearly mentioned it is D1. Dividend, what is D1 now? Dividend at the end of the first year dividend. Okay, now earnings per share given as 12. Next year dividend is 3 rupees. Cost of equity is 18%. Return on equity is 22%. Retention ratio is 75%. Calculate the market price per share using Gordon's model, Gordon's formula, Walter's formula. First we take Gordon's formula because it's given ask first. Very simple. Gordon's formula. Okay, earnings based model. Very simple. What you have? P0. Okay, value of the share or price of fair price of the share is equal to E na EPS. EPS into 1 minus B. B means retention ratio. 1 minus B is retention ratio divided by KE minus BR. This is the formula for Gordon. Are you all understanding? Here, even this is nothing new. E is EPS. Okay. 1 minus B, 1 minus retention ratio is nothing but dividend payout ratio. Dividend payout ratio. Earnings into dividend payout ratio, okay, is nothing but dividend. Is nothing but dividend effectively. And denominator also, if you see, BR is nothing but B into R is nothing but G, growth rate. Agreed? This is nothing but dividend growth formula, Gordon's growth formula. D1 by KE minus G is only written as, okay, E into 1 minus B divided by KE minus BR. Are you all comfortable? Here, just you don't need to discuss the logic and all. I have discussed in the regular lecture. E into 1 minus B. E is earnings per share given 12. 1 minus B, retention ratio is 75%. What is the payout ratio? 25%. Up 12 into 25%, okay, will be the numerator. Agreed? 4 rupees are 12 into 25%. Okay, 3. So 12 into 25 is 3 rupees divided by, okay, 18 is the K, 18% minus 0.18. You should write 18%. If you write in decimal terms, how much you will get? 0.18 minus G. Okay, G is nothing but BR. BR means retention ratio 0.75 into rate. Okay, how much you earn in the retained portion? What is the rate of earnings? Return on equity given 22%. Okay, here the question sometimes will not have clarity. Sometimes they will give a return on return on investment, IRR. Okay, simply return also they gave, or return on equity like in this question. Are you all understanding? Really speaking, the project IRR is something different from return on equity. It need not be same, but since no other data given, we'll assume the company earns the same return on equity. Okay, same return from the project, whatever is earning from the equity. So 22% return on equity we will consider. Okay, B into R 0.22 return on equity. We will consider that we will get 200. Are you all understanding? This is what they have given. By solving this, you get 200. This is as per Gordon's model. Walter's model, tell me the formula. Very simple. D plus R by K into E minus D. Okay, this E minus D is nothing but retained amount. Are you all understanding? This is dividend amount. So D plus R by K into E minus D, the whole divided by K. This is Walter's formula. Agreed? Now D, what is the D here in this question? You should take D as 3 rupees. 3 plus, okay, the rate of return earned 0.22 divided by KE 0.18 into EPS minus what is that? E minus D. How much is that? Dividend 3 rupees. 12 minus 3, 9 rupees. Okay, you should multiply into 0.22 by 0.18 divided by 0.18. Are you all understanding? Okay, this is the understanding. Okay, what is the value? 77.77. This is the value per share as per Walter's model. As per Walter's model, logic, details, everything I have covered there. Equity question, everything I have put it in YouTube freely. You can go through if you want. Okay, this I have given. No, not much clarity required for this. You can, okay, simple concept. Don't waste time on these things. Okay, next, dividend discount model and holding period based question. Take question number 7 for discussion. SAM Limited has just paid a dividend of 2 per share and it is expected to grow at 6% per annum. After paying dividend, the board declared to take up a project by retaining the next 3 years annual dividends. It is expected that the project is of same risk and as the existing project. The result of this project will start coming from the 4th year onward from now. The dividends will then be 2.5 per share and will grow at 7% per annum. An investor has 1,000 shares in SAM Limited and wants a receipt of at least 2,000 per annum from his investment. Show that the market value of the share is affected by the decision of the board. Also, show as to how the investor can maintain his target receipt from the investment for the first 3 years and improved income thereafter, given that the cost of capital of the firm is 8% per annum. See, what they say is that first, what is the impact on the share price due to the project? Whenever the company undertakes the project, okay, the project cash flows will be increasing, okay, based on if it is positive NPV generating project, the cash flows will be increasing, positive NPV generating project, which means the share price will ultimately appreciate. Now, how much is the impact in the share price? You need to show. This is what they ask in the first part. Show that the market value of the share is affected by the decision of the board, which means the investment decision which the company undertook by SAM Limited took, because of which market price will increase, we need to show. If project is not undertaken, what will be the share price? If project is undertaken, what will be the share price? We will find out. Then, we'll find out the impact on the share price. See what happens here. Value of the share at present before undertaking the project. Tell me, children, what is the value of the share? D1 divided by KE minus G. Okay, D1 by KE minus G, present value of all future cash flows, D1 to D infinity. I discount and bring it to present value terms. This present value of growing perpetual cash flow. In the time value of money itself, I have covered. So, present value of growing perpetual cash flow is nothing but first year end cash flow divided by, R minus G. This R is rate of return. Here it is required rate of return of equity holders. So, equity chapter. So, D1 by KE will be the, required rate of return of equity holders we will consider, minus G, growth rate. Are you understanding? If you do this, you will get present value of D1 to D infinity provided growth rate is given. This is constant growth model. Now, so D1 by KE minus G is the formula. You will apply here. If you see the company just paid a dividend of 2 per share. I told you in the previous question, this is D1 or D0 or D0. And you need to find out D1, D0 into 1 plus G. What is the growth rate to be applied here? Will grow, this is next project. This is without project, 6% it will grow, which means D 1.06. So 2 into 1.06 divided by K 8% minus G 6%. You will get the value as 108. Share price as 106. Now, however, if the board implements this decision, this 106 is the share price when the board, does not undertake the project at present without undertaking the project. Now, if undertakes the project, what happens? First 3 years, there will be no dividend. That is what they have given now. First 3 years, there will be no dividend. Now, there will be no D1, D2, D3. There will not be any D1, D2 or D3. From D4, and the dividend for the 4th year will be 2.5, which means D4 is 2.5 given. Are you all understanding? This is given as 2.5 and it will grow at 7.5% for 7% forever, and it will grow 7% forever at 7% forever. Now, the price of the share in this case, what will happen? You tell me. Now, I stand at the end of the year 3. First, I need to find out, I have D4. First, I need to find out, I have D4. Yes. Now, I have D4. What I will do, I will use the formula D1 by K minus G. If you want to find P0, you want to discount the first year cash flow from first year cash flow to D infinity. See, P0 is equal to D1 to D infinity. Agreed? First dividend to infinite amount of dividend. If you discount it, you will get this formula. This is nothing but D1 by KE minus G. If you want to find P0, you have to put D1 by KE minus G. If you want to find P3, price at the end of share price at the end of year 3, you will get D4 by KE minus G. Suppose you want to find out the price at the end of 7th year. How you should find? D8 divided by KE minus G. Are you all understanding? Okay, the next year cash flow divided by KE minus G. Okay, from where the growth stabilizes, okay, from there you should apply the formula. Very simple. Here they say first 3 years no dividend is there. Fourth year 2.5 dividend, and from here on the growth is constant, okay, at 7%. Growth is constant at 7%, which means you can use D4 by KE minus G and find out the P3. Are you all understand? Price at the end of year 3, you will find it was 198.46. This is not, see, this is not 198.46. Okay, that is P0. What they have done, I'll tell you. See, first 2.5, see, I'll just, okay, see here, 2.5 divided by 2.5 divided by 2.5 divided by KE what, 8% minus 7%, okay, will give you 250. 2.5 divided by 1%, 250 rupees is the price per share after a period of 3 years. This is called as P3, price at the end of third year, price at the end of third year. Now, I want price at the end of third year, P0. I need to find out any, okay, question value. Always you will try to value the asset today, not after 3 years, which means what you should do, you should discount and bring it to present value terms. What is the discounting rate? Price after 3 years, I will discount it, okay, 1 divided by 1.08 raised to the power 3. What is that? Okay, into 250, 198.46. Are you all understanding this? Very simple. First, you need to find D4 given the question. First 3 years, no dividend. From 4th year onwards, dividend grows forever at how much percentage? 7%. Now, 4th year dividend D4 given. Using this D4 by KE minus G, you should find out P3. Price at the end of year 3, I got it as 250. Now, you have P3, you need to find out P1 now. Discount it for 3 years. Okay, bring it to present value terms. Are you all understanding? Which is nothing but 198.46. So, price today of this share, if the project is undertaken, how much is the price? 198.46. Okay, now, what they say? Okay, next part of the question. Also show as to how the investor can maintain his target receipt from the investment for the first 3 years and improved income thereafter, given that the cost of capital is 8%. His cost, see what they say, he want a receipt of at least 2,000 from this investment. So what I should do? Very simple. Initially, okay, what he does now, very simple. So the price of the share is expected to increase from 106 to 198.58. Obviously, after the announcement of the project, the investor can take up the situation as follows. See, very simple. After 3 years, what will be the share price? 250. Just now I computed. 2.5 divided by KE minus G. This is nothing but D4 divided by KE minus G will give you P3. This is P price at the end of year 3 is 250. 1 year, you bring it to present value terms, discount it again, 1 divided by 1.08, you discount it, okay, once you discount, you will get 231.48. Are you all understanding? Now, again you discount once, okay, one more time, you will get 214.33, which means today the fair price is 198 point, how much we got? 198.46. Today, the price is 198.46. After 1 year, the share price is 214.33. After 2 years, the share price might be 231.48. Okay, this is all possibility. Fair price is what? Okay. After 3 years, the share price may appreciate to 250. Are you all understanding? This is P0, P1, P2. This is P0, P1, P2, P3. Listening, now what they say? The question they asked that this person at least wants 2,000 for the first 3 years, because first 3 years he will not get any dividend. What he need to do? He need to sell the share itself. He need to sell partial amount of share, few number of shares. How many number of shares he need to sell is the subject matter of discussion. Are you all understanding? So how much target receipt, how much he requires? 2,000 rupees, at least 2,000 rupees he requires. Agreed? So what he do? Okay, first year end, what is the share price? 214.33. Are you all listening? Okay, so 2,000 divided by 214.33, how much is the value? See, very simple. How much is the value? At least I need 2,000. 214.33 into 10, 2,000 2143. Are you all understanding? 2143.33. Listening, so at least 2000 he will recover. Sir, why I need to sell 10 shares? Can I sell 9 shares? No. What is the share price? 214.33 into 9. How much is that? 1928. 214 into 9, if you do, it will be only 1928. So less than 2000 you cannot recover, which means at least 2000 he needs to recover. Hence first year I sell 10 shares. In the first year end I sell 10 shares. Come to the second year. Second year, what happened? In order to maintain the same 2000 receipt, second year, how much I need to sell? 9 shares. Why? The share price will be 231.48. 231.48. Now 2000 divided by 231.48. How much is the decimal? 8.64, which means decimal. Okay, at least I need to sell 9 shares because minimum 2000 is required. So I will sell 9 shares. I will get 2083.32. Third year end, I will sell 8 shares because the share price would have been how much? 250. In order to make 2000 exactly, I need to sell 8 shares. Are you all understanding? So, in order to receive 2000 from the company, first year end, I will sell 10 shares. At what price? Price prevailing on that day, 214.33. Second year end, I will sell 9 shares for 231.48. Third year end, I will sell 8 shares for 2000. Are you all understanding? At the end of third year, what happens? He would have having balance shares in 1000. Minus 10 minus 9 minus 8. How much is that? 973 shares. It will be valued at the end of third year. How much? 250. So balance in your portfolio, in your demat account, the SAM Limited will have 973 shares into 250 each. Are you all understanding? The total value of the portfolio will be 2,43,250. On this 973 shares, he will receive a dividend from the fourth year of 2.5, which is 2432.5, which means from the fourth year to the foreseeable future, his dividend income will ensure that he will get 2000 per year every year. Are you all understanding? But first 3 years, when the company undertakes the project, he will have no alternative. He wants at least 2000 from this investment. Hence, he need to sell the 10 plus 9, 19, 8, 27 shares. Are you all understanding? So, if the project is taken up by the company, the investor would be able to maintain his receipt for at least 2000 for the first 3 years and would be getting the increased income thereafter, because the dividend income 2432 is more than 2143 or 2083 or 2000. Are you understanding? So initially he need to sacrifice for first 3 years, thereafter from fourth year he'll get the additional dividend. Okay, next question. Calculation of beta and CAPM. Very routine question, hence I'm discussing easy only, but under or overvaluation, okay, they usually test in every alternative attempt, so I'm discussing. Very easy question. Anyway, XYZ Limited paid a dividend of 2 for the current year. The dividend is expected to grow at 40% for the next 5 years and at 15% per annum thereafter. The return of 182 days T-bills is 11% per annum and the market return is expected to be around 18% with a variance of 24%. The covariance of XYZ's return with that the market is 30%. You are required to calculate the required rate of return and intrinsic value of the stock. This is a question that is being asked. Very simple. Whenever they give you RF, RM and all this, you need to understand they're testing you the CAPM approach, which means CAPM, KE as per the CAPM is equal to RF plus beta into RM minus RF. Here, if you notice, in this question, what is the RF? RF given as 182 days T-bills given now, that 11% you should consider as RF. The 11% you should consider as RF. Then what is the RM here? Okay, the RM is given or not given? Yes, given. No, covariance of the market is given. Very simple. Okay, see, here only you need to understand. Yes, market return given as 18%. Sorry, the market return is given as 18% and the market variance of the market return is 24%. Very simple. Beta, 6 formulas are there for beta. Okay, in portfolio management we'll discuss anyway. One of the formula for beta is covariance of market, covariance of what is that? Security and market. Covariance of security and market divided by sigma m square, the variance of the market. Covariance of the security and market divided by sigma m square or variance of the market will give you beta, one of the formula. Okay, here covariance, that is why they have given. Beta directly they have not given. Covariance is 30%. Okay, 30 divided by, what is the variance? 24. Okay, 30 divided by 24 will give you 1.25. Beta as 1.25. Are you all understanding? So beta 1.25. With this you will find out, okay, expected, this is wrongly given as expected return. Actually expected return and required rate of return is different. Expected return is the mean return or average return. Required return is what you require from the investment. The investors, okay, required KE is called as, okay, the equity holders required rate of return. That is what is computed using CAPM or SML return. SML return, which you are going to compute, study in CAPM. RF plus beta into RM minus RF. Here 11% beta, substitute it, you will get KE as 19.75%. You have found out KE. Now the next step is to, okay, yes, you are required to calculate the required rate of return, then intrinsic value of the stock. Intrinsic value of the stock. Now you will apply what? See, paid a dividend of 2 at the for the current year. The dividend is expected to grow next year's 15% per annum thereafter, which means very simple. The two-stage dividend model. This is called as two-stage dividend model, which means, see, very simple. The dividend, what happens? The next 5 years, 1, 2, 3, 4, 5, D1, D2, D3, D4, and D5. Okay, thereafter it is there. Okay, it will be there. What they say is that from D1 to D5, the company is growing, which means the first 5 years, this I call it as high growth period. How much is that? 40%. 40%. This is growing at 40%. Are you all understanding? The next stage, what happens from the year 5, this are all D1, D2, D3, year 1, 2, 3, 4, 5. From 5th year onwards, the balance years, okay, this is to be taken as constant growth period. How much is that? First 5 years, it grows at 40%. After that, it stabilizes at 15% per annum. Now, what they say, this D1 by K minus G, you learned the formula, constant growth model formula. This formula, you can only apply when the growth rate stabilizes, which means first 5 dividend, okay, you need to discount it manually. You find D1, D2, D3, D4, D5, correct? This, you want to find out P0, Upper you discount the D1, bring it to present value terms. D2, bring it to present value terms. D3, use the 3-year discounting rate, bring it to present value terms. D4, 4-year discounting rate, bring it to present value terms. D5, discounted present value terms. Thereafter, okay, you will have, at the end of 5th year, you will have P5, which means price prevailing at the end of 5th year. Thereafter, growth stabilizes. I can use this formula. P5 is equal to D6. Next dividend, okay, I told you the first year dividend, ensuing periods dividend, D6 by K minus G. Here you can apply the constant growth model and find out P5. So, 5th year end, you will have D5 and P5. Okay, D5 and P5. You discount and bring it to present value terms, which means I will have D1, D2, D3, D4, D5 and P5. Everything I will discount and bring it to present value terms. You will get the P0 price today. Are you all understanding? P0 or value of the share today. Now P5 is nothing but D6 divided by KE minus G. For that you need to find out D6. D6 is nothing but D5 into 1 plus G. Are you all understanding? Here D5. First you will find out D1, D2, D3, D4, D5 using 40% growth rate. 40% as G. D6 when you find out, D5 into 1 plus G, here growth rate is how much? It stabilizes at 15%. 15%. Are you all understanding? Like this, you need to find out. This is the solution given. See here, year 1, dividend 2.8. You will apply dividend. Okay, year 1 dividend 2.8. Discount and bring it to present value terms 2.34. Year 2, second year dividend, present value factor for 2 years. Okay, this is present discount at KE, present value factor at KE. Okay, equity cash flow, you need to discount using KE to bring it to present value terms. Next, third year cash flow, you will discount using 3-year discounting rate, 19.75. Now 1 divided by 1975, like this the first year. Second year, 1 divided by 1.15 is equal to 2 times. Or question may give you discounting factor directly, you can take and consider. If not, you can calculate also. Okay, next to 4th year, 7.68 is the dividend. Present value factor, you will get the discounted value. 5th year, you have dividend of 10.76. Are you all understanding? This is 10.76 discounted, bring it to present value terms. So, Total D1 to D5, you have the present value of 16.36. Here, they have not shown, but I can show you in a different manner. Other institute present is this way. Also, you can show it like this. Here, these are all D1, D2, D3, see, D4 and D5, and I have P5. P5 is called as terminal value. P5 is nothing but terminal value. How to find it? D6 by K minus G. Here the growth rate is different. Are you all understanding? Sometimes the 6th year KE also may be different. Business valuation, one of the question we saw that, right? So PV of terminal value is D5 into, this is D6 you need to find out. D6 is nothing but D5 into 1 plus G, okay, 15%, 1.15, they have considered, divided by KE minus G, okay, the revised growth rate 15%, if you calculate into present value, see, this is D6 by KE minus G, you found out the P5. P5 you discount using 0.406. This is nothing but, okay, 5th year end discounting rate. So 5th year you have this discounting rate, same discounting rate 0.406 you will apply to P5, okay, P5, and you will get the value as how much you discount and find out the value as 105.77, which means 16.36, the total present value of dividend plus present value of the terminal value 105.77, total value of the share is, okay, 122.13. Are you all understanding? Okay, next question number 9. Question number 9. Following financial data are available for PQR Limited, okay, for the year 2022. Now, particulars, amount in lakhs, 8% debentures 125, 10% bonds given, equity shares of 100, reserves and surplus 300, total assets comes to 600. Asset turnover ratio given as 1.1, effective interest rate is given as 8%, effective tax rate 40%, operating margin given. Now, a dividend payout ratio, current market price and required rate of return of the investors, okay, 15% is given. You are required to draw income statement for the year. First step, okay, this is a question regarding sustainable growth rate, SGR, and CAPM. I put it like this, okay. It's kind of miscellaneous question, but I put it under equity valuation, majority, okay, predominantly based on equity. Now, draw income statement for the year. Very simple. You have to draw income statement. Now, first, asset turnover ratio given. I have total assets, correct? First, I need to find out, first line, okay, top line, sales. Turnover, how much? Okay, 600 assets into 1.1 asset turnover ratio. So, 660 lakhs will be my total sales. Asset turnover ratio is nothing but turnover divided by total assets. Total assets comes to 600. Ratio is 1.1. So asset, the turnover is 600 into 1.1, which is 660 lakhs. Then effective interest rate. Okay, the total interest amount divided by liabilities, which is 8%. What is the total liability? See, you have, what is the total amount of liabilities? 125 plus 50 lakhs, which is 175 lakhs. Okay, which is 175 lakhs. Here 175 plus bonds, which means you have 8% debentures and 10% bond. Total effective interest rate is 8% they have given, which means, okay, cumulatively the value is 125 plus 50, 175 lakhs. Into 8%, if you apply, you will get the average interest amount. 175 into 8%, 14 lakhs. This is 14 lakhs is total interest amount. Next, you have operating margin 10%. Na? Okay, operating margin 10% you will apply in 660 lakhs. This will be the profit. 594 lakhs will be the operating profit, wherein operating cost will be how much? 90%. See, very simple. 10% is the operating margin, profit margin, which means 90% will be the cost. So what is the cost? 660 into 90 lakhs, 594 lakhs. Margin, how much will be the operating profit? Okay, 660 lakhs into 10, which is 66 lakhs. Are you understanding? Remaining 66 lakhs will be operating profit. Then you have dividend payout ratio 16.67%. Tax rate is given. Now, income statement, sales we have 660 lakhs minus operating expenses 594. 90% of it is operating expenses. EBIT, you'll get a 66 minus interest. Okay, 14. You will get EBT as 52. Tax at 40%. EAT, earnings available for shareholders. Thereafter, you will declare dividend of 16.67%, 5.2. Okay, if you reduce it, you will get 26 as retained earnings. Now, SGR formula, very simple. SGR formula is nothing but return on equity into 1 minus B. Return on equity into 1 minus B. Now, tell me, children, what is the ROE here? Return on equity is equal to, okay, net profit after tax. Net profit after tax divided by, okay, what is that? Equity. Equity means equity share capital plus reserves and surplus. Both you need to consider for computing the ROE. Denominator equity means you should consider the net worth, which means 100 plus 300 lakhs, 400 lakhs is the equity value. Okay, this PAT divided by equity value gives you ROE as 7.8%. Are you all understanding? So 7.8% is the ROE into 1 minus retention ratio. Okay, how much is that? 1 minus retention ratio. Sustainable growth rate is how much? See, 1 minus B, it should not be ROE 1 minus B. SGR is equal to ROE into, okay, into, see, this is wrong. Actually, 1 minus B, it should not, 1 minus payout ratio. This should be 1 minus payout ratio. Okay, this is C. ROE, I can call it as the self, okay, growth rate, sustainable growth rate is nothing but, okay, B into R, which I explained in the Gordon's model. Remember, G is equal to B into R. We discussed now. This growth only we need to compute. R is here, okay, ROE into B only is, okay, sustainable growth rate, not 1 minus B. This is 1 minus payout ratio, or just simply into B. B only is called as retention ratio. So ROE into 1 minus B, into B, simply B. So what is the B here? 7.8 into, what is B? Tell me, children, what is B? Okay, how much is the retained portion? 100 minus 16. If dividend payout ratio is 16.67, what is the retained portion? 83.83. So 7.8 into 83.33%. What is the amount? 7.8 into 83.33%. 6.49 or 6.5%. 6.5% is the sustainable growth rate. Okay. ROE into B or ROE into 1 minus payout ratio. Should have been payout ratio. I don't know how it is. Maybe while copy pasting, it is printing mistake came. No issue. Next, calculation of fair value of share using dividend discount model. Calculation of fair value using dividend discount model. Now, we have G now. Now, sustainable growth. How much is the G? 6.5%. We have dividend. How much is the dividend? 16.67% per share with the 5.2. 5.2 is the dividend. Okay, which is what is that? 0.52 dividend, total dividend. Yes, 5.2. This is in lakhs. Yes, 5.2 lakhs. Now 5,20,000 is the total dividend paid out by the company. Okay, to dividend per share. Total number of shares outstanding in the company, how much? See, what is the number of shares outstanding? Equity shares 10 each, 100 lakhs, which means 10 lakhs. Upper 10 lakhs is the share outstanding. 5,20,000 divided by 10 lakhs. How much is that? 0.50, 0.52 per share is the dividend per share. Is the dividend per share, which means, see, 0.52 D0. This is D0 into 1 plus G now. 1 plus 0.065. 6.5% is the growth divided by KE. What is the KE? 15%. 0.15 minus G, 0.065. This, if you do, you'll get 6.51 as the share price. Are you understanding? So, remarks in the current market price. Now, they want to comment. Now, see, very simple. They want us to draw income statement for the year. Then they want to calculate sustainable growth rate, which is nothing but, okay, ROE into B or retention ratio. That is, okay, sustainable growth rate. Calculate fair price of the company share using dividend discount model. D1 by KE minus G. We assume the constant growing model and found out. What is your opinion on investment in the company share at current price? Which means the fair price which we computed for step number 3 is how much? 6.51. The fair price is 6.51. The traded price, quoted price is how much? 14 rupees. Under overvalued, which means I will not buy the share. If I have share in the hand, I will sell the share. Are you all understanding? Okay, it is recommended not to buy the share or sell the share. Since the current market price per share is 14, the share is overvalued and hence recommended to not invest in the company. Or if you already hold the share, sell the share. Are you all understanding? Next, question number 10. This is also past RTP question, very important question. Okay, regularly asked. Now, Current EPS is 10.16. Growth rate in high growth period 4%. Length of high growth period is 4 years. Payout ratio during high growth period 52%. Return on equity is 12%. Expected growth in stable phase is 3%. Then payout ratio in stable phase is 60%. Calculate the value of equity share. This is the question that is being asked. Here, if you notice, see, till now, what we discussed, okay, the growth model, dividend discount model, okay, dividend growth model, like this we found out na D1, D2, D3, okay, D2 is equal to D1, D3 is equal to D2 into 1 plus G, okay, or D2 is equal to D1 into 1 plus G, D1 is equal to D0 into 1 plus G, like this we kept on finding out the dividends using the growth rate. Now, question arises in the dividend growth model. In the dividend growth model, we have formula D1 by KE minus G. This G is growth of dividend, growth of earnings. Question arises. Are you all understanding? If you use the dividend discount model, the main question is, sir, here G is there. The growth of dividend, growth in earnings. Generally, what growth means? Growth in earnings. Generally, growth means growth in earnings. Now, the growth in the EPS, okay, the earnings, total basis, I'm telling, growth in per share basis, it is called as EPS, earnings per share. The growth in EPS will be growth in dividend when the payout ratio is constant. When the payout ratio is constant, which means if you alter the payout ratio, okay, the dividend might be growing at some other rate, EPS might be growing at some other rate. Are you all understanding? So, which means you should consider the growth rate of the dividend. You should consider the dividend growth rate. Okay, so what is the issue? Very simple. Every year, the growth rate is given, you apply it to the earnings. You apply it to the earnings. Then, if payout ratio is not constant, see whether payout ratio is constant. If the payout ratio is constant, directly you can use the G to the dividend and find out the value per share. But the problem is, when payout ratio is not constant, what you should do? You should apply the growth to the earnings. The growth will be happening to earnings. Fine. Thereafter, respective years, payout ratio you will apply to the EPS of the respective year. Are you all understanding? Thereafter, you will find out D1, D2, D3, D4, D5, like this respective years dividend you will find out. Then apply the dividend discount model, find the value of the share. Are you all understanding? See, very simple. In this question, we are going to see. Now, what you do? First, working note number 1, calculation of EPS 4. Why you need EPS 4? To find out, okay, to find out D4. To find out D4, I need first EPS at the end of year 4. Are you all understanding? Okay, now, why you need D4 or D? I will need D4. Thereafter, I will need D5. Okay, I will use D5. D5 I will use, and then I will find out P4. P4 is equal to D5 by KE minus G. I will get P4. Are you all understanding? See, very simple. One by one, I will try to make you understand. First, EPS 4 you will find out. How to find EPS 4? EPS into third year EPS. How much is that? 10. See, EPS, what they have given. Yes, growth rate in high growth period 4%. What they say, first 4 years EPS. See, what is the high growth period? 4 years. So, first 4 years, see, here is year 1, 2, okay, suppose infinity. Here, first 4 years, 1, 2, 3, 4. This is suppose year 0. Okay, first 4 years, the EPS will grow at 4%. EPS will grow at 4%. Find out the EPS at the end of the 4th year, which means, what is the current EPS? 10.16. This is EPS 0. EPS 0 to this year's EPS into 1.04 first year EPS into 1.04 second year EPS into 1.04. Like this you will find 1.04 raised to the power 4. If you multiply, you will get 11.88. This is nothing but EPS at the end of year 4. EPS at the end of year 4. Next, P4 you need to compute. P4 you need to compute. Now, for computing P4 only, I computed EPS 4. Why I'll tell you. P4 is nothing but D5 by KE minus G. Agreed? You want D5 na? First you need to, D5 is what? D5 is nothing but EPS. See, EPS 5 into payout ratio for 5th year. Payout ratio for 5th year. Are you all understanding? This is how you compute D5. Now, The E5 is there. Will it be same as that is EPS 5? Can you just apply 4%? No, because first 4 years EPS is growing at 4%. The balance period growth rate is stabilizes at 3%. Are you all understanding? From 5th year forever, from 5th year to infinity, it grows at 3% forever, which means EPS 5 is equal to EPS 4 into 1 plus G, correct? The G is not 4%, only 3%, up 1.03. Are you all understanding? So EPS 5 na 11.88 is EPS 4, 11.88 EPS 4 into 1.03. How much you are getting? 12.23. This is 12.2364. I am getting as EPS 5. Agreed? Now, 5th year end payout ratio, what they say? Okay, first payout ratio during high growth period will be 52%. Balance, okay, the payout ratio in the stable period will be 60%. Up 5th year, to get D5, I need to multiply 60%, 52%, 60% to 12.23. 12.23 into 60%. If I compute, I get 7.34 as the dividend. Are you all understanding? 7.34 as D5. This is nothing but D5. I got D5, yeah. Now I will use this D5. Okay, divided by KE minus G, I'll find out P4. D5 is 7.34 divided by KE minus G. Here also G, if you notice, the 3% G is growth rate prevailing at the end of the what do you say, stable period from 5th year, which is 3%. I'll get the share price at 81.55. Are you all understanding? Okay, this is how we will compute here. So P4 we have. So we have D1, D2, D3, D4 and P4. Everything we will discount and bring it to present value terms. Shall I summarize? Very simple. In this question, you need to find out, you will find out the value using dividend discount model. This is two-stage dividend discount model. Yes, with varying payout ratio. Two-stage dividend model. Can you apply directly today D1 by K minus G? No. The growth rate is not constant forever from now, which means first 4 years it is growing at 4%. From 4% onwards, the balance years it is growing at 3%. You cannot directly apply first. Agreed? Now, also, the stable phase growth rate is stabilizing at 60%. First 4 years, the what is that? The payout ratio is not stable throughout these years. The first 4 years, payout ratio is 52. Thereafter, I increase my payout ratio, which means manually you should find out D1, D2, D3, D4. Thereafter, P4 you need to find. For that, P4 is equal to D5 by KE minus G. Agreed? This is what you require. Now, D1, D2, D3, D4. How to find out? Very simple. EPS 1, EPS 2, EPS 3, EPS 4. Respective EPS you have into 52% payout ratio, you will get D1. That is EPS 1 into 52% payout ratio for the first year, you will get D1. EPS 2 into payout ratio 2, you will get D2. Like this, D1, D2, D3, D4, you will compute. D5, okay, is nothing but EPS 5 into payout ratio at the end of 5th year. EPS 5, how to find out? EPS 5 is EPS 4 into 1 plus G. Growth rate you should apply based on EPS 4. So how much is that? EPS 4 11.88 into 1 plus G 1.03. I apply and find it out 12.2364 as EPS 5 into 60% payout ratio. How much is that? See, 12.2364 into 60%, 7.34, I get as D5. Now I have D1, D2, D3, D4, D5, very simple. Okay, from D1 to D4, okay, respective years, present value factor 12%, you will apply and find out the present value of all these dividends, 4 dividends. Agreed? Now, P4 is nothing but D5 to D infinity. Okay, present value of D5 to D infinity. What I do? Okay, D5 is how much? D5 we found out 7.34. P4 is nothing but D5 divided by K minus G. Okay, you will get 81.55. Just now we computed 81.55. Okay, and discount using the same 4th year end, because D4 and P4 are occurring on the same time frame. You can use the same discounting rate 0.635. Okay, you will get the total present value per share as 69.44. Are you understanding? Fair value per share is 69.44. Okay, next question number 11, earnings capitalization model. Now, you see, this is given under business valuation chapter. Okay, EV by EBITDA approach. There are two things to be learned here. EV by EBITDA approach, which means this is also a relative valuation. One of the relative valuation, PE approach, price to earnings. Price to earnings. This is also, okay, EV to EBITDA means how many times you can pay as an enterprise based on EBITDA. This is called as EBITDA multiple. This is called as EBITDA multiple, which means, so for example, your EBITDA, okay, comes to 80 lakhs, which means based on this 5 times the EBITDA you can pay as the enterprise value for the company. 80 into 5, okay, 400 lakhs I can pay as price for the company. Are you all understanding? This is EV by EBITDA approach. Enterprise value by using EBITDA multiple. We call it as multiple. PE multiple also, relative valuation. Okay, price to sales ratio, price to book ratio. Okay, price to earnings ratio is PE ratio. Here, okay, EV by EBITDA ratio. Very simple. The closing price of that is there, and earnings. This is EV by EBITDA multiple. This is one way of either. Then there is approach called as earnings capitalization approach. Earnings capitalization approach. In the earnings, okay, we will see, we will compute the operating profit. Now, there we compute something called as maintainable profit, which means suppose in the operating profit we have okay. It was found that the amount of 24 lakhs as income and an extraordinary loss of 9 lakhs were expected to continue in the future. Further, the company has launched a new product during the year with the following expectations. Sales given as 150, material cost, labor cost, fixed cost. Then they have given the company as 5 lakh equity shares of 10 each and 1 lakh 9% preference shares of 100 each. The price to earnings ratio is 6 times. Okay, already they've told that post-tax cost of capital is 10% per annum, tax rate is 34%. You are required to determine existing profit from old operations. So you are required to determine existing profit from operations, then the value of the business. This is what they have asked. Okay, see. Now, first step is price to earnings ratio. You need to find out EPS. For that, they've given PE ratio given in the question as 6 times, and the market price is given, current market price is given as 24. We know that MPS is equal to EPS into PE ratio. Therefore, EPS is equal to MPS divided by PE ratio. This is what the first step. They have calculated PE ratio, given PE ratio and market price divided by PE ratio. You will get 4 as EPS. Are you all understanding? Next, number of shares outstanding 5 lakh. So EPS into number of shares outstanding will give you profit after preference dividend, which means earnings okay, which is available for equity holders. Earnings available for equity holders is 20 lakhs. From there, you add back preference dividend. You would have reduced the preference dividend from the PAT. Okay, and you would have arrived at earning after tax. We need to go back. Okay, why? Because value of the company, we need to go back till EBAT. Okay, profit from operations. Correct? So what you will do? You add back the preference dividend, 9 lakhs. So total 29 lakhs profit after tax. This is nothing but profit after tax. Now, after going to after reaching profit after tax, what you should do? You should go before tax. Correct? EBAT na. So what you should do? Add back the tax. Add back the tax to get the PBT. Add back the tax. How much is the tax amount? 34%, which means any after tax number to take it to pre-tax, what you should do? Divide it by 1 minus t. I told you na, a pre-tax number is given. Okay, you want to take it to post-tax into 1 minus t. If post-tax number is given, you want to go back to EBIT or pre-tax number, what you should do? Divide it by 1 minus t. Upon 29 lakhs divided by 1 minus 0.34, 34% will give you 43,93,939. Okay, this is the EBIT. Assume this is the EBIT. Here, EBIT, okay, from the original EBIT, I need to do some adjustment. What they have given? The extraordinary income and extraordinary loss, here they have given us 9 lakhs extraordinary income is credited and extraordinary loss, okay, extraordinary income 24 lakhs they would have credited in the P&L and extraordinary loss of 9 lakhs would have been debited, which means these are all extraordinary. We will not consider it for computing future maintainable profit. They're not considered in calculating future maintainable profit, which means what you should do? Extraordinary income, I will, okay, what you should, I have wrongly added in the P&L, I wrongly credited in the P&L, I need to debit it back, reduce it, less extraordinary income, 24 lakhs, I will reduce. Then extraordinary losses I would have debited, wrongly debited, I add extraordinary losses to the extent of 9 lakhs, total comes to 28 lakhs 93,933. This is the profit from existing operations. Are you all understanding? Old operations currently without undertaking the new product. Now, new product profit, this is the existing profit. New product profit also I need to consider now. What is the new product profit? Sales 150 lakhs. Okay, alignment issue. Don't worry, the sales would have been here 150 lakhs. Okay. Then you have material cost, less material cost 40, 34 and 24. Okay, this 98 should go here. Total comes to 98. The total comes to 98. Okay, 150 minus 98, that is 52 lakhs. 52 lakhs. This 52 lakhs I have written here. Are you all understanding? Okay, so 52 lakhs is the profit from the new product. Existing product profit is 28 lakh 93,000. Total it will get 80 lakhs 93,939. Now, this is what I call it as EBAT. EBAT means here also EBAT not taken, okay, EBAT after doing some adjustment for valuation. EBAT originally taken from account, na, they here I have wrongly, okay, debited and credited this extraordinary income and losses. I will adjust it. Thereafter, I'll get the EBAT. Now, in the revised EBAT, I will, okay, deduct the tax 1 minus T. No PAT, I will compute. This EBAT into 1 minus T is called as no PAT. Net operating profit after tax. Okay, why we are computing? Very simple. Okay, this is, the government, for the government, you need to pay tax irrespective of what is there. So, here, EBAT, I definitely need to reduce the taxation. This is what I get. Okay, less taxation, 34% I reduce. I'll get future maintainable after tax profit. Future maintainable after tax profit to the extent of 53 lakhs 42,000. Okay, this I will discount using KO. Are you all understanding? Numerator, if you take EBAT, you should discount using KO or WAC, weighted average cost of capital, assuming the EBAT is constant earnings model, something similar to constant earnings model, where will you assume that the maintainable profit will, okay, continue in the foreseeable future. So 5,34,20, okay, divided by 10, 53 lakh 42,000 divided by 10%, 5.34 crores or 534 lakhs 20,000. Are you all understanding? Next, relative valuation method, question number 12. There is privately held company X Private Limited, okay, that is operating into the retail space and now scouting for angel investors. The detail pertinent to valuing X Private Limited are as follows. The company has achieved a break even this year and has an EBITDA of 90. The company, okay. Yes, okay. The unleveraged beta, unlevered beta unlevered. Okay, there is a concept in portfolio management, levered and unlevered beta. Anyway, I'll briefly discuss here. There also I will try to cover one. I think the concept will be discussed in portfolio management. Application in these kind of questions, merger and acquisition. One question we have in merger and acquisition, and business valuation. One question we have. This question can also be put under. No, there is one more question which is in mergers and acquisition, which has the beta unlevered and levered beta. Now, anyway, so this is beta unlevered based on the industry. This is also called as asset beta. Asset beta. Beta unlevered is called as asset beta. Now, based on the industry in which it operates is 1.8. So the asset beta is equal to 1.8. Next, and the average debt to equity ratio is hovering around 40 is to 60, 40 is to 60 or debt by equity. Now, the rate of return provided by liquid bonds is 5%. What is this? Risk-free asset, risk-free rate, RF is given. The EV is to be taken at a multiple of 5 on EBITDA. Enterprise value is nothing but, okay, relative valuation method. EV they have given as multiple of 5, which means EBITDA multiple of 5. EBITDA into 5. This is the P multiple, just like P ratio, relative ratio. Okay, they have given the EBITDA multiple. The accountant has informed that the EBITDA of 90 includes the extraordinary gain of 10 for the year and a potential write-off of preliminary sales promotion expenses, which means 90 originally their reported number. In this number includes an extraordinary gain I have wrongly credited. What I should do? Remove it. How much is that? 10 rupees. Then, apart from that, you have potential write-off of preliminary sales promotion expenses. I did not write off. Upper wrongly not debited. What I do? I will debit again 20. How much is that? 90 minus 10 minus 20. 60 is the actual EBITDA, the correct EBITDA to be computed for valuation purpose. Okay. Now, anyway, that is there. Keep in mind what they're asking. The internal assessment of rate of market return for the industry is 11%. This is nothing but RM. Rate of return of the market is 11%. The free cash flows for the next 3 years are as follows. Okay, the future cash flows. Okay, the future cash flows given year 1, year 2, year 3. These are all cash flows, future cash flows given. Pre-tax cost of debt is given as 12%. Assume a tax regime of 30%. What is the potential value to be placed for ex-private limited? See, very simple. In this question, there is ambiguity. I will tell you what are the issue here. See, what they have done. Okay, value of the firm is present value of future cash flows. Like this, they have discounted 3 years cash flow given. This 3 years cash flow, you will discount at the appropriate discounting rate, which means first, you will find out they have given data for asset beta. From asset beta, you will compute equity beta. Data. After computing equity beta, this equity beta you will use to find out KE. KE is equal to beta RF plus beta into RM minus RF. Agreed? This you will find out KE. Thereafter, using that KE, you have KD, KE, but we need find WACC. WACC means KO, weighted average cost of capital. That we will use to discount the cash flows. Are you understanding what I'm trying to say? And find out the value. There are 2 issues here. The value, if you see, there are only 3 years cash flow. It will never happen. Normally, if you see, there is no terminal value details given. There is no terminal value given. But correct. Okay, this is not a correct way of what do you say, finding the value. Okay, if you see, most of the companies will have the majority value will derived from the terminal value and not from the first few years cash flow. Are you understanding? Anyway, this is not given, so I will not discuss about that. That is not given. Okay, in this question, you just need to discount these cash flows. 3 years cash flow, bring it to present value term. That is the value of the firm. Discount using KO, WACC. For that, you need KD, KE. KE, you will use, CAPM, RF plus beta into RM minus RF. For that, you will require the beta, that is equity beta, levered beta, you need to find out. So, first step in convert the unlevered beta into levered beta. Okay, very simple. Levered beta, unlevered beta. Here I will briefly explain. See what happened. There is an unlevered company. There is a unlevered company. There is a levered company. Levered company, and the company in which it has, the company in which there is a debt in the capital structure of the company is called as levered beta. The company in which there is no debt involved, okay, this is an all equity company. We call it as unlevered company. Now, In this unlevered company, there are two things here. One is asset beta. One is asset beta, overall risk of the company. Overall risk of the company. Okay, here we have asset beta. Next, in the asset beta also you see there is debt beta, beta of debt, and there is equity beta, equity beta. If you see everywhere, debt beta will be zero. Mostly debt beta will be zero unless other specifically stated in the question. Debt beta you will assume it to be zero. Why? Debt holders will never take the risk of the project or risk of the company. Are you understanding? So debt beta will always be zero. Hence equity beta, okay, if there is, see, if there is debt we call it as financial leverage. Okay, due to debt, what happens? Okay, if asset beta is less, the equity beta of a levered company will get magnified. For example, in case of all all equity company, unlevered company, asset beta will be equal to, okay, equity beta. Asset beta will be equal to equity beta. Why? There is no debt beta involved and it is an all equity company, hence no issue. Only issue will arise when it comes to levered company. Levered company, what happens? Asset beta, okay, is overall risk, but the problem is debt holders will never share the risk. Therefore, equity holders risk gets magnified because of the financial leverage. Are you all understanding? The equity beta of the levered company I call it as, okay, equity beta of the levered company I call it as levered beta. Are you all understanding? Okay, now unlevered company, anyway, asset beta and, okay, beta unlevered, the beta, equity beta of the unlevered company is called as unlevered beta. There also, okay, the unlevered beta will be equal to asset beta. Why? Because it's an all equity company. Are you all understanding? This is the basic understanding here. Now, the formula for it, beta unlevered given. How to find out beta levered? Beta, see, beta levered is equal to, one second, beta levered from unlevered. Now, how to find out? Beta levered is equal to beta unlevered, okay, into there 1 plus debt by equity. Here, when tax is given, debt into 1 minus t. Are you all understanding? This is how it, beta unlevered into 1 plus debt by equity into debt into 1 minus t divided by equity. This is how you will find out beta levered. Okay, in this question they have given beta unlevered. Asset beta is given as how much? 1.8. So okay, 1.8 into, here they have done 1.8, you need to convert into levered beta na, 1.8 into 1 plus 1 minus 0.3, this they have done because tax is there, into, okay, 40 by 60, you will get 2.64. Okay, very simple. What they have done, this is, see, this you should not misunderstand this. What happens here? 1.8, okay, in 1 plus, okay, 1 plus debt by equity, debt into 1 minus t, debt into 1 minus t now, 40 into 1 minus t, 0.7 divided by, what is that? Equity, 60. Are you all understanding? Now, 40 into 0.7 divided by 60. How much is that? 0.46. Up 1.46. 1.46 I'll get from here into 1.8. Up 1.8 into 1.8, 1.4, I'll get 2.62. Okay, 64, 64, rounding off issue. Okay, 0.628, no issue. That is rounding off. More or less, it should be same. 2.63 I'm getting. It is 64, no issue. Now, you tell me, children. Now I have beta levered, na? Yes, this is beta levered. Now, okay, come this step you forget about it. Come to the CAPM. Okay, Ke is equal to RF plus beta into RF is equal to RF plus beta into equity beta 2.64 into RM minus RF. You computed Ke as 20.8. Are you all understanding? This is how you compute Ke. Thereafter, you need to compute VAC. Na, VAC computation, very simple. Source, proportion, cost, weighted cost. This we learn in intermediate itself. Source means you have debt and equity. Proportion, what? Debt proportion, okay, this is 60, okay, equity proportion 60, but debt 40 by 100, equity is 60 by 100. Are you all understanding? Question, like, you need to be very careful. Debt ratio means debt divided by total assets, or debt equity ratio means debt by equity. Here debt equity ratio is 40 is to 60, but ratio means 40 divided by 100, 60 divided by 100, which means 40 debt, remaining 60 is equity. So cost is how much? Okay, here equity cost we have found, debt cost we have, see, debt they have given post-tax. For WACC computation, you need to take post-tax, pre-tax, yes, debt they have given pre-tax, you need to convert it to post-tax. What is the tax rate? 30%. So 12 into 0.7, 8.4. This is okay. Post-tax cost of debt. Then we have equity. How much is the KE? 20.84. Are you all understanding? Now, if you multiply, okay, 40% into 8.4. 8.4 into 40%, 3.36 plus 20.84 into 60 percentage or 0.6, 12.504. Okay, the total comes to that 15.864. This is the WACC. 15.864. Now, this future maintainable, the future cash flows, you need to discount using KO. Discount using KO. Very simple. Future cash flows 100. Okay, here 100 given, 120 and 150. Discounting factor at 15.864. 1 divided by 1.15864. If you do, you will get first year 0.863, second year 0.745 and 0.643. Okay, present value of future cash flows. This is given for every year. Total of the firm. These 3 years they have totaled and found out that 272.15. Are you all understanding? Here, one thing is that, okay, there should be the terminal value given, and okay, you should discount that also and bring it to present value terms. This will not reflect the fair value. Anyway, given in the question, the study mat they have given, as such, I have told you how to compute this question. If it comes now, don't worry about, think about terminal value. Whatever given, you consider, because details not given. We will assume only 3 years cash flow to be discounted. Okay. Next, we will have the question number 13. Very, very important. So, okay, similar question, levered and unlevered. Okay, valuation based question. Hence, I put it here. It can also be, see, this can also be solved under mergers and acquisition. Anyway, this is valuation related question, so I have put it in equity and business valuation. See, ABC, a large business house, is planning to sell its wholly owned subsidiary KLM. Another large business entity, XYZ, has expressed its interest in making a bid for KLM. Okay, KLM wants to sell its wholly owned subsidiary. What ABC wants to sell is wholly owned subsidiary KLM. Right. Now, XYZ has shown interest to bid for KLM, the subsidiary. XYZ expects that after acquisition, the annual earning will increase by 10%. Anyway, following information, ignoring any potential synergic benefit, there is no potential synergic benefit, assume, arising out of the possible acquisition are available. Profit after tax for KLM for the financial year just ended is estimated to be 10 crores. KLM's after-tax profit has increasing trend of 7% each year, and same is expected to continue, which means constant growing rate of 7% is expected. Are you all understanding? Is the first point. Next, estimated post-tax market return 10%. Why they have given market return? To compute K. Are you all understanding? Risk-free rate, market return, these data, beta related data, beta data given means it is for computing K. These rates are expected to continue. Anyway, corporate tax rate is 30%. Apart from that, XYZ, okay, and ABC Limited, number of shares given 100 lakhs, 80 lakhs. Okay. Proxy beta, this question is regarding proxy beta, proxy entity for KLM in the same line of business, number of shares that is not given. Current share price is 287 for XYZ and ABC 375. Dividend payout 40% and 50%. Debt equity ratio at market 1:2, 1:3. Here, okay, the proxy entity for which you are trying to, okay, take the beta, that you will take it as 1:4. The debt equity ratio of the proxy company is 1:4. Okay, PE ratio is given as 10, 13 and 12. Equity beta given as 1, 1.1 and 1.1. Very simple. See, now I will finish reading of the question, then I will come back to the solution. See, assume gearing level of KLM to be same as for ABC and debt beta of 0. Debt beta 0 given. Are you all understanding? So there is no complication. You are required to calculate appropriate cost of equity for KLM based on the data available for the proxy entity. A range of values for KLM both before and after any potential synergic benefits to XYZ acquisition. This is the question being asked. First, you need to compute cost of equity. First, cost of equity for KLM based on the data available for proxy entity, which means what they are testing now, proxy beta they are testing. Proxy beta, there is a concept called as proxy beta. I have put what do you say? I have put some 6 or 7 hours or nearly 8 hours of portfolio management revision video. There I have comprehensively covered all these topics. Okay, equity beta, debt beta, proxy beta, asset beta, everything, levered, unlevered, everything I have covered detailedly. I will briefly explain here, don't worry. Okay, that is sufficient for examination. Very simple. When a company doesn't have its own beta, it will take some other company in the similar industry. Okay, if it is operating, suppose a steel company is there, and I'm taking Tata Steel company's beta for purpose of proxy. Okay, I'm taking it for proxy. The problem is this beta I cannot as such I can take. Why? Because its own debt equity ratio will be there. This Tata Steel company's debt equity ratio will be something different than my debt equity ratio. What I do, the equity beta I'll take na levered beta. That first I unlever it. I unlever it first. First step. Then what I will do, I will use my appropriate my leverage ratio, debt equity ratio to lever it, and then okay, are you all understanding my own levered beta I will compute. Thereafter I will use this beta to compute the KE, CAPM. Okay, beta RF plus beta into RM minus RF. This I will use and compute. So very simple. Beta ungeared for proxy company. Very simple. What is the levered beta of the proxy company? See, very debt equity at the market means debt equity is there 1:4, which means prox entity for KLM is there. This entity is levered company, unlevered company, levered company debt equity ratio given 1:4. Now, levered company beta, equity beta is called as beta levered. Correct? Up a proxy entity 1.1 is there. This 1.1, can I take this 1.1 as such? No, because this is levered beta of a proxy company. So it has different debt equity ratio. It might have different debt equity ratio. First, you need to unlever it. You need to ungear it. Apo this beta levered 1.1, I will convert this beta lever into beta unlevered. Are you all understanding? In the previous question, I showed you how to compute how to calculate beta unlevered to beta levered. Here I am trying to calculate how to compute beta levered to unlevered. Levered to unlevered. Very simple. There you multiplied, na? Very simple. Beta levered is equal to beta unlevered into, okay, 1 plus debt into 1 minus t divided by equity. This we did, na? Here beta unlevered is equal to what? Very simple. Beta levered divided by this number 1 plus debt into 1 minus t divided by equity. This if you do, okay, there you do multiplication, here you do division, you will get the solution. Are you understanding? So here first step, what is the first step here? 1 second. Yes, what is the first step here? Unlever the beta. Here beta levered given, yes, unlever the beta. So how much I will get? 1.1 into 4 divided by 4 plus 1 minus t is equal to 0.9362. I will again recompute for this clarification. Beta unlevered, you convert levered into unlevered. So what is that? Okay, 4 plus, this is 1 plus debt equity. What is the debt equity ratio given? 1:4. What is the debt equity ratio given? Yes, 1:4, which means debt equity ratio is 1:4. Debt into 1 into 0.7 divided by, okay, debt by equity. What is the equity? 4. The 0.175 plus 1. 1.75. Okay, this is denominator. So here beta unlevered 1.17. Got 1.175. Yeah, what I should do? Beta levered given, beta levered given 1.1. 1.1 divided by 1.1 is that 0.936. Are you all understanding? Okay, 1.1 beta unlevered divided by 1 plus debt into 1 minus t divided by equity. This I got as 1.175. This 1.1 divided by 1.175 is equal to 0.936. Are you all understanding? I am getting 0.9362. It is a unlevered beta. Unlevered beta. Now we need to lever it using ABC's debt equity ratio, which means you have unlevered this beta, unlevered beta. How much you got? Unlevered beta 0.9362, you need to lever it using your own debt equity ratio, which ABC's debt equity ratio 1:3. This you remember, ABC's debt equity ratio is how much? 1:3. That you need to do. So which means lever it using its own debt equity ratio. Okay, so beta levered again is equal to beta unlevered into 1 plus debt into 1 minus t divided by equity. How much is that? See, 0.9362 into, okay, 1 plus 0.7 divided by 3. 1 plus 0.7 divided by 3 will give me 1.2333, okay, into 0.9362 gives me how much? 0.9362, 1.5464. That is what is given, 1.546. Are you all understanding? So this is now geared equity beta, levered equity beta. Now I will compute cost of equity. Okay, RF plus beta, this equity beta into RM minus RF, 10.93. 10.93 is cost of equity. Are you all understanding? Now, second, P valuation. Okay, so range of valuation we need to find out. P based valuation, and you have discount, driven discount model. Two models you will apply, you will find the minimum and the maximum. Minimum range, if you see, using proxy entities PE ratio. Okay, 12 is the PE ratio into 10 crore. Proxy entities PE ratio, okay, which is 12 into 10 crore. How much is that? 120 crore. Proxy entity, KLM's proxy entity is there. Here PE ratio is given as 12. This 12 you will consider and find out. Are you all understanding? Here they have given here. Can you see this? This is a proxy entity's PE ratio that you will use and find out the, okay, 12 into 10 crores, you will find out the 120 crores valuation. Then you have using XYZ's PE, that is 10 into 10 crore, you have 100 crore. Are you all understanding? Two different valuation based on PE ratio you will get. Now, next, post synergic value based on PE ratio. This is pre-synergic value, post synergic value under both the conditions. So post synergic value PE based on PE ratio is 12 into 10 crore, okay, into 1.1. Why? After synergy, okay, see here what happens. Okay, see here. After synergy acquisition, the earnings will increase by 10%. That is what they have given. Okay, the earnings increase by 10%. So 10 crore into 1.1, it will be 11 crore into 12. 11 crore into 12, 132 crores. 10 into 10 crore into 1.1, 110 crores in case of post synergy, but P ratio is different. Here it is 10. Okay, here it is 12. Are you all understanding? This is all based on P valuation. So P based valuation, you have four values: pre-synergic PE value, post-synergic value based on PE ratio. That also we have two divisions using the proxy entities PE and using XYZ's PE. Are you all understanding? Next, dividend valuation model. Okay, dividend based valuation model also based on 50% payout ratio, based on 40% payout ratio, I can find out. Why? Because if you see, okay, the company's dividend payout ratio given as 40% here, 50% here and here, which means the proxy based dividend, okay, the distribution which is happening at 50%, and the company ABC's dividend happen, the XYZ limited company having, okay, 40% as dividend payout ratio. So payout ratio is different, okay, under both the scenario. What do you do? 50% payout ratio, 40% payout ratio. Okay, if I assume, because dividend will change, na, that is why. If 50% dividend is being paid, na, so 0.5 into 10, okay, into 1.07, into 1.07, 7% is the growth rate forever. So D1, I will find out, I'll try to find out D1 divided by KE minus G. 10.93 was the KE minus G. Okay, 136.13 crore. Here also D1 by KE minus G, if I apply, I'll get 108.91 crores. Like this post synergic value, okay, here 1.1 is multiplied additionally, something great. Okay, 10% earnings has improved. So 10 into 1.1 into 0.5 dividend, okay, into 1.07 divided by KE minus G. Like this, I will apply here also. I got the, okay, 50% payout ratio value and 40% payout ratio value. Are you all understanding? So minimum and maximum range of valuation, if you see, the minimum valuation is pre-synergic valuation 100 crore. If you see that here, pre-synergic value, minimum value is using the XYZ's PE, I get is 100 crore. Correct? Now, pre-synergic maximum value 136.13 crore. Pre-synergic maximum value comes to 1. What is that? 136.13 crore pre-synergic. Then post-synergy maximum value is how much? Or minimum value is 110 crore. Maximum value is 149 crore. Are you all understanding this? Or the range of valuation given? Okay, the marginal acquisition question, but still I'm discussed here because of the valuation aspect. Now, shall we move on to the 14th question, relative valuation? See, take question number 14, relative valuation method. A Limited made a gross profit of 10 lakhs and incurred indirect expenses of 4 lakhs. The number of issued equity shares is 1 lakh. The company has a debt of 3 lakhs and surplus fund to the tune of 5 lakhs. The market detail, the surplus fund is nothing but cash and cash equivalent. Okay, I will take consider as cash and cash equivalent. The market related details are as follow. Okay, risk-free rate of return, market rate of return, beta of the company. This to compute KE they have given. Determine per share earning value of the company, equity value of the company, if applicable, EBITDA multiple is 5. Two questions are being asked. Okay, you should assume this question as independent. Okay, they are not related. So first, per share earning value of the company. Separately, we'll find out earning value of the company. Now, here, while finding the earning value of the company, they have used the EBITDA. They have used the EBITDA. Very simple. Gross profit. I'll tell you what is the one problem is there in this question. If you see the capitalization rate, they have computed using CAPM. The CAPM, okay, is to compute the cost of equity, is to compute KE actually. It cannot compute the KO. It is not WACC, but just a KE. Since there is debt in the company to the extent of 3 lakhs, I cannot say this is an all equity company where KE will be equal to KO. In all equity company, KE will be equal to KO. Okay, but in this case, there is debt involved, so KE will be greater than KO. I should not say KE is KO. Really speaking, if I use EBITDA based valuation, I should use KO as capitalization rate to discount. But in this question, okay, not appropriately discounted using KE, but it's not fair to discount using KE anyway. But they have used it, they have solved like this. Hence, I'm telling, okay, this conceptually there is some problem here. Anyway, they have used CAPM 4.5 risk-free rate of interest plus, okay, 0.09 beta into RM minus RF 11.25. So 11.25 is equity capitalization rate. This is equity capitalization rate, KE. Anyway, now calculation of the earning value per share. This is the first they have asked earning value per share. EBITDA you will find out. Okay, you will discount this EBITDA using cost of capital. Really speaking, EBITDA is a value before tax. Very simple. In the free cash flow approach, we have seen that if you are finding free cash flow to firm, the free cash flow to firm should be discounted using KO, and because the free cash flow to firm is free cash flow available to the entire capital providers, free cash flow to the firm. Okay, now if you use free cash flow to equity, FCFE, you should discount using KE. Are you all understanding this? Already I discussed. Okay, here they have computed EBITDA. EBITDA is a number which is EBIT is a number available for all the capital providers. It's a profit of the company, overall profit of the operating profit of the company, and not PAT, not profit after tax. Profit after tax which is available only for equity holders. So if I use the PAT for finding the value of the company, and PAT I should discount using KE. If I use EBIT, I should discount using KO and find out the value of the company. Are you all understanding? This is there conceptually, but here what they're done. Gross profit is there 10 lakhs minus indirect expenses they have reduced and find out the EBITDA. EBITDA is how much? 6 lakhs. The 6 lakhs they have taken EBITDA. What they have done? They have just capitalized using KE. They have capitalized using KE. Okay, constant earnings model they have applied. The EBITDA divided by KE they have used and found out the EBITDA value, total value of the company as 5,333.33. Okay, again, if you may ask why you should use KE, KE should not be used anyway. They have used. I'm also explaining. Okay, this question if asked, use KE because okay, they have not given regarding weighted average cost of capital. They have not given the other details. They have not given the other details. Maybe you can assume that they have not given other details to compute WACC. Hence, they have taken KE. But anyway, that is there. So 600 divided by 11.25 percentage constant earnings model. So 600 divided by 11.25, you'll get 533, which is 53 lakhs, 33,000. What is that? 33,000. So okay, this is how much is the amount in terms of 53.33 into that 53 lakhs 33,330. 53 lakhs 33,330 is the value. Number of shares is 1 lakh. So earning value per share is 53.33. Again, I'm saying this is earning value per share, means this is total value. See, is just like FCFF per share. FCFF per share. Okay, this is not to be regarded as equity value alone. This is earning value of the company. Are you all understanding? So this 53 divided by number of shares, total number of shares. Okay, will give you 53.33. Next, they have asked separately equity value of the company. Now we will compute equity value of the company. How to compute equity value of the company? Very simple. By using EV by EBITDA approach. EV by EBITDA approach. EBITDA you have calculated as how much? 3000. What is the EBITDA you have calculated? Very simple. What is the EBITDA given? What is the EBITDA given here? Yes, EBITDA is given as 600. So EBITDA is given as, we calculated as 600. Now this EBITDA, EBITDA, how much is that? 600. Now EV by EBITDA, how much is the enterprise value? They have asked you to find out enterprise value. How much is the enterprise value into 5? EBITDA multiple given as 5. So 600 into 5, 3000 is the EBITDA value. 3000, which means 30 lakhs will be the EV enterprise value. Are you all understanding? Okay, in 1000, if the amount is in 1000, so EBITDA is 600 into 5 EBITDA multiple. So total EV enterprise value is 3000. Enterprise value is 3000. Now listen to me, friends. In this question, they have asked you equity value, which means market cap of the company, M cap of the company. This is nothing but equity value. Very simple. There is a formula for enterprise value. Enterprise value is market value of equity, which is nothing but market capitalization. Number of shares into market price per share also. You can give market value of equity plus market value of debt minus cash and cash equivalent. That is what is known as surplus funds in this question. Okay, then there is minority stake is there. I will not consider because in no question they are asking minority stake. If minority stake is there, that also you need to adjust. Now, market value of equity plus market value of debt minus cash and cash equivalent will give you enterprise value. Will give you enterprise value. This is the value. Now, what they are saying, they have given enterprise value. You have been asked to find out the enterprise value using EV by EBITDA approach. You know that enterprise value is 3000. You know that EV is 3000. Are you all understanding? They have told that enterprise value is 5 times the EBITDA, which means 3000 is the enterprise value. Cash and cash equivalent given. Market value of debt is given as 300, which means 3 lakhs. Then market value of equity, you need to find out. That is what they have asked. Equity value of the company, market capitalization of the company. Now, what you should do, very simple. If market value of the equity given, debt given, now add it minus surplus funds. Now, EV given, now what you should do? From EV, what you should do? You should reduce the market value of debt and add the surplus cash and cash equivalents. Are you all comfortable? That's what they have done. So 3000 is the EV enterprise value minus value of the debt plus cash, surplus cash. I will get the equity value. I'll get the equity value. Now you can just reverse working. Okay, you can take the equity value 3200 plus debt value is 300, 3500 minus surplus cash 500 will give you enterprise value of 3000. Are you all comfortable? This is how they have done the EV by EBITDA approach. They have solved this question. Very, very important question. Small question, but important. Remember the KE adjustment. Okay, shall we move on to next question? Question number 15. Okay, question number 15. Compute EVA of A Limited with the following information. P&L statement given. Revenue minus direct cost minus selling and general admin expenses. Then EBIT you got. Then interest, EBT and tax expenses of 120. Are you understanding? Next, balance sheet given PPE, current assets, equity, reserves and surplus, non-current borrowings, current liabilities and provisions to the 400. Okay, total 1300. Assume bad debts provision of 20 lakhs is included in the SGA and the same amount is reduced from the trade receivables and current assets. Also assume that, also assume that the pre-tax cost of debt is 12%. Pre-tax cost of debt is 12%. Tax rate is 30% and cost of equity is 8.45%. Also calculate MVA if current market value of the firm is 1 lakh. There's a question regarding EVA. What do you mean by EVA? The economic value added. What is the formula? Okay. The regular batch I used to discuss two option, which means required return, equity holders required return, actual return minus required return. This is one way of understanding EVA. Or on a total basis, if you see, this is nothing but EVA is equal to, I call it as no PAT. Okay, cash, no PAT, EB80 into 1 minus T. Okay, add back the non-cash expense, no PAT, minus capital charge, This capital charge is nothing but, okay, invested capital into WACC, invested capital into weighted average cost of capital. Okay, this is the total capital invested into cost of capital. Okay, this you reduce from the no PAT. Net operating profit after tax. How to compute it? Very simple. This no PAT can be computed in two ways. If you have given PAT now, flat plus add back the interest, flat plus interest into 1 minus T. Okay, plus non-cash, if any, non-cash item, if any, included in the P&L. Are you all understanding? Here also, you have EB80 into 1 minus T plus add back non-cash expenses if you have debited. Very simple. This is the no PAT. Agreed? Now, they have computed no PAT. EB80 given 410 lakhs. Less taxes. Taxes at 30%. Okay, taxes paid should be computed. What is debited in the P&L is irrelevant. What is how much you have? Okay, you have to reduce 123. 410 into 30%. Add back non-cash expenses to the extent of 20. Why? Because in the SGA, the P&L account, in the 200 contains the 20 rupees. They have told this 200 will have, okay, what is that? Yes, 20 lakhs bad debts provision is included in SGA, non-cash item. Add back to the, okay, no PAT, you will get the cash no PAT of 307. Okay, now finding out the invested capital. Here you have arrived at the no PAT, which is 307 minus invested capital into WACC. So two things you need to find out. Okay, what is that? Invested capital. Now total capital is how much? Invested capital. You can, okay, ascertain this in two way. Very simple. You can either take equity, reserves and surplus, and non-current borrowing. How much is 700 plus 100 plus 100 is the total capital invested. This approach, okay, includes the debt capital also, which means 700, 100 plus 100, 900 is the total. Are you all understanding? Okay, another way of computing the same 900 is that 1300 total of assets minus current liability of 400, non-interest bearing liability. This is also a method to arrive at the 900. Are you all understanding? All forms of long-term capital is what I call it as invested capital. I include equity, I include reserves and surplus, I include non-current borrowing. Okay, long-term debt if it is there, now that also I will include. Okay, this I will include and get it as 900. This is what they have done. Okay, they have done, see, total assets, they have calculated from asset side. You can also compute from liability side. So our total assets 1300 minus 400, which is short-term liability, you'll get the 900. Now, one more thing is that non-cash adjustment. When see, in the no PAT, you have adjusted non-cash item. So therefore, corresponding adjustment, you have to do invested capital also. This provision for bad debts, what happened? This provision for bad debts in a P&L, it is included. Same way debited. Same way it is also, okay, reduce the, what is that? Debtors. What they have done? Receivables, it is reduced from the, see here, what they have done. Yes, trade receivables in current assets. It is reduced from the trade receivables or the current assets, which means current assets really, okay, the correct value of current asset should be more or less very simple. Yeah, current value. Okay, see here, 900 is there. Okay, without adjusting this 20, 20 if you add back, you will get 920. This is the correct way, because non-cash adjustment, there you did the provision. Here also you will add back. So 900 plus 20, you will get 920 as the total invested capital. 920 as total invested capital. Now, what is the WACC? Next step, this is invested capital. WACC computation we need to do. This you already know, source, proportion, okay, cost, weighted cost. Now tell me children, here source what? Debt and equity. Okay, proportion what? 800 by 900. They have told, see, if you see, what is the total capital? 900. Total capital is 900, out of which equity is 800. Equity means equity share capital plus reserves and surplus. Cumulatively it is called as equity. So 800 is the equity, 900 is the total capital. So what is the weight of equity here? Okay, weight of equity is 800 by 900. Debt is 100 by 900. So 100 by 900, 800 by 900. This is the weightage. What is the cost? Okay, cost of debt, post-tax cost of debt. How much is given? See, yes. Pre-tax cost of debt is given 12%. For WACC computation, you need to take post-tax or pre-tax post-tax, which means 30% tax rate up at 12 into 0.7. How much is that? 8.4. So 8.4 you should consider. And then there is 8.5% of equity capital, which means 8.4 post-tax cost of debt 8.4%. Here 8.5%. If you find out the weighted average cost of capital, you will get the 8.44%. Are you all understanding WACC computation? Next, find out the capital charge. This is very simple. Invested capital into WACC. This is what we have to reduce from the NOPAT. So 920 lakhs into 8.44, you get 77.65 lakhs. This you will reduce from the NOPAT. What is the NOPAT amount? Okay, 307 lakhs minus 77.65 will give you EVA. EVA is equal to NOPAT minus capital charge or nothing but, okay, invested capital into WACC. This is the formula, 229.35. Are you all comfortable? Now, next is market value added. Market value added, there are two ways to compute. See, based on book value or based on market value. Very simple, I'll tell you what happens. Market capitalization. In this question, they have given that current market value of the firm, total market value of the firm is how much? 1,000. Correct? Now, you reduce the market value of, this is the market value of the firm, total market value of the firm. You reduce the market value of equity. How much it is? Very simple. Okay. See, in this case, yes, current market value of the firm is 1,000 lakhs. Okay. Now, you need to understand that this can be solved using two methods. Either I can take total approach or I can take just the equity approach, which means here what they have done, I'll tell you. 1,000 lakhs they have taken market value. 1,000 lakhs they have taken as market value. Well and fine. Now this 1,000 lakhs market value of the firm they have taken. You reduce the total book value. How much is the total book value? Okay, 920 lakhs. Just now you computed total book value. Are you all understanding? This is a total. I will tell you what. MVA, market value added, can be computed in two methods. One is total approach. Total approach or equity approach. Equity approach. Very simple. In the total approach, what you do? Total value of the firm. Total market value of firm. Like in this question, they have done using total approach. Total market value of the firm minus total market value of the firm given. Minus what you do? Okay. The book value of, what is that? Capital. Total capital. Book value of total capital, which means book value of equity plus book value of debt. Equity, book value of equity plus debt. This just now we computed as 929 invested capital. This you reduce from the market value 1,000. This you get it as 80 lakhs. Are you all understanding? This is one way. Second approach, in this question not given. Some other question they have given this approach also. That also I will discuss. In the equity approach they have taken, what they have done is that, okay, MPS into number of shares will give you market capitalization. Remember, MPS into total number of shares will give you MCAP, market capitalization. This I also called as market value of equity. Market value of equity. Okay, market value added, you need to find out now. MCAP minus book value of equity. Book value of equity alone. Book value of equity. Market value of equity alone minus book value of equity. This is one way of understanding market value added. No, total approach I'll use now. Total market value of the firm. In this question, they have taken total market value of the firm given. So you take this approach, total approach, minus book value of the total, okay, invested capital, which means value of debt plus book value of equity. Okay, together 920 lakhs. After all adjustments you will do, you will get the value. Are you all understanding? Shall I proceed to the next question? Next question is regarding FCFF, free cash flow to firm, and free cash flow to equity approach. The question is regarding free cash flow to equity. Also can be solved using free cash flow to firm. Anyway, this question, okay, was asked MTP November 24 for the first time. Okay, very good quality question. I think it may any time it may get repeated. Okay, this was asked in mock test paper, never in real paper, exam paper. So calculate the value of one equity share of X Limited from the following information: profit of the company before tax, profit given, profit before tax, PBT. Next, equity share capital of the company given as 19,000 crore, number of equity shares given as 380 crores, long run growth rate of the company 7%, risk-free rate of return given, beta, market premium, all this given to compute K. Okay, using CAPM, market risk premium is given, total capital expenditure is given, capex is given, chargeable depreciation is given, total increase in the working capital also given. New debt to be issued for funding is 2062.108. Are you all understanding? Next. Okay, tax rate is 30%. All the calculations to be rounded off using 4 decimal points and final value of the equity share to be rounded off to 2 decimal points. Find out the value per share. This is the question is being asked. See, very simple. First step. You have PAT, you have, okay, PBT, PBT. This is profit before tax now. Tax rate 30%, convert it to post tax. So 8,000 into 1 minus 0.3, you will get PAT, profit after tax of 5,600 crore. You have PAT, profit after tax. Now, free cash flow to income formula, free cash flow to equity formula, free cash flow to equity formula. I told you when you want to convert, when you want to calculate free cash flow to equity, okay, from PAT is given. You want to compute free cash flow to equity. What you should do? Okay, very simple. You should add back interest. You should not add back interest. This is free cash flow to firm up, free cash flow to equity, free cash flow to firm up, free cash flow to equity. So I'll take profit. PAT is the profit belongs to equity holders. You will add back interest or you will not add back. Are you understanding? You will not add back interest into 1 minus T. So what I should do? Okay, I will reduce the change in capex, change in capital expenditure. Okay, change in capital expenditure. Now, minus change in working capital, minus change in working capital. I will add back depreciation. I will add back depreciation plus net borrowing. Plus net borrowing. This is important adjustment. Plus net borrowing means, okay, what you should do? You should add if new debt is issued. If you have borrowed, it will be inflow to you. Okay, you will add back the borrowing. If you have borrowed this year, you will add back the borrowing. If you have repaid this year, you will reduce the repayment amount. Are you all understanding? So, effectively, I will add back if it is borrowing. I will reduce if it is net repayment. So, plus or minus net borrowing or repayment. Are you all understanding? So, net borrowing, if I put plus net borrowing means, assume, okay, if it is net repayment, it will be minus plus or minus net borrowing or repayment. This is what you will, this is how you will compute free cash flow to equity from PAT. Now, you tell me, children, here the debt, this is debt given. In this mock test, they have given this formula wherein preference shares they have considered on par with net borrowing. Because sometimes in the next examination, they might even ask you the preference share capital adjustment, but you should not get confused. It is nothing but it should be treated on par with what is that? Net borrowing. So, institute taken a stand that if it is preference share capital given on issue of new preference shares, you will add. Okay, and redemption of preference shares, you will reduce. This is what is the treatment. Are you all understanding? So, free cash flow to equity here. I have PAT of 5,600 crores. Yes. Minus, okay, capex 20,140 plus depreciation 17,100. Here is given, I think, yes, 20,140. I will reduce plus, okay, depreciation, add back non-cash expenses, add back. Then minus change in working capital 1755.6. I will reduce. Okay, plus net borrowing here 2062.108. I have repaid borrowings this year. I have issued borrowing, new debt to be issued for funding, which means issuance of new debt means I have raised the debt. Okay, this is inflow 2062.108. This I will add. This I will add net borrowings. Okay, I'll get the free cash flow to equity as 2,866.508 crore. Are you all comfortable? So tell me, children, FCFE, how to compute FCFE? Okay, PAT given. You have profit after tax. From PAT, how to compute FCFE? If from PAT, you should reduce capex. Okay, minus change in capital expenditure. Minus change. This is also called as change in fixed assets. Change in capital assets. Okay, change in capital expenditure minus change in working capital plus add back depreciation, non-cash item plus add back depreciation plus or minus borrowings or repayment. If it is net borrowing, you will add the borrowing. If it is net repayment, you will reduce the repayment amount. Are you all comfortable? So this is the free cash flow to equity. Now, you need, this is free cash flow to equity today. Free cash flow to equity 0. Free cash flow to equity today 0. Today's free cash flow to equity. Now, why this is relevant, I will tell you. Now, next is cost of equity. You need to find out RF plus beta into RM minus RF. Okay, this you already know, 9.5% plus 0.1 beta into RM minus RF, market risk premium given, not market return, directly given RM minus RF, which is 3.1. Okay, you get it as the KES 9.81%. Now, what they say, value of equity, directly value of equity means what? Okay, nothing but FCFE1 divided by AE minus G. This is one way of finding value of equity. Are you all understanding? See, very simple. Okay, you see what happens. This is FCFE1 divided by KE minus G. Earlier, the free cash flow to firm approach, what we did, value of the firm is equal to FCFF1, just like your D1 by KE minus G, FCFF1 divided by KO, WAC minus G. Okay, when you discount this free cash flow firm, you should discount using overall cost of the capital of the firm, KO minus G. Okay, when you this you do, okay, you will get the value of the firm. This is total value of the firm. From here, if you reduce the value of debt, market value of debt, you will get value of equity. From there, if you divide it by number of shares, you will get value per share. Are you all understanding? This is FCFF approach. In FCFE approach, what you should do? FCFE1 divided by KE minus G. If you do, you will get value of equity divided by number of shares. You will get the value per share. This is one approach. Other approach is, instead of total FCFE itself I will take in per share basis, which means numerator. Okay, I'll divide it on per share basis. Are you all understanding? Say very simple. First approach we will consider now. Value of equity is equal to FCFE 1 plus G divided by KE minus G. The same number, just to substitute 22,000, which is 2,22,866.508 crore into 1.07. I think this is a mistake here. 16 is additional there. 22,000. What is that? FCFE. Okay, total value of the equity. This is 2866. What is that? 2866. So this is the, okay, this is mistake. I think this is mistake. Okay, see, this should be taken. This value should be taken. 2866.508 into 1.07. This number is correct. Okay, this number is correct. This is typographical error. So 2866.508 into growth rate 1.07. Okay, this is nothing but FCFE 0 into 1 plus G will give you FCFE 1 divided by KE minus G. KE you just now find out 9.81, 0.0981 minus G 7%. If you apply, okay, you will get the value of equity as how much? 10, what is that? 109 lakhs, okay, 151.72 crores. This, if you divide it by number of shares, 380 crore, you will get the value per share as 287 point, okay, 287.24. Sorry, 287.24. Are you all understanding? Comfortable? Next step. Alternatively, it can also be calculated using per share basis. Okay, very simple. FCFE per share is equal to FCFE divided by number of equity shares. Total FCFE you have computed now, directly divided by number of share you do, you will get FCFE per share. Now, if you have FCFE per share, you apply the growth rate here, okay, divided by KE minus G, you will get the same value. Okay, either you can find out in total basis divided by total number of shares first you can do, or convert the FCFE per share, okay, then you can find out value per equity share. You all comfortable? Shall I move on? Okay, this is all about the FCFE approach. Next, very important area, rights issue. See, for this attempt, rights issue and buyback is very, very important. Long due, I believe. They might, even buyback was tested recently. I believe the September attempt, or not September, I think in May or January 25. Okay, I don't remember, but they have asked it recently, 2 attempts back, they have asked it, but still, buyback is also important. I will discuss the rights, then buyback. Okay, then we will move on to other areas. Okay, we have one more question regarding equity. So three question is pending: rights issue, buyback of the shares, and then one more area. Okay, it's just a computational mechanism. Okay, it can also be asked in mergers and acquisition. It can also be discussed in mergers and acquisition, but I have put it in equity. So three questions is pending in the equity and business valuation chapter. Okay, with this we will be through with the equity. Now, take the rights issue. Jaspal Limited had issued 30 lakhs ordinary shares of rupee 1 each that are at present selling at 4 per share. A company plans to issue rights to purchase one new equity share at a price of rupees 3.2 per share for every 3 shares held. So, okay, for one, what is that? Yes, 3.2 per share for every 3 shares held, which means for every 3 shares, 1 shares is being issued as right share. A shareholder who owns 900 shares thinks that he will suffer a loss in his personal wealth because new shares are being offered at a price lower than market value on the assumption that the actual market value of the shares will be equal to X rights price. What could be the effect on the shareholder's wealth if he sells all the rights, he exercises half of the rights and sells other half, he does nothing at all? This is the typical rights question. Only one type of question is being asked. Okay, what will be the impact on the shareholder's wealth? Okay, if the company comes up with a rights issue, this is the question. See, now one by one we will solve. I'll tell you what happens in the rights issue. Rights issue, new shares will be issued. Right shares will be issued for the first, as per the company law, existing shareholders should be given the right priority. Right. So what happened now? This company offers one share for every 3 shares held in the company. Correct? Now, before the rights issue, what was the share price? Share price was 4 rupees. This you need to remember. Okay, I will interchangeably discuss this. So before the rights issue, share price was how much? 4 rupees. Now, the share price is market price. Current market price is 4 rupees. When they come up with the rights issue, they will be coming up with to keep the rights competitive, they will come up with a lower price. Say 3.2. In this question, 3.2. This is the rights price. This is rights price, subscription price. Are you understanding? So 4 rupees is the market price before the rights issue. And 3.2 is the subscription price. Since you are issuing the shares for a discounted price, which means 4 is the price, you are issuing it for 3.2. Are you all understanding? Discount price? Hence, the value will get diluted. This is what is the thinking. Shall I proceed? Now, first step, is to compute theoretical X rights price. First step is to compute theoretical X rights price. First we will calculate. Thereafter, I will do the numbers. I will explain. See what happens. First step is to compute theoretical X rights price. Nothing new in the EPS standard and all. Okay, accounts you would have studied. See, what is this X? Theoretical X rights price. I denote it as X. It's nothing but market price per share into existing shares. Very simple. Here, M is what? MP is before rights issue, and N is what? Number of shares qualifying for one right, which means see, this can be calculated on a total basis or per right basis. So very simple. See, what is the market price per share? Currently 4 rupees into how many shares were there, for which you are issuing right. For every 3 shares only rights are issued. Up existing shares is how much? 3 share. Are you all understanding? Plus this is 4 into 3. Existing number of shares into market price per share plus rights. Number of rights is given, which means for every 3, how many rights is given? 1 right shares is given. Correct? Into, you tell me, what is the yes, at what price the rights is given? Right subscription price, which is 3.2. Yes, in this case 3.2 divided by, this is the total value per share, divided by new shares, existing shares plus right shares, which means existing shares 3 plus right shares 1. Are you all understanding? So 12 plus 3.2, 15.2 divided by 4. 15.2 divided by 4. First theoretical X rights price comes to how much? Second, some issue. Not loading. Yes. See, theoretical X rights price Yes, 4 into 3 plus 1 into 3.2 divided by 3.1, 3.8 per share. Are you all having the clarity? Okay, this on a total basis also you can compute. Okay, total shares outstanding in the company. That way also you can compute. Are you all understanding this question? Okay, yes, 30 lakhs ordinary shares is there, which means this also can be computed on a total basis. 30 lakhs into 4. Okay, 30 lakhs, how many new shares will be there? 30 lakhs, 1 is to 3, na? What is the, for every 3 shares, 1 shares is being issued, na? 10 lakh shares will be there into how much? 3.2. This is a subscription price. Divided by 30 lakhs existing shares plus 10 lakhs, so 40 lakhs. Okay, this if you do, it will give you same 3.8 per share. Are you all understanding? This is a theoretical ex-rights price, which means ex-rights price means right after the rights issue, what should have been the fair rights price? What should have been the fair share price? How much is that? How much is that? 3.8, which means very simple. Today market price is 4 rupees. If I come up with the rights issue at a lower price of 3.2, I am coming up with the lower price of 3.2. Hence, okay, my value gets diluted to the extent of 3.8. Are you understanding now? Next is finding value of right. Value of right. Very simple. This can be found out in 2 ways. Very simple. I'll tell you what happens. There are 2 parties there, right? One existing shareholder, then there is new shareholder or the subscriber. Listening, yeah? Now, new shareholders are coming. Assume sales is right. New shareholders coming. Existing shareholder, okay, theoretical ex-rights price is how much? 3.8, which means after the rights issue, okay, the value became 3.8. The value became 3.8. Okay, value became 3.8. Now, what is the subscription price? A share worth 3.8. After rights issue, the share became how much? The shares worth is 3.8. But this 3.8, the existing shareholder, the new shareholder is okay getting the opportunity to buy it for 3.2. Are you understanding? A 3.8 worth share he is able to buy at 3.2, which means he is enjoying 0.6 per share. This is value of right. The benefit derived by the new subscriber to the right. Are you understanding? This is the value of right. This is one way from the new shareholders angle. Existing shareholders angle also this will be same. Very simple. Existing shareholder had how much value before rights issue? 4 rupees per share was the value. Agreed. Now, for every share, okay, his share price became 3.8. For every 1 share, he loses 0.2. Okay, for how many shares rights is right? 1 right shares is being issued. 3 shares. Up 3 original shares into every share he is losing 0.2. Total loss for the existing shareholder is what? 0.6. Okay, this is what here. So you can also compute 3 into 4 minus 3.8. Okay, 3 is the number of shares for which the rights is being issued into 4 minus 3.8 minus 2.6 is the difference. This is the value which the existing shareholders will lose. And this is the value new shareholders will gain. Are you all understanding? This is nothing but value of rights. So value of rights formula. And what is the formula for value of rights? Tell me, children. Okay, is nothing but X minus subscription price. In a shortcut, you can remember this is nothing but X. X is theoretical X rights price minus subscription price. 3.8 minus 3.2. This will be easy to remember. Are you understanding? Next, now we will move on to the impact. We will find out what is the impact of rights issue on the shareholders' wealth. See, very simple. How many shares the existing shareholder had? 900 shares. They are asking for 900 shares. Up 900 shares the shareholder had. Earlier, 4 rupees was the value per share. Total 3,600. Are you all agreeing? Which means earlier, 3,600 was the value he is having. Now, what happens? Situation 1, shareholder sells all his rights. If shareholder sells all his right, what happens? Okay, existing portfolio value, 900 shares he is having. Into, he will sell the share at what rupees? At what price? 4 rupees or 3.8 or 3.8. Why? See, after the company comes up with the rights issue, the share price falls from 4 to 3.8. Are you all understanding? Theoretical X rights price. Now, really speaking, the market to 3.8 will be the share price or something different. It depends on market. But that is why it is called as theoretical excitement, which should have been the market price after the rights issue, which means 3.8 into 900, which is 3420. Realization from sale of the rights, which means I will see this is the total value existing portfolio value from here. what I do, I will sell the entire write-up. 900 shares I will sell. Okay, into 1 by 3 now. How many rights you will get for 900 shares? If I'm holding 900 original shares, how many right shares I will get? Into 1 by 3, which means 300 shares I will get into 0.6. This is the realized sale of right. At what price I will sell? Value of the right. That's why you computed value of right in step number 2, which is 0.6. For every right shares, I'll get 0.6 into 300. How much is that? 180. Are you all understanding? So original value 3420. Sale, I realize 180. Okay, how much is the value? 3600. Hence, my value doesn't change. Are you all understanding? See, here also, shareholder sells all his rights, not the original share. Original shares he is still holding at the value of 3.8, but he sells the right shares at 0.6 and realizes 180. So 3420 plus 180, which means in the demat account, he will have 3420. Are you all understanding? The value of the existing shares. In the bank account, he would have sold, in the bank account, he would have 180. So total 3600. Wealth of the shareholder does not change. Are you all understanding clearly? Next, very, very important for this attempt. Hence, I am slowly moving. Next, situation number 2. The shareholder sells 50% of its rights and exercises balance 50%. Very simple. In the earlier situation, he sold 100% of its right. 900 shares he was holding. How many right shares were issued? 300. Entire 300 is sold. Here what they say, sell 50% of its rights, which means 150 shares sell it. Balance 150, exercise and keep it with you. Are you all understanding? In this case, what will happen to your wealth is what is the question. So existing portfolio value 900. This is original shares value that will remain unchanged. Now, realization from the sale of the rights. Now you are realizing sale of the rights. How many shares? 900 shares total you had into 1 by 3, 300 rights shares. Either 50%. Out of this, 50% will be sold at what price? 0.60, 90 rupees you will realize. Are you all understanding? So 3420 plus 90 you will get. Agreed. Next, exercises 50% of it right. Next is what? Exercising 50% of it right. Now, new shares will be issued. New shares will get. What do? You exercise your right. And keep your 150 rights. Are you all understanding? 900 shares into 1 by 3, how much? 300 into 50% balance is how much? 150 shares. This 150 share you keep it. By keeping it, what happens? Okay, very simple. By keeping it, what happens? See, if you sell the shares, okay, at what price you will have to sell? Very simple. Yeah. Now, see, value of the right is 0.6. You would have sold at 0.6 and realized 180 rupees, like in the previous question. Now, what happens? See, 150 shares, I become the owner of the share, which means I exercise. I subscribe to this rights issue, right? That is what is exercising means, subscribing. So, this 150 share, what I do, the share worth is today 3.8, but I get to exercise this at what price? Just 3.2. Are you all understanding? Up a share worth 3.8, I am able to exercise just for 3.2. I am making a gain of 0.6. Are you all understanding? I am making a gain of 0.6. But this happens. See what happens. Okay, this happens for the new shares. How many new shares is there? 150 into 0.6. How much is that? 90. 150 into 0.6 comes to 90. Are you all understanding? So which means here 50%, even if you sold 50% and exercised 50%, what will happen? Effectively, this 180 in the previous step gets split by way of 90 and 90, but total 3600 will not change. The wealth of the shareholder will never. Very, very important. Are you all understanding? Now, if he doesn't do anything, like Kumbhakarna, go and sleep. In this case, what will happen? Very simple. Okay, you had 900 shares. Company came up with a rights issue. Do nothing. The third case, if you do nothing, what will happen? This is original shares, that will be the value. Rights issue, you neither subscribe to it, you neither sold it. Are you all understanding? Time also elapsed. So 900 shares will be, earlier it was the value 4 rupees per share was the value. From 4 it became 3.8. Therefore, okay, what will be the wealth? 900 into 3.8. 3420. The wealth gets eroded. 180 rupees is gone. Are you all understanding? Okay, this is, see, when the shareholder exercises his rights and purchases shares, he pays this much. Okay, you can go through the notes, the previous explanation. Step number 3, shareholders does nothing. Existing portfolio value 900 into 3.8, 3420. Okay, he does nothing regarding to a rights issue. Hence, from 3600, his value gets eroded. What is the conclusion? Conclusion is very simple. When the company comes up with a rights issue, either subscribe to the right, okay, or sell the right to someone, but don't sit idle. If you sit idle, okay, if you just keep on watch, then the value will get eroded. That's what they say. Rights issue is an arrangement. Okay, anyway, a shareholder should either subscribe to the rights shares or renounce it at the right value. If he does nothing, his wealth stand eroded. Are you listening? Very, very important discussion. Next. Shall I move on to buyback? Yes, buyback. Now, A Limited has surplus cash of 90 lakhs. See, we are not learning accounting for buyback. In our subject, what is the agenda? Now, just like right shares, what we learned in right shares, whether right shares will affect the value of the wealth of the shareholder. Now, whether the buyback will affect the wealth of the shareholder is what is the subject matter of discussion. Are you all understanding? Buyback is a way of distributing the surplus cash of the fund, just like you dividend. Some company may declare dividend, or some company may just buy back the shares. It's just a way of utilizing the surplus cash available in the company. Are you all understanding? So wealth will never change. Anyway, we have done the question. This question is regarding the typical examination question I'm discussing. Okay, anyway, concepts and all I have discussed detail in equity valuation. Now we'll move on to the detail in the revision segment. Okay, A Limited has surplus cash of 90 lakhs and want to distribute 30% of this to shareholders. A company decides to buy back the shares. The company estimates that its share price after repurchase is likely to be 10% above the buyback price. The number of shares outstanding at present are 10 lakhs and the current TPS is 3 per share. You are required to current TPS is 3 anyway. You are required to determine the price at which the shares can be repurchased if the market capitalization required post buyback is 200 lakh. Next. Okay. What is that? Second. Disappearing. 1 second. Okay. Yes, point B. The number of shares that can be repurchased. Next point, what is the question? First part of the question, they're asking, okay, what is the price at which the shares can be repurchased? Now, buyback price. Buyback price, what is set by the company? What is the asked first part? The second part, what they're asking, the number of shares that can be repurchased. Third part, impact of the repurchase on EPS, assuming that net income is same, which means the EPS same, net income PAT is same, okay, profit after tax is same, and the EPS, okay, what will be the impact on EPS? Why? EPS will reduce or increase if you do buyback. Very simple. Profit will never change. Okay, due to buyback. Buyback is just a way of distributing the surplus cash. Profit will change. No, earnings will not change. Now, EPS is equal to what? Okay, net profit after tax, which means profit available to equity holders divided by number of shares. Number of shares, you tell me after buyback, existing shares 1 lakh, assume. You bought back 2,000 shares, which means, okay, what, 98,000 shares this 98,000 shares will be the denominator, which means, okay, the PAT will be shared by less number of shares, hence EPS will increase. Always when buyback happens, EPS will increase. Are you listening? Okay, impact of repurchase on it. This we know. The third question. Now, first issue, buyback price. You need to find out buyback price. Okay. Assume the buyback price to be X. Assume the buyback price to be X. You need to form an equation and solve the equation. Solving the equation is not an issue, but forming the equation is the main issue. See, very simple. Number of shares to be bought back. Now, if the share price, okay, share price at which this is the buyback price. That buyback price be X. If the buyback price is X, number of shares that can be bought back is how much? Amount available to be bought back, which is 27 lakhs. What they say, very simple. See, I'll just show you. Having some error. See here, in this question, if you notice, what they say, 90 lakhs is the surplus cash. Out of the surplus cash, I want to distribute how much? 30%. So 90 lakhs into 30%. How much is that? 27 lakhs I want to distribute. This 27 lakhs is the total amount I'm going to utilize for buying back. So this number of shares to be bought back, how we will find out? Total 27 lakhs amount to be bought back divided by, okay, what is that? Buyback price. If you do this, you will find very simple. Okay, number of shares to be bought back. Number of shares to be bought back into buyback price will give you what? Amount to be utilized for buyback. Are you understanding? Amount utilized to be utilized for buyback. So now what they say is that this is the number of shares to be bought back is equal to 27 lakh divided by X. Very simple. First part of the question ask us to buyback price. Second part of the question ask us number of price to be bought back. Correct? Second part of the question ask a number of shares to be bought back. So part A and part B, they formed as an equation. Okay, X and 27 lakhs divided by X. That is not an issue. What they say, the market capitalization post buyback should be 200 lakhs. This is the main adjustment. Okay, you need to find. Very simple. Market capitalization post buyback should be 200 lakhs. M cap after BB buyback should be how much? 200 lakhs. That they have given. How 200 lakhs? Don't they have given straight away? See, the market capitalization required post buyback is 200 lakhs. Now, we already know what is the formula for M cap. Tell me, children, what is the formula for market capitalization? Market capitalization is nothing but number of shares into market price per share. Number of shares into market price per share. Here, there is a catch. The number of shares, this is post buyback, after buyback market capitalization you want to find out. So this is number of shares after buyback. This is number of shares after buyback into market price per share after buyback. Market price per share after buyback, you equate it to 200 lakhs. Here only I need your attention. Number of shares after buyback, how much is that number of shares? Very simple. Existing number of shares is how much? I will use the separate note. I will use the new section here. Now, market capitalization post buyback. Little bit tricky area. I want you to focus. How much is that? 200 lakhs. They want you to be 200 lakhs. Now, what they say? M cap post buyback is what? Number of shares post buyback into market price per share post buyback. Agreed? Number of shares post buyback is how much? Existing number of shares minus shares bought back. How many shares you bought back? You will reduce from existing number of shares. Agreed? Existing number of shares, how much given? 10 lakhs. I think it is 10 lakhs. Shares to be bought back. What is the formula? 27 lakh equation. Just now you formula 27 lakhs divided by X, which means 10 lakhs minus 27 lakhs divided by X is number of shares to post buyback. This is nothing but number of shares post buyback into market price per share post buyback. Here only what they say, okay, the market price per share in the question, read the question properly. The market price per share post buyback, the market price per share post buyback is likely to be 10% above the buyback price. Buyback price we assume to be X, which means post buyback, what will happen? The market price per share will be 10% above the buyback price, which means 1.1 into X. 1.1 into X. If X is the price of, okay, 1.1 now, 110% of X, 10% extra over and above the buyback price, which means, okay, you will add this 1.1 now. Put it simply, here we have, okay, into 1.1x is equal to 200 lakh. Buyback, this is market capitalization. The market price per share post buyback is 1.51x. So 10 lakhs minus 27 lakh divided by X into 1.1x is equal to 200 lakhs. Are you all understanding? This is what is the important equation. Thereafter, you can easily algebra equation you can form. That is not an equation you can solve. 10 lakh minus 27 lakhs divided by x into 1.1x will give you 200 lakhs. If you solve x, you will get as 20.88 the buyback price. 0.88 as buyback price. This is point number A. This is the important adjustment. If you don't know how to compute buyback price, forget about the next step. Number of shares repurchased, that also you will not get. If you don't know how many shares to be repurchased, you will never get the EPS after repurchase. So, entire, okay, the 6 or 10 mark, this was asked for 10 marks in what, May 20 or November 23, if I'm not wrong. Okay, within those 2 attempts, they asked for 10 marks. Okay, only because of this adjustment. Are you all understanding? Now, if you do that, number of shares divided, okay, 27 lakh divided by buyback price, you will get you number of shares, which means existing number of shares, how much? 10 lakh. Okay, bought back shares is 1,29,003 times. Are you all understanding? Now, EPS, how to find EPS? 30 lakhs, okay, which will not change, divided by number of shares after buyback, it will change. 10 lakhs was the number of shares before buyback minus shares bought back. How much is that? Shares buyback, how many shares you bought back? 1,29,310. You will get 8,70,690. Okay, so EPS you will get 3.4. Are you understanding? EPS is increasing or decreasing or increasing. Existing EPS is 3 rupees. What is the impact on EPS? EPS is increasing. And okay, write it as note. Here I have not given, but of course, EPS has increased from 3 to 3.45. Are you all clear with this? Shall we do the last question in the equity segment? Okay, take question number 19. A valuation done of an established company by a well-known analyst has estimated a value of 525 lakhs based on the current year's free cash flow of 20 lakhs and an expected growth rate of 5. What they say in the first step, I'll discuss step by step. I'll discuss. Okay, discuss the question, then I will solve, because fully if you read now, we'll get lost here. This question, there is some adjustment required, reverse working question. So I will tell you what happened. What they say, this company, and analyst is estimating the value of this company. What they say, he got the value of 525 lakhs. He got the value as 525 lakhs for the company. How he did found out now? 20 lakhs he assumed to be free cash flow for the current year free cash flow. Growth rate he took as 5%. Growth rate he took as 5%. So 20 lakhs into 1 plus G he has applied, divided by KO minus G. KO, value of the firm. You are finding value of the company. Are you understanding? Estimated value of the company. Now, in the denominator, you will use K over KO, which means, okay, so free cash flow to firm. This is free cash flow to firm 1 divided by KO minus G. Growth rate 0.5. Free cash flow to firm is 20 into 1.05. 20.05. 5% growth rate, 21 lakhs. So this is 21 lakhs. Numerator I know. Denominator I don't know what is the KO, but I know the growth rate 0.05. 5% growth rate. Are you all understanding? Like this, if I do this, I got the value of 525 lakhs. This they have given in the question. This is the first step they have given, already given in the question. Now, next step. While going through the valuation procedure, I am checking the valuation procedure. What I found that you found that the analyst had made some mistake. He made the mistake of using book value of debt and equity in his calculation. Now, sir, what is this book value calculation in his debt and equity? Very simple. You need KO minus G. This KO is nothing but WACC. While computing WACC, okay, in the intermediate also you have discussed WACC using book value weights, WACC using market value weights, WACC using marginal weights. All this we have discussed in intermediate. What they say, this KO computation, WACC computation, he has mistakenly taken book value weights, but preferably, okay, he should have done the WACC computation using market value weights. Are you all understanding now? Using book value of debt and equity in his calculation. While you do not know the book value weights he used, you have been provided with the following information. I don't know what book value he used. Otherwise, I could have easily corrected. Reverse working, I don't know what is that, but I have been given these two information. Company cost of equity is 12%. KE given as 12%. After tax cost of debt, straight away given, you don't need to apply the tax rate. What is that? After tax cost. For WACC computation, you need to consider after tax cost of debt. So KD is how much? 6%. Are you all understanding? So KE is given, KD is given. Now the market value of equity is 3 times the book value of equity, while the market value of debt is equal to the book value of debt. Okay, now, really speaking, you need to take market value, which means he has taken book value. What is the question asking? He has taken wrongly book value. You don't know what is that. You need to find out what he has taken. Okay, agreed. That you need to correct with using market value weights. Here also, market value of equity is 3 times the book value of equity. market value of equity times the book value of equity. Assume book value of equity is, say, some number 0.3. Okay, market value of equity, the weight should have been 0.9. Like this, 3 times the book value of the equity. While the market value of debt will be equal to book value of debt, there is no change. Market value of debt is, okay, book value and market value are same, one and same, no issue. Shall I move on? Okay, this is what the question is asking. You are required to estimate the correct value of the company by taking the market value weights. Okay, KO, the mistake happened. That KO mistake, you need to recompute KO, correct it with market value weights, recompute KO using market value weights, then apply the FCF of 1 divided by KO minus G for the value of the company. Are you understanding now what they say? First step is to identify, okay, book value weight. What he has taken as book value weights, we need to find out. Then only we can correct it. Correct? For that, we need to compute the incorrect KO first. What is the actual KO he has taken? That KO is wrong. But I need KO for further computation, analyzing. Correct? So what I do, value of the firm is equal to what he must have done. Okay, FCFF1 divided by KO minus G, WAC minus G. Okay, he would have done 525 lakhs is equal to 20 lakhs plus 105. I don't know the WAC. I compute the WAC using this method. He should have taken 9% as WAC. Then only he would have arrived at 525 lakhs value of the firm. Are you understanding? He would have taken 9% WAC. Therefore, 20 lakhs into 1.05, 21 lakhs. 21 divided by 9 minus 4%, 5%, 4%. 21 lakhs divided by 4% will give me 525 lakhs. Okay, he has taken wrong WAC. Yes, he has taken 9% as WAC. Now, how he would have computed this 9%? Next step, see, very simple. He would have source, proportion, cost, and weighted cost. He would have computed WAC, there. Equity is there, debt is there. Let's assume that equity value is P, proportion of the equity is P, and proportion of debt is 1 minus P. Only two, okay, types of either is there. Okay, capital, source of capital is there. So P, 1 minus P. Cost of equity given in the question as 12%. We don't know what is the proportion here. We don't know what is the proportion. That is what we need to find out. We need to find out what is the weight taken by this person. Correct? Now, this is nothing but P. Let the weight be P, of the equity be P. Upper debt weight will be 1 minus P. Agreed? Cost is given in the question. Okay, it is 12% cost of equity, 6% post-tax cost of debt is given. Now, the total will be 12P and 6P. 18P will be the WAC. Equate it. So, 18P will be the WAC is equal to, already you know what is the WAC. He has got the WAC as 9%. 18P is equal to 9% means P is equal to 50%, 0.5 or 50%, which means he has taken book value weight as value of equity, weight of equity 50%, weight of debt as 50%, and solved the question. Are you all understand? Solved the found out the valuation. He has done the valuation based on 50% weight. Agreed? Now what we need to do? We need to correct the weights. We need to correct the weight. Okay, see what they say. Market value of the weight, he has taken 50%. Book value is 50%. What you should do? Okay, the market value of equity is 3 times the book value of the equity. Which means if 0.5 is the book value of equity into 3, now 1.5 will be my weight of the equity. Whereas book value of debt will be same as market value of debt. So 0.5 will be the value of debt, weight of the debt, which means, okay, the proportion should be, this is 1.5. So market value of equity is 1.5. Market value of debt is same as book value 0.5. So proportion of equity, the total comes to 2. So proportion is 1.5 equity. Proportion of equity is 1.5 divided by 2. And proportion of debt is 0.5 divided by 2. Are you all understanding? Equity. Now recompute the WAC. Source, proportion, cost and weighted cost. Source, equity and debt. Equity, 1.5 divided by 2, you have 0.75. Okay, here 0.5 divided by 2, you have 0.25. Cost is 12% and 6%. Weighted cost comes to 9% and 1.5%. Overall cost of capital comes to 10.5%. Are you all understanding, my dear friends? Which means he has taken 9% WAC, which is incorrect. The correct WAC is 10.5% using market value weights. This WAC you should apply to the free cash flow to firm. The formula, free cash FCF of 1, the 21 lakhs, numerator will be same. WAC only changes. Earlier 9%, 10.5% minus, okay, 5%, 5.5%. 21 lakhs divided by 5.5% comes to 381.82 lakhs. Are you all understanding? This is the correct value of firm. Okay, next question, question number 20. Already we discussed this, repeated. No, don't worry, ignore that. Okay, this question already discussed. With this, we are through with the equity valuation segment. We'll take a short break and then we will start discussing the futures. Okay, shall we start with futures? Okay. Question number 21. Take question number 20. First question of the future. Next futures with dividend yield. Heading given like this in examination head will not be given. Anyway, I have given it to identify the question. See, very simple. You have the 31st August 2011, the value of stock index was 2200. The risk-free rate of return is 8% per annum. The dividend yield on the stock, okay, index is as under, which means January, February, March, from January to December, 12 months dividend yield, respective dividend yield has been given. Assuming that the interest is continuously compounded daily, find out the future price of contract deliverable as on 31/12/2011, given E value given. Now, see here what happens. You need to, okay, find out the fair futures price. Fair futures price is equal to nothing but fair value of the futures, nothing but spot into e to the power tr. Where continuous compounding is to be used, you should multiply it e to the power tr. I told you where dividend yield is given, spot into e to the power tr is there. This t into tr is what? T into r. Here I will show you. Okay, second. Here I will show you what to do. See, very simple. Spot into e to the power t into r is there. Where dividend yield is given, the same, okay, the formula will be spot into e to the power t into r minus d. This r d is nothing but dividend yield. You can directly reduce from the rate to arrive at the d. Are you all understanding? So here spot, leave the spot price, spot index is 2200 into e to the power t in a time which is 4 months. Very simple. On the future, starting date is 31/8/2011. What is the maturity period of the futures? 4 months. 11, 8, 9, 10, 11, 12. 31/12/2011. Now, so the time is 4 by 12. That is not an issue. Into rate, our rate of return is annualized rate of return is 8%. So 8% minus dividend yield I need to find now. So what they say, if 12 months dividend yield is given, you have to consider September, October, November, December. This is what the future falls within this time frame. These 4 months are relevant. About dividend yield for these 4 months, 3%, 3%, 4%, 3% is same or something different or different. So what you should do, take a simple average of this, which means 3 plus 3 plus 4 plus 3 divided by 3 are your divided by 4 are your understanding. Simple average if you take, you will get 3. Yeah, 13 divided by 4, the 3.25 are you all understanding? So what you should do is 3.25 percentage reduced from the 8% minus 3.25. How much you are getting? 8 minus 3.25 at 4.75% into 4 divided by 12. 1.5833. So 2200 into e to the power 1.5833 percentage. If you change in the decimal terms, how to write it? 0.015833. Are you all understanding? This is nothing but given in the solution. If you see, given in the question itself, if you see this e to the power 0.015833 is nothing but 1.01593. So spot into, okay, 1.01593. If you do, you will get the value 0.093. That 2235.042. 0.04, you'll get the fair futures price. Next, margin accounts is there. This question I feel is important, even though asked in the recent attempt. Okay, I think September attempt they have asked, September 25, they have asked this margin account. Anyway, this is important, that's why I'm discussing. Sensex futures are traded at a multiple of 50. What is this 50? Lot size. Lot size is 50. Consider the following quotations of Sensex futures in the 10 trading days during the February 2009. High, low, okay, day, high, low, this is day, and high, low, closing given. I told you, wherever these kind of quotations are given, what is the relevant price? Always closing price will be relevant price. I don't care what is the high price today or low price today or opening price. Always consider the closing price. Are you all understanding? That is to be taken. Now, various dates are given, closing prices are given. Now, Abhishek bought one Sensex futures on February 4, which means February 4 means I have here first day he bought one Sensex futures at 3296.5. Agreed? Now, the average daily absolute change of the value of the contract is 10,000. This is average daily absolute change, and standard deviation of these changes is 2,000. Can vary up to 2,000. The maintenance margin is 75% of the initial margin. You are required to determine the daily balances in the margin account and payment on margin calls, if any. This is the question. First step is to compute the initial margin amount. Step is to compute initial margin. Initial margin, we have the formula. Okay, mu plus 3 into standard deviation. 3 into standard deviation, whereby the mu is nothing but daily absolute change. I call it as daily absolute change. In this question, it is 10,000. It is 10,000. And what is the standard deviation here? 2,000. So 10,000 plus 3 into 2,000, which is 6,000. 16,000 is the value. 6,000 is the initial margin required to be deposited. Are you all understanding? Initial margin 10,000 plus 6,000. 16,000 is the initial margin. Next, maintenance margin is 75% of the initial margin. 12,000 is the maintenance margin. Now, we need to find out whether call money is required or not. I told you three types of margin is there: initial margin, maintenance margin, and variation margin. Very simple. Initial margin, when the amount crosses the maintenance margin, okay, that is the threshold. At least that, what they say, 16,000 you deposit initially. Okay, it should not breach 12,000. If the money breaches 12,000, you should recoup the amount. Are you understanding? Maintenance margin should never be breached, is what they say. So suppose you have balance of 10,000 rupees. M2M procedure will be there every day, mark to market procedure. So every day the futures contract will be, even though you are not selling or buying, closing the futures contract, but every day on market closure, it will be assumed that it is closed. The contract is closed and reopened in the next day price. Are you understanding? So what will happen? 16,000 is assumed, 10,000 is the balance. Okay. Then 4,000 you incurred loss on the first day. Then the second day, assume. So 6,000 will be the balance. It is the balance. 6,000 is going below the 12,000 maintenance margin. You need to recoup the maintenance. You recoup the balance. This balance you should not make good 12,000. You should make good 16,000 amount. Are you understanding? So 6,000 is the balance. Bring 10,000. You should at least recoup the initial margin, even though it is going below maintenance margin. But while topping up, okay, you should not top up only up to maintenance margin. You should recoup the initial margin. Are you understanding? So very first day, I'll see one by one. Each day I'll see the transaction, what happened. 4 and I buy this 16,000. I deposit the margin account. I just deposit in my margin account. I have 16,000 opening initial margin. Fifth day, what happens? Okay, I bought at what 329. What is the price initially? I bought the futures at 3296.5. Next day, for comparison, the closing only you should take for comparison. Okay, high, low, you should never consider. Are you understanding? So closing prices 3294.4 is the next closing price. So 3296 we buy it, but he sold at 3294.4. Gain or loss? Loss, because 3294 minus 3296.5, you will have loss. How much will be the loss? Okay, see. What is the loss amount? Tell me. See. Here. 105 minus, see, 3294 minus 96. This is minus 2.1. This is per share. How many shares are there bundled in one futures contract? 50. Lot size is 50. Are you understanding? So loss is 105. Up 16,000, or you reduce 105 from it. How much you will get? 15,895. Is it breaching 12,000? Not crossing 12,000, not below 12,000. So what I should do? I should call money. You should bring back the amount. You should not. No need to bring money. So we'll keep as such. Only if the 12,000 is breached, you need to bring up the money. Are you understanding? Next to 6 today. Loss again 3230 closing price minus opening price 3294.4 into 50 minus 3,200 minus 3,200. And what is the amount? Loss again? Yes, loss of 3,200. You reduce 15,895 minus 3,200. You will get 12,695. Still not breaches the 12,000. Hence, no call money. Are you all understanding? Next day, 7-2. Okay, again minus 905 loss. Okay, and 60, what happens? 905, you are incurred loss, from 12,000, what was the amount? From 12,695, from 12,695, much is the amount? 11,790. Now, it is breaching 12,000. It is getting below 12,000. Okay, which means you need to recoup. Yes, I need to recoup. Sir, how much I need to recoup just to make it 12,000 or 16,000? 16,000. You need to recoup initial money. So 11,790. I need to recoup it to 16,000. So 16,000. How much I need to bring in? 4,206. You all understand? 210. Okay, this is round of 12,695 is there. 16,000. Okay, 905. Okay, 12,695. Okay, agreed. 11,790 minus 16,000. 4,210. 4,210. Not rounding off, correct only. 4,210 should be recouped to make it 16,000. Are you understanding? One line summary. If the 12,000 threshold breaches, you should not only bring up to 12,000, you should make it to 16,000. That is a okay, only point adjustment. Next, 10 to, you have the same profit here. Profit, you add back the profit. Okay, 2,760 plus 16,000. Call money required or not required. Again, next day, profit, not required. Okay, add the amount. Okay, next day, again profit, you add this amount. Like this, you do. Next, okay, again profit, you add. Next day also profit. Next day, minus. This is loss. Minus 2,575. Okay, you reduce it. 18,275. Less than 12,000, not less than 2,000. No issues. Next day, okay, bumper loss. This is minus. This is here given. Minus 7,000. Okay, 760. Which means from 18,275, it became how much? 8,000 plus 1,007. Crosses 12,000. Yes, comfortably crosses 12,000. Now I need to make it up 12,000, 16,000, 16, which means that 5,485 you need to bring. Are you all understanding? This is how we need to compute margin account. Very simple and very Only two things here. One is the initial margin formula you need to remember. Sometimes they may give you like this absolute daily absolute change means mu and standard deviation will be given. Now you should apply this formula mu plus 3 into standard deviation, find out the initial margin. Sometimes they may just ask you, okay, contract value will be given 8 lakhs contract, 80 lakhs will be the contract value. Now, some percentage of the directly given the contract value. See, bring 40% of the contract value as margin. So 40% into contract value, you can easily find out. Next, futures and futures and portfolio management. Anyway, heading given, no issue. Mr. A has a portfolio of 5 crore consisting of equity shares of X Limited and Y Limited. So two shares, company shares are there, X Limited as well as Y Limited. He has constructed a portfolio. With beta of 1.15. Other information as follows. Spot value of index futures 21,000. Multiplier is 150. Multiplier is 150. To a contract lot size. Okay, multiplier is 150. You are requested to reduce the beta to 0.85 and increase the beta to 1.45 by using change in composition through risk-free security. Index futures. Are you understanding? Very simple. Okay, now see, you need to reduce the beta. Two things have been given. You need to reduce the beta in the first beta. The second part, you need to increase the beta. Two things have been asked. Both the things you need to do by using risk-free security first, then index futures. Beta hedging. Index futures you use, beta hedging you use, and increase or decrease the beta. How you should do. Or risk-free securities, if I bring in, how should we hedge the position? Very simple. What I should do? See, initially, first change in composition. Risk-free securities, I will say part A. Risk-free securities, I need to bring in how much? Very simple. At present, what is the beta? At present, what is the beta? 1.15. I need to bring it to 0.85. Now reduce the beta. I need to reduce the current beta. Current beta is 1.15. I need to take the beta to 0.85. What I will do, if I want to reduce the beta, I will include a risk-free security, which means I will invest in risk-free security, or borrow in risk-free security, or invest in risk-free security. What will be the beta? Beta of the RF, risk-free security, will be always zero. Be zero. Beta is nothing but correlation, change in security return divided by change in market return. correlation of the securities return with market. This is called as beta. Are you all understanding how much the security return changes with regards to market return? This is the beta. Now, risk-free security is correlated to market or not at all correlated to market or not at all correlated to market. Market movement depend. The risk-free security return depends on market movement. It doesn't depend on market movement, so there is no correlation. Beta is 0. Now, at present, I have beta of 1.15. If I want to reduce the beta, if I bring in a security which is having 0 beta, my ultimate portfolio beta will be reduced. Having the clarity. Conversely, if I want to increase this beta, at present beta is 1.15. I want to increase it to 1.45. What I should do? Increase the beta. Now, what I should do? I should take more risk, reduce risk, more risk. Instead of investing in risk-free security, I will borrow at the risk-free security. Understanding leverage, financial leverage, I will borrow, risk will automatically increase. Are you listening? That I will do and increase the security. So, change in composition through risk-free security. What I will do, reducing beta to 0.85. First option, I want to reduce the beta. Now, what I should do? My portfolio proportion is P, proportion P, and risk-free security proportion is 1 minus P. Let the portfolio P is nothing but risky securities proportion. Risky securities proportion, okay, is P. Beta is 1.15 of the risky portfolio. Weighted beta is 1.15p. The risk-free security has anyway beta is 0. I told just now I explained. So weighted beta, anything multiplied by 0 will be 0. Total comes to point. Total should be 0.85. Okay, I should get proportion. I should invest in risky security in such a proportion that my weighted average portfolio beta becomes 0.85, because portfolio beta is nothing but weighted average beta of the individual securities inside the portfolio. Now, portfolio beta, target beta, how much? 0.85. I should equate it to 0.85. So, 0.85 is equal to 1.15p. Hence, P is equal to what? Okay, P is equal to 0.739 or 73.9 percentage. And 1 minus P is equal to what? Okay, 0.261 or 26.1%. Are you all having the clarity? Which means, okay, if you want to invest 5 crores, how much this person wants to invest? 5 crores are given in the question, 5 crores he want to invest. Out of this 5 crores, what I do, if I invest a 73.9%, which means 3.695 crores in portfolio, risky portfolio, and 5 crore I invest in risk-free security, okay, then the risk-free security, then the beta will be reduced to 0.85. Are you listening? Now, using the same risk-free security, if I want to increase the beta to 1.45, if I want to increase the beta to 1.45, tell me children, what will happen? Okay, if I want to increase the portfolio beta to 1.45, I need to borrow, that is fine. Okay, now, borrow now, what I will see, very simple. Okay, now, I need to borrow now, I call it a short position in a short RF, risk-free security. See, very simple. If you want to invest in RF, you go long. This is called as long in RF. This is investing, because you are putting in money, you are buying risk-free security, which is long in risk-free security. Short in risk-free security, you should sell. Sell means borrow. You should additionally borrow the risk-free security. Are you all having the clarity? Same way, security, proportion, beta, weighted beta. Weighted beta should be 1.45, and anyway, this will be 0 of the risk-free security. So this beta 1.15 P proportion of the risky portfolio is equal to 1.45. This, if you equate, okay, P you will get as how much? P will be how much? 1.26. 1 minus 2P will be minus 0.26. Sir, what is this 1.26 and minus 0.26? Very simple. What they say, okay, if you have 5 crore in hand, what they say, into 0.26%, 5 crore into 0.26, how much is that? 1.3 crore you borrow. Additionally, 1.3 crore you borrow. You have 5 crore in hand plus 1.3 crore you will borrow. Together, how much is that? 6.3 crores. Together you invest in risky security. Everything you invest in risky security. Are you all understanding? So my portfolio beta will become 1.45. It will even increase further. My portfolio earlier was at present 1.15. That will become 1.45. Instead of reducing, it gets added. Are you listening? This is the first part of the solution, where you bring in risk-free asset and change the beta value. Okay, reducing and increasing. Now, next part B, what we are going to discuss, they also asked us to hedge using the futures, change the beta using index futures. What I should do? Reduce the beta to 0.85. Now, I told you, if you want to reduce the beta, if you have long position in cash market, what you should do in futures? Short in futures. Are long in cash market, short in the futures market. So a person long in the cash market, long buy position in cash market, should take short futures position to reduce the risk. Value to be hedged is nothing but cash market value. This is 5 crores is cash market value into, okay, my existing beta minus target beta. Very simple. Okay, cash market value into beta minus target beta. Existing beta 1.15 minus my target beta 0.85. 0.85. I need to reduce how much? Value to be hedged 1.5 crore. Value to be 1.5 crore. In this is the total value to be hedged. The value to be hedged has 3 components. This is nothing but amount to be hedged. How much is that? 1.5 crore. This has 3 components in it. Okay. Value of the futures contract. This I call it as total futures contract value. Contract value is nothing but number of contracts into lot size into futures price. Are you all understanding? In this case, we know that this 1.5, okay, we know that 21,000 is the futures price. Lot size is 150. How many contracts? Okay, you just multiply 1.5 crore divided by 21,000 into 150. If you do this, okay, you will get the value as 4.76, which is nothing but number of contracts rounded off to 5 contract. I need at least 5 contract to hedge my position. Okay, so that the futures value become 1.5 crore. By that, I will hedge my cash market value. Are you listening? Next, increasing beta to 1.45. Sir, in by way of futures hedging, how will I increase the beta? Very simple. In cash market, if you have buy position, if cash market you have long position, what you should do in futures market to increase the risk? Same position in futures market, risk will not be reducing, risk will be even doubling, further increasing. Which if you have cash market position, if you are long in cash market position, take a long position in futures market, your risk will increase. If you have short in cash market position, take short in futures market, your risk will increase. A person long in cash market should take long futures position to increase risk. Value of futures to be taken 5 crores, okay, into beta minus target beta 1.45 is equal to 1.5 crores. Are you all understanding this? 1.5 crores. What I should do? I should long or short long. I should go long. Number of futures contract to be bought 1.4 crores. Same question, same drill. Okay, 1.5 crore is the total contract value. Divided by, okay, 3 things are to be there. Number of, okay, what is that? Number of futures per contract. Number of contract into lot size into futures price. FP na futures price. Here 2 things are given. Lot size is 150. Futures price is 21,000. Number of contract, you will find out the balancing number 4.76 or 5 contract. Are you all understanding? Only thing is, there also 5, here also 5. What is that? Sir, there I need to reduce beta. So 5 contract I will short to reduce the beta. Short I will sell the value to reduce the beta. Here what I am doing to increase the beta, I am going long in the future. Correct? I am going long, which means I am buying buy more contract. Are you all understanding till now? Question number 24. Futures arbitrage. The following data related to Anand Limited share price is given. Current share price is given as 1,800. Then 6 months future price, okay, given as 1,950. Futures price is given as 1,950. Spot price of the share is given as 1,800. Assuming it is possible to borrow money in the market for transaction securities at 12% per annum, you are required to calculate the theoretical minimum price of a 6 months forward purchases to be understood as futures. Okay, futures, because question is being asked, forward and future are not one and same, but okay, 6 months futures purchase. And to explain arbitrage opportunity, very simple. First step in the arbitrage process, I told you that it is nothing but calculation of fair futures price. Now, let me check. What is the fair futures price? Spot into e to the power TR. Here, Okay, there is nothing E value given or not given. I told you where they have not mentioned anything about E value or continuous compounding, CCRI. You should take normal compounding. So spot into 1 plus R raised to the power n. Simple compounding you will do. Okay, what is that? 12%. Na? So that is what they have done. First fair futures price. They have spot into 1 plus R raised to the power n. So 1800 into 1.06, 1908. This is the fair futures price. Fair futures price is equal to 1908. Actual futures price is equal to what? 1950 quoted in the market. You tell me, futures are quoted in the market overvalued, undervalued? Futures are overvalued, undervalued? Very simple. Okay, in the future share is overvalued in the futures market. Futures market. This is overvalued 1950 na. So what you will do? Something you will something it is overvalued. Now what you will do? You will sell. So sell. Okay, this future, sell the futures at 1950. This is the strategy. So spot buy, sell futures, sell futures. Now the share is overpriced in the futures market. Therefore, the arbitrage strategy is to sell the share futures contract at 1950 and buy the share at 1800. How arbitrage profit happens now? Very simple. You have to buy the share. So today, what is the strategy? This is cash market. This is futures market. In cash market, you will buy 1800. This is the share worth 1800. In futures market, I'll sell, okay, at 1950. Are you all understanding? Now, borrow. Now, this 1800 you need to buy. Na? How you will buy? You will assume it to be borrowed amount. And repayment on the maturity, you need to do that with interest. So borrow 1800 at 12% for 6 months. Borrow 1800 rupees 6 months. Assume you have no money. You will borrow 1800, buy a share, and go to the futures market and sell the futures at 1950. So two things you will do together today. You will do two things together. One is that buy the share in the cash market 1800 and sell, okay, in the futures market for 1950. Are you all understanding? Now, after 3 months, 4 months, or 3 months, 6 months, after 6 months, on the date of maturity, what will happen? Again, 10 children, what will happen? You have borrowed 1800. Now you need to repay. Okay, 1800 into 1.06, 1108. This principal plus interest you need to repay. Okay, the borrowing 1908. Are you all understanding? So 1800 into 1.06 comes to 108. You will repay this 1908. You will repay the borrowing. Now you need to sell. You have sold in the futures market. You need to close your position. Na? Okay, you have agreed to sell the share on the date of maturity. Now, from where you will get the share? Initially, you bought the share at 1800. Na? That you will sell after 6 months for 1950. Are you all understanding? So, gain is nothing but 1950 minus the repayment amount. You settled amount. How much is that? 1908. Okay, how much is that? 42 rupees is the profit. Repay borrowing along with the interest comes to how much? 1908. Then the balance is profit. Okay, which is 1000. See. What is that? Sell the share in the futures market on maturity at 1950. Use the proceeds to repay the borrowing of course, arbitrage process 1950 minus 1942. The arbitrage process. Simple arbitrage question. Okay, shall we move on to question number 25? This is futures hedging. Very, very important topic. Futures hedging. Mostly, okay, every 2 or 3 attempts they ask questions regarding futures hedging. On January 1, 2013, an investor has a portfolio of 5 shares given below. Security A, B, C, D, E given, price given, number of shares given, and beta given. Now, the cost of capital to the investor is 10.5% per annum. And you are required to calculate beta of the portfolio. First, beta of the portfolio, then theoretical value of Nifty futures for February 2013. The number of contracts of Nifty the investor needs to sell to get a full hedge until February for his portfolio. The current value of Nifty is 5,900 and Nifty futures have a minimum trade lot requirement of 200 units. Assume that the futures are trading at their fair value. Futures are trading at their fair value. The number of futures contract the investor should trade if he desires to reduce the beta of his portfolio to 0.6. Okay, number of days in a year to be treated as 365. Given This is log Norman value. Ln of ln 1.105 equal to 0.0998 and e to the power, okay, 0.015858 is 0.01598. Very, very important, these two numbers. I will explain what it is one by one, step by step. Can we solve the question? Very simple. Now, first step they are asking us to, they have given the individual share. So I have created a portfolio of one security or five security. Five security I have got in my portfolio. Now what I should do, I have beta for each of these securities. What they say, find out the beta of the portfolio. Beta of the portfolio management. Okay, I will explain, no issue. Beta of the portfolio is nothing but weighted average beta of the individual securities inside the portfolio. Now tell me, what is portfolio beta? Portfolio beta is nothing but weighted average beta of the individual securities inside the portfolio. Just like your WACC computation, weighted average cost of capital you compute, na? Same way here also, weighted average beta you will compute. The first step is very, very simple and straightforward. Okay, how to compute the weights is the only thing. Security A, B, C, D and D I will put. Price of the share, number of shares, I will take the market value of the share. Are you all understanding? Market value weights I will use. Just like you compute the WACC, I will compute the portfolio beta. Are you all comfortable? Very simple. Price of the share, per share price is how much? 349.3. Suppose number of shares 5,000. The total market value of AL Limited is how much? 17,46,500. Like this. Okay, total value of the entire portfolio. What is the total value of the portfolio? 188,54,860. Are you all having the clarity? Now what I will do? Okay, I will find the proportion of value of A to total portfolio value, which means 17,46,500 divided by 188,54,860. I get proportion as 0.093. Next, tell me children, how to find proportion of B. 33,63,500 divided by 188,54,860. You will get the proportion of B. Like this, you will find out the proportion of each and every security. Multiply it with beta, you will get the weighted average beta of the portfolio. Add everything, you will get the weighted average portfolio beta. Are you all understanding? So security, price of the stock, number of shares. This you multiply the second column and third column, you will get the value. Like this, if you create the, you find out the value, market value of each and every security and find out the total. Are you understanding? Now proportion, how to compute each security's market value to the total portfolio value. That you will find out the proportion. Respective beta you multiply with the proportion. Okay, total it you will get the 0.849 weighted average beta of the individual security. Portfolio beta I got it as 0.849. This question, if you see that in one or two attempts they were asked a reverse working calculation. Okay, one portfolio beta is given, one of the security beta is missing. Okay, you should calculate that security's beta. Like this one question has been asked, the portfolio beta given, security A beta they've asked us to calculate. Okay, anyway, that you can easily do. Next, calculation of theoretical value of futures contract. Next, what they're asking, okay, theoretical value of Nifty futures for February 13, which means at present, see, yes, today on January 1, 2013, which means 2 months future, or I should say 58 days futures, because, okay, they have taken as 58 days futures because the number of days in a year is to be assumed as 365. Okay, what you should do? 365 days, na January 1, from Jan 1 to February last, okay, 2013, not a leap year, so 28, okay, 28 in here, 30, so first day you leave it, so how much is that? 58 days, so 58 days futures, I need to find out. Spot into e to the power TRR. What is the spot? Tell me, what is the spot? Even, see, you need to find out theoretical value fair futures price. Theoretical value means FFP, fair futures price we need to find out. For that, you need to find, okay, Nifty, Nifty you have to have, correct? Now, they have given, this is what the question anomaly is that. Second question, the second part of the question, they asked theoretical value. But the point is the spot Nifty, okay, if the current Nifty is 5,900, they are going to the third part. You are understanding? Anyway, you will consider that. So 5,900 is the spot Nifty. You will consider that. Okay. And you will find out the theoretical value. That is not an issue. Okay. 58 by 365 is the time period and 5,900 spot price you will consider. Fine. Here, the main adjustment is regarding that R you have e to the power T. See, here continuous compounding you should use e to the spot into e to the power T into R. Right? Here T, I know that it is time. What is the time? Number of days to be taken. So 58 by 365. This is fine. Are you understanding? R the continuous compounding rate of return you need to use, there will be one important adjustment. You see what they say in the question. They have given the cost of capital as 10.5%. They have given cost of capital as 10.5%. That is not an issue. But only issue is, sir, okay, they have given this log normal value, continuous compounding rate. See, in this question, whether they have given this is 10.5% per annum. This is normal interest rate and not continuous compounding rate of risk-free rate of interest, CCRRI. If CCRRI only you should consider for continuous compounding. Normal rate given 10.5. How we should convert the 10.5 normal rate into continuous compounding rate? Are you all understanding? Which means 1 rupee, if you are deposited 1 rupee in the bank, okay, it will mature to 10.5 now, 1.105 in the after 1 year. If you compound only for one time, if you compound only for once, this one will become 1.105. This I call it as normal compounding or compounded once. In case of continuous compounding happens once or every second continuously compounded. So which means, okay, how much the rate of return I should use? If I use 10.5% and compound it once, the maturity value become 1.105 after 1 year. Are you all understanding? What is the rate of interest if I use, okay, to arrive at the same maturity value, okay, within this one year, the rate would be less than 10.5, more than 10.5, less than 10.5. That is what is given as log normal value. Okay, how this will be arrived at all this data, you can go through the comprehensive revision series I have uploaded. There I have solved the same thing. Very simple. Log normal value of 1.105. This is nothing means, see, the maturity value of 1 rupee matures to 1.105 at 10.5%. The equivalent continuous compounding rate you will get nothing but 0.0998. This is in decimal or percentage number is nothing but 9.98%. To put it simply, okay, if 1 rupee is compounded only once at 10.5%, it will become 1.105 after 1 year. The same 1 rupee, if compounded at 9.98%, continuously compounded for 1 year, it will become 1.105. 0.105. So continuous compounding rate is 9.98. They have already given in their question that you need to consider. Are you all understanding? So in case of e to the power t, that is what given. Okay, here also note as given. Capital cost of capital 10.5%, annually compounded rate of interest, continuously compounded rate of interest, log normal value of 10.5. Okay, 1.105 is 9.98% or 0.0998. Understanding this, okay, e to the power t, all this I have given. Please go through that. I don't want to discuss in the revision lecture, question answer discussion. Okay, for February contract, so 58 days is there. R is 9.98. What you should do? E to the power TR, E 58 by 365 into rate of return 9.98%. So 9.98%. Okay, in decimal terms, how will you write the 9.98? 0.098. Agreed? So 0.098. See, 0. What is that? 998. Yes, 998.0998 into, okay, 58 by 65. What is the decimal? 0.015858. This is what they have given as. Okay, the question itself, they have given e to the power 0.015858. This you multiply with 5,900, you will get the futures price as 5,994.28. Are you all understanding? Next question, what they are asking. Okay, what is the number of contracts to be hedged, okay, of the investor need to sell to get a full hedge until February for his portfolio. The current value of Nifty is this much. Nifty futures have a minimum lot requirement of 200 units. Assume that the futures are trading at fair value. Important. Futures are trading at fair value. See, now futures price. See, very simple. I'll tell you like. What happens, you tell me. Now, what is the total portfolio value? 188.54.860. Out of this, okay, if you see this is total contract value. If I need full hedge, what I should do? Okay, this is the cash market value in beta into cash market value into beta. What is the portfolio beta? Into 0.849. This I will do to arrive at, okay, the Futures market value. How much is the futures market value? 160 lakhs 07776. This is the total futures market value. Agreed? This total futures market value. Okay. This 160 07776. Now this futures market value I have in hand. This futures market value is a mixture of three things. One is the number of contract into lot size into futures price. Futures price, they have told that the futures price, okay, the fair, this is actual futures price. This is to be taken as actual futures price, but they have given one adjustment. What is that? The actual price, assume it to be on that date quoted at fair price, which means the fair futures price, just now you computed fair futures price, that 5,994 or something, that you will consider fair futures price. Lot size is given and number of contract you will find out. Are you all comfortable? So this is what they have done. Number of futures contract, balancing number you will get, number of futures contract. Okay. See. Number of futures contract, very simple. How much is that? Second, I'm moving on to a question. Having some bug here. 160 lakhs 07776. Agreed? This futures price, if you divide, you have to divide it by three things. One is number of contracts and divided by future into futures price into what is that? Lot size. Here, lot size is given. Yes, 200 lot size given. Again, 5994.28 is given. So what you should do, this 160,07776 divided by 200, I know that, lot size, into futures price, 5994.28, fair price, I know that. But into number of contract, let it be C. Let it be C is equal to, if you do this, how much you should get? Okay, you should get this. If you do, you should get the balancing number as number of contract. Are you understanding? If you do 0.776 divided by 200 divided by 5994.28, 13.35 or 14 contracts, rounding off. Okay, you should be rounding off to the, you cannot take 13 contracts, it will not be fully hedged. You should take 14 contracts to fully hedge the position. Are you all understanding? Next, number of contracts to hedge the portfolio partially. Number of times, what they ask, the step number 4, they ask that reduce, don't hedge entire portfolio, which means don't bring the portfolio beta to 0. They say, okay, make the portfolio beta how much? 0.6. Make the portfolio beta to 0.6. See, if you use the cash market value into beta of the portfolio, the entire portfolio will be hedged. Are you listening? Now, I don't need my entire portfolio to be hedged. Current beta is how much of the portfolio? 0.849. This I need to bring down to 0.6. That's it. But don't bring it to 0, which means what I will do, value of the futures market value. Futures market value is equal to, total value is equal to what? Spot value or cash market value. Cash market value into, okay, existing beta minus target beta. Existing beta minus target beta. Okay, is equal to nothing but, what is that? See. Value of the position of 188,54,860 total portfolio value into, this is existing portfolio beta 0.849 minus target beta 0.6, which means only the balance portion you will hedge. Okay, 0.6 beta you will keep unhedged. Are you listening? So this comes to 46,94,860. Number of futures to be sold. Okay, this much is to be hedged. If this is the amount to be hedged, okay, which means again same way, number contract value divided by futures price divide into what is that? Lot size 200. Are you all understanding? So 46 lakhs 94,860 divided by 200 into 5994.28. You will get how much? 4 contracts, 3.92, which is rounded off to the, okay, higher end 4.4 contracts. Are you all understanding? Very, very important question. Mark it as important. Now, take question number 26. Okay. Details about portfolio shares of an investors are below. This is very, very important. Little bit tricky question. Last question, all tricky. Already, whatever we discussed, I'm not going to discuss. Are you all understanding? Every question will have so many subparts. Okay, like portfolio, this also will ask us to compute portfolio beta, pair futures price, number of contracts to be hedged, all this will be said. Okay, one important adjustment is that, that's why I put the question. Okay, see here. Details about portfolio of shares of an investor is as below. Shares detail given as A limited, B limited and C limited. Okay, number of shares given in lakhs, price per share given, beta is given for each and every security. Now, the investor thinks that risk of the old portfolio is very high and wants to reduce the risk of old portfolio, which means existing risk of the portfolio. It should be risk of portfolio is very high and wants to reduce the portfolio beta to 0.91. Are you all understanding? Now, he wants to reduce the beta to 0.91. At present, I don't know what is the beta. Correct? Now, what is saying? He is considering two below mentioned alternative strategy. Bring the portfolio. One question already we saw, risk-free security and futures market. This is nothing new. Already we discussed one question regarding the same strategy. Okay, that's why I'm discussing again. Say, dispose of a part of his existing portfolio to acquire risk-free asset. Same strategy. Okay, one option is that part of your portfolio dilute and bring in risk-free security. That is one option. Second option, okay, you keep the full amount here, cash market value, let it be as such. You take the corresponding futures market, futures position, which means in the first option, you take risk-free security and hedge your position. Second option, take futures and hedge your position. These are the two options available. Are you all understanding? Now, that given, take appropriate position on Nifty futures. If you are long in the cash market, anyway, futures, so what you should do? Sell in the futures, short in the futures, which are currently traded at 8.125 and each Nifty points worth 200. This is lot size. This is the future price. This is the lot size. This is futures price. Are you all understanding? Contract, how many number of contracts not given? You will find out. Okay, they will ask you, say, portfolio beta. You are required to determine, again, first step in, what is that? Portfolio beta. First step, already we computed, you can go through. Shares, number of shares, market price of the share into number of shares. If you do, you'll get the total market value. You'll get the proportion, beta, weighted beta. Nothing new. Already we discussed. Same way you compute the portfolio beta. A portfolio beta comes to 1.3. Are you all understanding? Now, next is question they are asking. At present, what is the portfolio beta? What is that? Portfolio beta 1.3. What they say? This portfolio beta, they want to bring down this portfolio beta to 0.91. They said in the question, do you remember? See here, 0.91. They want to reduce. At present, the beta is 1.3. Now, two options they have told. One is to acquire the risk-free asset. Correct? The value of risk-free security is to be acquired. If I want to hedge using risk-free security, what is the amount of risk-free security I need to bring in? Value of the risk-free security is the question. Now, required beta is 0.91. Okay, I need to bring in risk-free security using, okay, with this risky security. Already I have 4 security in my portfolio. Cumulatively, I call this a risky portfolio. RP and a risky portfolio. I bring in risk-free asset. Agreed? So existing portfolio is there. I'm bringing in RF. Agreed? Now what they say, I don't know what is the amount or proportion of this risk-free asset to total asset. Okay, see, very simple. You will combine all the risky asset. This is the risk of the portfolio, which means the risky portfolio's proportion. This is RF's proportion. Now what you should do, let the proportion of risk-free security as the target beta 0.91 should be P. Okay, let us assume that the proportion of the risk-free security to the total assets be P. This is P. Assume it to be P. I don't know what is the proportion. I need to find out now. What is the proportion amount? Okay, I need to bring in. First, I need to find out the proportion. Now, if this is P, this will be 1 minus P. All the proportion cumulatively combined, I call it as risky asset proportion. This is 1 minus P. Now, the total weighted average should be 0.91. This is one thing. And what is the beta? Beta is what? Portfolio beta is nothing but weighted average beta of the individual securities inside the portfolio. Are you all agreeing this? Weighted average beta of the individual securities inside the portfolio. Correct? RF, what is the beta of risk-free security? Already I told you, beta of risk-free security is what? 0. Because no correlation with market. There is no relation to market. Okay, market doesn't decide how risk-free asset move. Are you all understanding? So, 0 is the beta for risk-free asset. Now, 0 into P, weight of risk-free asset is P into, okay, what is that? What is that? risk-free security is beta. So weight of risk-free security into beta of risk-free security plus weight of the risky asset, which is 1 minus P into beta of the risky portfolio, just the portfolio. See, sir, weighted average beta of the individual security you told, you're taking portfolio, don't worry. For computation, I have clubbed this, na? Okay, I clubbed this, all the risky security I have clubbed and put it as, okay, one single security, 1 minus P is the weight into 1.3. 1.3 means what? 1.3 is the beta of existing risky portfolios beta. You take it, okay, it'll multiply with, what is that? Weight of risky portfolio, which is 1 minus P. Are you all understanding? Up 0 into P will be 0. Up 1.3 into 1 minus P is equal to 0.91. You want your beta to be how much? 0.91. You equate it, you will get 30% as proportion of risk-free security and 70% proportion of risky security. Are you all understanding? So which means existing 100% risky security you have now, out of this total 100%, remove 30% of this risky asset and add 30% risk-free security. Are you all understanding? So what is to be done now? Shares to be disposed of to reduce the beta to bring it to, okay, this much. 5,000 is the total portfolio value. Agreed? See what is happening. Value of total share portfolio is 500 lakhs in this question. Okay, 1 second, is not loading. Okay, there's some error. It is slow in loading, hence the disturbance. See again, thing is coming. It takes time to load. I don't know what the issue. Here they've given that, okay, what is the value? You see the last column, total value, market value 5,000 lakhs. Out of this 5,000 lakhs, 30% you remove and bring in risk-free security. So total risk-free security to be acquired, 5,000 into 30%, how much is that? 1,500 lakhs. 5,000 into 30%, 1,500 lakhs. This much you need to acquire. Now the point here is, okay, how much you need to sell each security in order to acquire this much? Question arises, na? That you need to see the proportion, which means existing proportion 30%, 60%, 10%. Okay, you need to proportionately exist. Now, can I use different proportions? Possible, but ideally, whatever proportion you have bought in these security, in the same proportion, okay, you should do to not alter the, okay, risky portfolio value, which means 0.3 into, okay, what is the 1,500 lakhs you need to bring up? Adila 0.3 into 1,500. How much is that? 1,500 into 0.3. 450. 450, you will sell 450 lakhs worth of share of A Limited. Then 0.6 into 1,500. How much is that? 0.6 into 1,500. You will sell 900 worth B Limited share, and then 500 into okay, 1,500 into 0.1. How much is that? 150 lakhs worth C Limited. Like this, you will sell partially and you will get the balancing. Are you all understanding? See here, number of shares of the each company to be disposed of. So share A Limited, B Limited, and C Limited. Proportion I keep same proportion. Okay, proportionate amount. This total comes to 1,500 lakhs, which you decided to sell. Are you all understanding? This 1,500 lakhs is the total amount. 30% goes off from the overall portfolio, 5,000. Okay, 1,500 lakhs. And 1,500 lakhs, 450 will sell A Limited, B Limited 900, and C Limited 150. This is the price per share. Hence, number of shares to be sold. This is 0.9 lakhs, 90,000 shares of A Limited. 1,20,000 shares of B Limited you need to sell, and 60,000 shares of C Limited you need to sell. Are you understanding? And acquire the risk-free asset, okay, to bring in portfolio beta to 0.91. Next, number of Nifty contracts to be sold. Next, they've asked the number of Nifty contracts to be sold. Now, this is all about risk-free security. I come back to futures. Two options given now. Now, futures first. How many contracts you need to sell to make the portfolio beta, bring down the portfolio beta to 0.91? Are you understanding? You should not, if you see the cash market value is there into beta, if you do the total beta, portfolio beta 1.3, we computed in the first system. If you multiply the portfolio beta in cash market value, you will get the total futures market value. This is, okay, the amount to be hedged if you want to bring down the portfolio beta to 0. But you don't want full hedge. What they say, keep the portfolio beta to reduce the portfolio beta to 0.91. In that case, what formula you will use? Cash market value to beta minus target beta. Beta minus target beta, which is 0.91. So what they do is that 1.3 minus 0.91 into 5,000 lakhs cash market value. Okay, this is the total value of the futures contract. 5,000 lakhs. That 1950 lakhs. So 1950 lakhs divided by 8.2125 futures price into lot size will give you number of contract 120 contracts. Are you all understanding? Because number of contract into lot size into futures price will give you total numerator, other total contract value. Now total contract value divided by futures price into lot size will give you number of contracts. Are you all understanding? Next, 2% Nifty is accompanied by, okay, this is the important main adjustment. Why I want to discuss the question is getting it is not loading. Okay, now see the question, the last part of the question, read it again. Okay, the number of shares each company to be disposed of, already we know. Number of Nifty contracts to be bought and sold, yes, we discussed 120 contracts. Last part of the question, the value of the portfolio beta for 2% rise in Nifty. Your portfolio beta for 2% rise in Nifty. This is a question that is being asked. You tell me, if what they asking, if value of the portfolio beta, existing portfolio beta is 1.3, agreed? What will happen to this portfolio beta if there is 2% rise in Nifty? Nifty increases by 2%, what will be my overall impact in the portfolio beta? Okay, see. If 2% rise in Nifty, Nifty increases by 2%, what will be my total increase in the beta portfolio in 2 into 1.3%? Generally, if Nifty increases by 2%, your portfolio value will be increased by how much? Because your portfolio beta is 1.3. So Nifty into beta, okay, this many times your portfolio will increase. How much is the portfolio share will increase? Share portfolio will increase to 2.6. Are you listening? So share portfolio will increase to 2.6. This is the yes. Share portfolio will increase 2.6. Agreed? Now, tell me children, what happened? Current value of portfolio of shares is 5,000 lakhs. Are you all having any doubt? No. Value of portfolio after the rise, which means 2% rise in Nifty will raise the my portfolio by what? Beta. What is beta? Beta captures the change in security or portfolio return divided by change in market return. For every 1% change in the market, my portfolio value will be changing by 1.3. This is what is the value of the beta. Agreed? So which means for every 1% change in Nifty, 1.3 means Nifty in the question given how much? 2%. It will Nifty will be increasing by 2%. What will be the increase in portfolio? 2.6%. Are you all understanding? Which means current portfolio is 5,000 lakhs into 102.6. Okay, this will be the value of portfolio. If Nifty rises now, what will happen to portfolio? It will rise by 2.6%. 5,000 into 102.6. How much is that? 5,130. Are you all understanding till now? If Nifty rises by 2%, yes, my portfolio will rise. Share portfolio will rise. But the problem is, okay, my when Nifty rises, see what happens initially, you have taken two position. Cash market, you have taken the position, long position. Correct? Futures market, to hedge this, okay, you have taken a short position. Short position. You have sold the futures, sold the shares in the futures market. Now, when you have taken long position and the share price increased, you will have profit in the cash market. That is what happened here. Cash market, the price portfolio, share portfolio value increased 5,130. But futures, you have taken short position to hedge the portfolio. You have taken short position, sold, and the price increased because Nifty increases. Spot Nifty increased. Because of this, spot futures will also increase. Are you all understanding? That is basic thing. If spot price increases, asset spot price increases, futures price will also increase. Are you all listening? So futures price will also increase. In this question, actually speaking, conceptually, the futures price increase or decrease may not correlate with the spot price, even if Nifty futures there. Nifty raises by 2%. Nifty futures may not raise by same 2%. Okay. Now what they say, even though it will not happen conceptually, but here spot Nifty question, the ICA have taken assumption, if spot Nifty increases by 2%, Nifty futures will also increase by 2%. Are you all understanding? If Nifty futures increase by 2%, you will have 2% loss in the futures market. This you have to compensate. Mark to market, okay, mark to market margin money you have to compensate, because loss in the futures market. Now they will deduct the margin account. What is the futures price? 8,125 into 2% margin money will be gone, because futures price reduced by 2% into 200 lot size into 120 number of contracts. This is what you took to hedge the position. So 39 lakhs will be wiped out by way of mark to market procedure. Even though share price from 5,000 increased to 5,130, from there you will reduce 39. From there you will reduce 39, because it will be gone by way of mark to market procedure, MTM, and the balance amount, overall balance amount of the portfolio, okay, combining cash as well as the share portfolio, will be 5,091. Change in value of the portfolio is how much? Okay, how much it dropped? Really speaking, earlier your portfolio value was 5,130, 5,091. Sorry, 5,000. See here, I'm writing 5,091. Agreed? Now, earlier value was how much? 5,000, which means how much it increased? 91. Really speaking, it has not increased by 130, because 39 got wiped out. So only 91 rupees it is increasing. This 91 divided by 5,000, from where it increased? From 5,000, it increased 91. In percentage terms, how much is the increase in the value? 1.82. Actually speaking, in the value is 1.82, which means Nifty raises by 2%. Okay, what is the value of my entire portfolio changes? Not 2%. It is actually changes by 1.82%. What is the beta then? Very simple. Beta is change in portfolio return. Portfolio return divided by change in market return, which means 1.82 divided by 2. How much is that? 0.91. This is the beta. This is the beta. Are you all understanding? Very, very important question. Market, this adjustment is very, very important. Practice 1 or 2 times, you will get comfortable. Okay, only assumption is that when spot Nifty changes by 2%, Nifty futures also changes by 2%, is the assumption taken by ICA, but it will never happen. Okay, spot Nifty and other spot market, when price increases, futures price will also increase, but the percentage increase will never be same. Are you understanding? Okay. Anyway, this is all about this question. Shall we move on to the next question? See, I'll try to fix the issue and come back. So I'll try to fix the issue. Okay, not properly showing. Okay, let us start discussing the last question in the future segment. That is question number 27, commodity futures related question. Company is long on 10 MT of copper at 534 per kg and intends to remain so for the ensuing quarter. The variance of change in its spot and future prices are 16% and 36% respectively, having correlation coefficient of 0.75. The contract size of one contract is 1000 kgs. Calculate the optimal hedge ratio and for perfect hedging in future market. First, optimal hedge ratio. See, you have exposure in spot market. How much I need to take exposure in futures market so that my cash market position will be hedged? This is what they are asking in the first segment. Next, advise the position to be taken in futures market for perfect hedging. Determine the number and the amount of the copper futures to achieve a perfect hedge. This is the question that is being asked. Now, first, okay, computation of hedge ratio. See, in the equity chapter, we have something called as beta. Portfolio chapter, we are going to learn beta. One of the formula is beta. What is the formula? Okay, sigma S by sigma M into correlation of S and M. Are you all understanding this formula? We study in portfolio management chapter. There are 6 formulas. This is correlation based formula. 3 formulas, regression based formula. This is correlation based formula. This hedge ratio is something similar to this beta. This is not beta, but something similar to beta. Are you all understanding? See, So what should be the hedge ratio? Very simple. Sigma, okay, here I will trying to, okay, sigma, yes, sigma, yeah, sigma S, which means, okay, sigma of change in spot price. Here I have to say this is standard deviation of change in spot price. I simply write it as, what does S mean? Okay, change in spot price, change in spot price. So sigma, standard deviation of change in spot price, divided by sigma, okay, or standard deviation of change in futures price, change in futures price. Are you all understanding? This is the hedge ratio for into correlation of, okay, spot and futures, correlation of spot and futures price. Okay, will give you this will give you the hedge ratio, coefficient between change in spot and futures price. Okay, this change in spot and futures price will give you the hedge ratio. Very simple. Here what they've given in the question, okay, here they've given 16 and 36% as the, okay, the variance, correct? Now, variance, now standard deviation, how to compute standard deviation from variance? Square root. So 16 square root is how much? 4. Then you have 36, square root is 6. So 4 by 6 is there, na? This is change in spot. This is this is standard deviation of change in spot, 4. Divided by standard deviation of change in futures is 6 into 0.75. 0.75. How much is that? 4 by 6 into 4 divided by 6. Okay, 0.5. This is the hedge ratio. 0.5 is the hedge ratio. Are you all understanding? There's some issue here. Okay, anyway, this is 0.5 is the hedge ratio. Please wait, I'll just reopen, close and reopen the. Okay, now can you see this? Here, the hedge ratio I need to compute. Hedge ratio is nothing but, okay, sigma, okay, change in spot price, sigma of change in spot price divided by sigma of change in futures price into correlation of change in spot and futures, correlation of change in spot and futures. Now they have given this, they have solved it, we already got that number as 0.5. Next, see what is the strategy to be taken here to achieve a perfect hedge, what they are asking. Okay, what strategy you will consider to hedge perfect? Very simple. Yes, since the company is long position spot market, cash market, it has long empty na, and it shall take the short position in futures market. Okay, corresponding opposite position to hedge the position, it will take futures market. Okay, since contract size, one contract size is 1000 kg, number of contracts to be short. Okay, that is the third question. What they're asking, number of contracts to be short sold. How much is that? 10,000 kgs divided by 1000 kgs into 0.5 hedge ratio. You will get 5 contracts. Are you all understanding? So amount to be hedged, number of contract 5 into 1000 into 534 into 534, you will get this much, 26 lakh 70,000. 70,000. 534 is the Okay, it is the price. It is the future price. 534 is the future price. Okay. Anyway, this is the question that is being asked. Okay, I'll try to fix this issue. Then we'll come back. Since there was a disturbance in the last segment, we'll quickly see again. Determine the number and amount of the copper futures to achieve the perfect hedge. Very simple. The first part we computed, hedge ratio is 0.5. Are you understanding? Next, advise the position to be taken. Short position to be taken. Now, determine the number and the amount of copper futures, which means the contract value as well as number of contract. Okay, amount of the copper futures to achieve the perfect hedge. Very simple. What is the spot exposure? 10 MT copper, 534 per kg. Okay, which is okay, 1000 MT into 10, that 50 lakhs 40,000 is the spot exposure. Are you all understanding? 50, yes, 53 lakhs 40,000 is the spot exposure. Okay, now what is happening here? Okay, since the contract size is 1000 kg, one contract size is 1000 kg, number of contract to be short, 10,000 kgs, okay, divided by 1000 kgs, 10,000 kgs divided by 1000 kg into 0.5 hedge ratio. Okay, 0.5, if you do it, you will get the number of contract. Very simple. Number of contract 5 into 1000 lot size, 1000 kg per contract into 534 is the price. Okay, you will get 27 lakh 70,000. This is nothing but 53 lakhs 40,000 divided by 2. Hedge ratio is a perfect hedge. So hedge ratio, simply you can divide it, 26 lakh 70,000. This is the amount to be hedged, and the number of contracts is 5 contracts. Are you all understanding? Okay, this is the question. With this, we are through with the futures. All the questions been discussed. Now, shall I move on to options? Okay, see. Option, basic question, call and put option, payoff question. Basic payoff question. See, a call and put exist on the same stock, each of which is exercisable at rupees 60. They now trade for market price of the stock or stock index is 55. Market price of the call option is 9 and market price of put option is 1. Are you understanding? So market price of the share underlying asset is given as 55. Market price of call is given as 9 and market price of put is given as 1. Calculate the expiry date cash flow, investment value and net profit. These three you need to compute. Okay, when you buy a call, write a call, buy a put, write a put. Are you all understanding? Write a put, na sell a put. Okay, writing a put means selling a put. For different FSV, this is expiry date stock price. If you have lectures or revision videos, you would have understood this. Expiry date stock price means nothing but FSP. My students know this is FSP. Are you all comfortable? Which means future spot price. This I call it as future spot price. On the date of exercise or maturity date, I compare this with exercise price, this FSP with exercise price, and decide whether I'll exercise or lapse it. Now, very simple. Now, tell me, children. For varying FSP, they have given 50, 55, 60, 65, and 70. Okay, first we will compute the expiry date cash flow. First expiry date cash flow. First segment. Okay, they have asked all these things now. First expiry date cash flow. This they have asked. Then they have asked investment value. Then you have net profit. Net profit to be computed. So first take expiry date cash flow. Share buying and selling. Very simple. What happened? Buy one call. Okay, buy one call. If you had bought one call for 50 rupees, 55 rupees, 60 rupees, 65 rupees, 70 rupees, varying FSP. Tell me, children. You have bought one call having exercise price of what? What is the exercise price of this call option? Exercisable at 60 rupees. The exercise price is 60 rupees. So, you have a right to buy the share. Okay, a share worth 50 rupees. You have right to buy the share at 60 rupees. Will you pay a higher price and exercise your right? Call option means what? Your first option, buying one call. Buying one call means you have bought a call. Call option gives you right to buy the share, right to buy the underlying asset, which means if you have taken a call option, you will get the right to buy now. A right to buy share worth 50. This is the FSP actually trading in the market at 50 rupees. On the date of maturity, the share price is 50. A share worth 50, you have exercise price at what? 60. It is exercisable at 60 rupees. No fool will pay extra, okay, and exercise the right. if you go to open market, you will get it at 50. Why you will exercise? You will never exercise. So, okay, the expiry date cash flow will be nil. Expiry date cash flow will be nil. Why? You will never exercise. You will never exercise. Okay, this is expiry date cash flow means very simple. For a buyer of the call option, the expiry date cash outflow or inflow? Outflow. Are you all understanding? If you exercise, it will be outflow. If you don't exercise, it will never be any outflow. Are you all understanding? Now, sir, I paid premium as a call option holder. I will pay premium now. No, this premium is not expiry date cash flow. Premium when you pay, you will pay upfront. So this will not come under expiry date cash flow. Are you all understanding? Net profit, I will adjust the premium that I later see. Are you all listening? So for 50 rupees, I will not exercise. Next, 55. A call worth 55, exercisable at 60. Will I exercise a lapse? Lapse. So no cash flow. 60, I will lapse. 65. Now listen. A share worth 65, exercisable at 60 rupees. Will you exercise? Yes. 5 rupees. Okay, I will enjoy the profit, so I will exercise. If I exercise on the maturity date, what will be my cash flow? 60 rupees. Will be my cash flow. Next, 70 rupees. Yes, exercise. I will exercise. 60. Here also 60. Here also 60. Don't get confused. This 60 is just the expiry date cash flow. If you exercise, what will be your outflow? Minus 60 means outflow. Are you all comfortable with this step 1? Okay, same. Write one call option. Now tell me, children, if you have written one call option initially, which means you are call option seller or buyer seller. Now, a share worth 50, exercisable at 60, will the holder of, decision to exercise or lapse is will vest with whom? Holder of the option. Holder of the option will only decide whether to, buyer of the option will only decide whether to exercise or not. The choice is not for the seller. If the buyer exercises, this party, the seller will have obligation to buy, will have obligation to sell. If buyer, exercises right to buy, the seller will have obligation to sell. Are you all understanding? Which means a share worth 50, from the buyer's perspective, think like this. A share worth 50, exercisable at 60. Will the buyer exercise? Will never exercise, it will lapse. When buyer lapses, okay, if you have written a call option, will you have expiry date any cash flow? Nothing will be expiry date cash flow for the seller. Are you all understanding? First 3 cases, there will be no cash flow. In the 4th year, when buyer exercises, he will pay 60 rupees. This will be outflow for the buyer and this will become the inflow for the seller. Are you all understanding? When you write the call option, sir, you should not ask, sir, for writer, only premium is received. What is the 60 rupees? No, this is just exercise price he will pay. For this consideration, this is just a consideration for buying the share. This is consideration for buying the share. Option premium they would have paid initially. This is consideration for buying the share. For this, sir, 60 rupees is the income. What I do now, I will give back the share. I will give back the share to the other party. Are you listening? This is next, buy one put option. Next option. What is the next option? Buy one put option. Tell me, children, if you have bought one put option, a share worth 60, right to sell at 60, will you share worth 50, right to sell at 60, will you exercise? Yes, I will exercise. Which means as a put holder, I will exercise. Okay, if I exercise now, inflow, outflow, inflow. This is only important because right to sell, you are selling, exercising means right to sell, which means you sell the share and receive the 60 rupees cash flow. Are you all comfortable? Okay, here you will lapse, right? Share worth 65. What is that? A share worth 60, right to sell at 60. No phone will exercise. A share worth 65, right to sell at 60. Will you exercise or never will exercise? Are you all understanding? Next, write one put option. The same opposite na? Yes, right. You have written one put option. A share worth 50, exercisable at 60. Will the put option holder will exercise or lapse? Exercise. If he exercises this, okay, he will exercise right to sell. He will sell, and the writer of the put option will have obligation to buy, which means it will be outflow for the writer of the put option. You are comfortable? All this I've given. So if you don't understand the basic discussion, call option, put option, basics, code, if you don't understand this discussion, okay, it means that your basics are not strong. Basics are not strong. I cannot explain everything here. Okay, you can go through the revision video. Just watch the first 20 minutes or half an hour. You will have absolute clarity regarding the instrument, call option, how to think about it. Okay, because if I go and discuss all these things, so many questions are yet to be discussed. Okay, will be delayed. Hence, I am not discussing now. Next, expiry date investment value. Next, expiry date investment value I will find out. Very simple. A share worth 50 rupees, I have right to, okay, see, a share worth 50, I have right to buy at 60. What is that? 1 second. Yes, this is a FSP. And what are they asked? 50, 55, 60, 65, 70. Well, so a share worth 50, exercisable at 50, if the call option holder exercises, he will not exercise. If he doesn't exercise, there will be no expiry date investment value. There will be no expiry date investment value. Are you all understanding? Now, in this case, if you take a share worth, fourth case, a share worth 65, exercisable at what? Exercisable at what? Are you all understanding? Exercisable at 60. Okay, what is the what is the exercise price? 60. Sorry, what is the exercise price? 60 rupees. A share worth 65, exercisable at 60. You pay 60 rupees and you bought the share worth 65. Now, what is your value of investment? Very simple. Outflow is 60 rupees. Incoming, you are taking the shares. Share is worth 65. So 5 rupees, you have the investment value, extra investment value. Are you all understanding what I'm trying to say? Okay, you may ask, sir, investment value should be 65 because you have share 65. No, outflow was there. Now you paid cash to the extent of 60. So effectively, you are getting 5 rupees as the investment value. Are you all understanding? This is what is called as investment value. So what option value? Option value is nothing but FSP minus X. Call option value is FSP minus X. Put option value is nothing but X minus FSP. This I have explained you detailed in the revision videos. Okay, now. Then the call option, a share worth 70, exercisable at 60. Will he exercise? Yes, buyer will exercise and investment value will be 10 rupees. Investment value will be positive 10 rupees. Are you all understanding? Same way, writer of the call option. Okay, you can go through the writer of the call option. Opposite position will be there because he's writing now, which means a share worth, what is that? 65. Okay, the writer has obligation to sell at 60 rupees, just 60 rupees, he is making a loss. Hence, this is minus 5 and minus 10. A profit for the buyer will be loss for the seller. Next, buy a put option, write a put option. Here also, if you see, okay, a share worth 50 rupees, put option buyer will have right to sell at 60, higher amount. Okay, so the profit will be 10 rupees, 10 investment value in profit from the investment without considering the P and L, without considering the net profit. What is that? Initial premium I have not deducted. See, first step, the expiry date cash flow is nothing but inflow or outflow on the date of expiry. Second, they are asking now investment value is nothing but the value of option, which is without discounting X minus FSP or FSP minus X. FSP minus X. Now, this FSP minus X without deducting premium is called as investment value. Are you all understanding? Next, net payoff is there, net profit, net payoff. That will be net profit. Ultimately, you will gain or loss, you will be computing after deducting the premium. After deducting the premium amount. Are you all comfortable? See here. See here, stock price is given. Write one, buy one put option. A share worth 50. Okay, I have right to sell at 60 rupees, profit of 10 rupees, profit of 10 rupees. Okay, like this, you can see the right one put option also, no issues. Next, expiry date, net profit, net payoff is there, very simple. What I do is that 50, 55, 60, 65, 70 is there, net profit. A share worth 50, exercisable 60, I will never exercise, I will lapse. So value of call will be 0, value of call will be 0. But I would have paid a premium. Call option premium is 9 rupees. Here I am computing net payoff. Net payoff is nothing but net payoff is nothing but, okay, the value of the call, FSP minus X. This is value of the call. This is value of call minus premium. The value of call is nil because you will never exercise. So value of call will be nil. Premium you will deduct. Suppose nil, 0 minus 9. Minus 9 is the, okay, net payoff amount. Are you understanding? A call option holder will net profit as T. This is an accounting number. This is an accounting number I told you because premium paid, if you see, not considering time value of money. Actually speaking, the value, okay, FSP minus X actually is derived from the various models are there, binomial model, Black-Scholes model, everything tries to, okay, explain the value of the call as of today. This current market value, the current fair option value. Now, the FSP value is the FSP minus X is there. This is value on maturity. This is value on maturity. If I discount and bring it to present value terms, it will be fair value of the option. Now, anyway, in the net profit computation, okay, see, even though the FSP minus X is happening on the maturity date, the spot date, the trade date, you are paying the premium upfront. These are not as such comparable. You cannot simply deduct the 9 rupees from FS value of the call. But again, this computation is net of accounting number. Here, I don't consider the finance aspect. Hence, this is net payoff 9 rupees. Are you all understanding? Okay, next 55 rupees, 9 rupees the net payoff. Like this, 9 rupees will be the net payoff. Here, 65 rupees, 4 rupees will be the net payoff. How? Very simple. A share worth 65. I have right to buy it 60 rupees. I will exercise my right and gain 5 rupees from the value of the call. Minus 9 rupees. Okay, how the premium paid? So minus 4 rupees. This is how you should understand this net profit, net payoff. Next, 70 rupees is there. A share worth 70, exercisable at 60, 10 rupees you make payoff from the value of the call is equal to 10 minus premium. Premium paid how much? 9 rupees. So total net payoff is how much? 1 rupee. That is what the positive 1 rupee. That is what they have given. For like this, you can go through for each and every aspect. It will be same. Okay. Now, take question number 29. Question number 29. You as an investor had purchased a 4-month call option on the equity shares of X Limited of rupees 10 each, of which the current market price is rupees 132 and the exercise price is 150. Okay, what is this 10 rupees? Okay, equity shares of X Limited of 10 rupees. No? This is the call option premium. Are you all understanding? You expect the price range between 120 to 190. The expected share price of X Limited and related probability is given below. Now, this person expects that, okay, the share price on the future date will be 120 to 190. But I don't know what will be the maturity date share price, but given probability, it may be 120. There is a 5% chance. Okay, there is a 5% chance to become 120, there is a 20% chance for the share price to become 140, and there is a 50% chance for the share price to become 160, 180 and 190, 10% and 50% given. Now, compute the following expected share price at the end of the 4 months, which means this is expected share price means on an average, what is the price expected, weighted average price. Okay, very simple. 120 into 5%, 140 into 20%, 160 into 50% plus 180 into 10% plus 190 into 15%. Just apply the respective probability and find out the average price, expected price. Okay, at the end of 4 months. This is nothing but expected FSP based on probability. How much is that? 160.5. This is the first part of the solution. Next. Value of the call option at the end of 4 months if the exercise price prevails. Okay. The value of the call option is nothing but, I told you, FSP minus X. This FSP is nothing but maturity date spot price. Now, for example, this call option is for 4 months. Assume this call option is for 4 months. At the end of the 4 month, what is the FSP? In this case, the expected FSP you will find out, then minus X strike price will give you the call option value. Are you understanding? Now, what they say, if the exercise price prevails, means, listen to me friend, what is the understanding by reading the question? What is the value of the call option at the end of 4 months? If the exercise price prevails means, the future spot price becomes exercise price. The future spot price is equal to exercise price. Exercise price, the future spot price becomes exercise price. What is the future spot price? Very simple. Okay, here if you see, 150 is the future exercise price, and future spot price also becomes 150. They are saying, what they are saying, the exercise price is 150. Yeah, this 150, okay, will be the future spot price. On the date of maturity, 150 becomes the spot price. In that case, what happens if exercise price prevails? What happens to the call option? FSP minus X. Okay, 150 minus 150, nil. Are you all understanding? Very, very important. Okay, the value is 150 minus 150, nil. Next, 0 is the call option value. Okay, if the option is held, what is the third part? Okay. In case the option is held to its maturity, what will be the expected value of the call option? Right. what they are saying in the third part. If option is held till maturity, if the option is held till maturity, what will be the expected value of the call option? Value of the call, see, very simple. If 120 is the share price, you don't know what will happen tomorrow. If 120 in the share price, okay, what will be the value of call? Exercise price 150, call option will never be exercised. Are you listening? So value of the call at this point will be 0. Here also it will be 0. Here, what will be the value of the call? A share worth 160, exercisable at 150. Now, value of the call will be 10. Here, value of the call 30, FSP minus X. Here, value of the call will be 40. Agreed? Now, but the probability is there. You have to multiply with respective probability and find out expected value of the call, because this is not sure. The value of the call may be 10, maybe 30, maybe 40. There's a probability attached to it. So I'll find out value of the call option. Are you all understanding? If the option is held till maturity, the expected value of the call option, market price is 2020. Whether exercise or not exercise, decision whether you will exercise or not exercise, you will not exercise. Actually, it should be. What is this? This is a value of put. Whether this is call option or put option. This is call option. Market price 120. Now, exercisable, we will expect. No. This is lapse. This, see, there is a printing, the typing error. This is lapse. This should be lapse, because share worth 120, exercisable at 150. Holder will lapse here. Lapse value will be 0. Therefore, value will become 0. Are you all understanding? Here also, in case 140, if it is 140, it is lapse. Sorry, this wrongly given lapse. This also lapse. First 3 cases lapse. Last 2 cases exercises. Wrongly given exercise. This is also exercise. Are you all understanding? So a share worth 140 exercisable at share worth 40 exercisable at 150. I will lapse. A share worth 160 exercisable at 150. 150 or 160. What is the exercise price here? 1 second. What is the exercise price? Yes, a share worth 160, exercisable at 150. Yes, I will exercise. Third case, I will exercise. This is not lapse. This is correct. This is correct. See, that is the problem. Not, this is correct. This is exercise. These 4 entries are wrong. This one is correct. Share worth 160, exercisable at 150. Exercise, lapse, exercise. What is the value of the call? FSP minus X, 10 rupees. Then you have weighted average call. This is value of the call. Or third option, 50% chance. What is the probability attached to it? 50%. So value of the call is 10%, 10 rupees into 50%, 5 rupees. Are you all understanding? This is expected value. Now here also 30 rupees, probability attached 10%. So 3 is the expected value. 40 rupees is there. 1.15 is the probability, 15% is the probability, 6 rupees. Total expected value, 5 plus 3, 9 plus 6. 5 plus 3, 8, 8 plus 6, 14 rupees. Are you all understanding? 14 rupees is the expected value of the call. Next. Shall I move on to the next strategy? Long straddle. This strategy is called as long straddle. Anyway, the question you don't need to, find out whether it is straddle, strangle, butterfly strategy. Those things are irrelevant. Name is irrelevant. Just read the question. What is the payoff? Try to understand the payoff. See, the equity share of VCC Limited is quoted at rupees 210. A 3-month call option is available at a premium of 6 per share, and a 3-month put option is available at a premium of 5 per share. Call option premium is different, put option premium is different. Ascertain the net payoffs to the option holder of a call option and a put option. The strike price in both the cases is 220. Strike price both the cases same. The share price on the exercise day is 200, 210, 220, 230, 240, which means share price on the exercise date, maturity date, is called as what? When will you exercise? European call option, only exercisable on the date of maturity. Which means I will assume that that is a fact. It is nothing but FSP. It is nothing but future spot price. Now, tell me, Chandra. Now, you have net payoff. What you have to find? Net payoff in case of different, strike price, 200, 210. This is strike price on exercise day, 210, 220, 230, and 240. This is not strike price on exercise day. This should not be strike price, because outflow will be the strike price. You are call option buyer, na? So this is correct. This is correct. Here, it is not strike price on exercise day, share price on exercise day. Share price on exercise day. Here, given, na? See, the share price on exercise day. This is not strike price. Sorry, it is the typographical error. This is Share price on the exercise day. Okay, not strike price. That is why I was confused. Okay, no issue. Now, share price on exercise day is how much? 200, 210. These are all FSPs, future spot price. This I call it as future spot price. Now, very simple. Share price on the date of maturity is 200. A share worth 200, exercisable at what rate? What is the strike price? What is the strike price? Okay, strike price in both the cases is 220. Very simple. Here option, call option holder and a put option. Okay, we have to find call option payoff as well as put option payoff. First to take call option payoff. A share worth 220, exercisable at a share worth 200, FSP 200, exercise price is 220. Will you exercise? You will not exercise. Here also you will not exercise. 220 na same price, I will not exercise. No use. 230 na, yes, I will exercise. At 210, I will outflow is 220. Net payoff is how much? Okay, net payoff is 10 rupees. And premium paid is 6 rupees. So total net payoff will be 4 rupees. Are you all understanding? Very simple. A share worth 230, exercise at 220. How much is the value of the call? Value of the call is 10 rupees minus premium paid. Premium, how much? 6 rupees. So what is the okay net payoff? 4 rupees is the net payoff. That is what is given. Are you all understanding? Total outflow they have given accounting number. That's why they have clubbed the initial premium amount of 6 and the 220 outflow strike price. Are you all understanding? Okay. Anyway, you just need to compute this. Like this, you can find out value of the call minus premium. Next step. Next situation, a share worth 240, exercisable at 220. Exercisable at 220. Now tell me, okay, what is the value of the call? Value of the call will be 20 minus premium 6 rupees. So 14 is the net payoff. 14 is the net payoff. Here I have given 14 is the net payoff. Are you all understanding? So next we will proceed to put option. Tell me children, put option, what is the this is not strike price again, this is share price. Share price on exercise day. Share price on exercise day. Now, a share worth 200, exercisable at what? Exercisable at 220. You tell me, a share worth 200, right to sell at 220 as a put holder. Will you sell or will not sell? Will sell, obviously. Yes, I will exercise my put option and I will gain. Value of the call is now 220 minus 20. Value of the call is 20 minus premium is 5, I think, for put option. So 50 is the net payoff. Like this, you need to compute. Are you all understanding? Okay, even though this presentation is just given for understanding, you can just write. See, the share price on exercise day 210. Strike price 220. A share worth 210. Exercisable at 220. Sellable at 220. Will you sell? Yes, you will sell as a holder. Now, how much is the value of the call? Value of the put? Value of the put is equal to 220 minus 210. How much is that? 10 rupees. Minus premium paid. Premium paid is how much? 5 rupees for the put option. So 5 is the payoff. Like this, you can directly find out. Here you will lapse. Here you will lapse and lapse. Put option. Okay, holder will lapse when the future spot price is more than the exercise price. Are you all understanding? So this is there. Anyway, 5 rupees the minus 5, minus 5, minus 5. This is the payoff. Okay, shall we move on to option valuation model? Okay, core discussion starts in the option segment. Option valuation model. There are predominantly three broad valuation model. That is, okay, we have riskless hedge portfolio method. We have binomial model, wherein inside the binomial model we have two methods. One is riskless hedge portfolio method. Riskless hedge portfolio method. Broadly, okay, I can also call it as binomial model. Okay, this is binomial model only. Then we have risk neutral method. We have risk neutral method. These two methods are there. Apart from that, okay, the two-period binomial tree is there. Two-period binomial tree. Then there is LogicSchool's model. So 4 models are predominantly there. We are going to discuss. See what happens here. I will take this question as an example to make you understand both the models. Okay, riskless hedge portfolio method as well as risk neutral method. See, I will tell you here. We have binomial model. Binomial model. In this binomial model, there are two methods. Riskless hedge portfolio method. Portfolio method, and there is risk neutral model. Risk neutral model also they call method. Risk neutral method. Both are cumulatively called as binomial model. Both are cumulatively called as binomial model, but interchangeably used in the question. Sometimes in the exam paper they tell just simply binomial model. Binomial model versus risk neutral model. In this case, what you should assume? Okay, they by the word binomial model, they are meaning they want to communicate that use riskless hedge portfolio method and you have risk neutral method, because both separately given in the question. Understand? If separately question is asked, See, till November 23 examination, what they used to, either they used to simply give the question and ask you to value. People, used to do the risk neutral method and solve the question. It's possible and they will award marks. Or simply they use the wording hedge method, hedge portfolio, riskless hedge portfolio method they mention in the question. In that case, you will solve using riskless hedge portfolio method, no problem. What happened? In the November 2023 examination, first time what they do, they asked both binomial model as well as risk neutral model. Binomial model in the sense riskless hedge portfolio method and risk neutral method, they combined in one single question and they've asked everything. Like they asked the riskless hedge portfolio, value of the call based on the riskless hedge portfolio method. Then they've asked us to value the call based on risk neutral method. And they have also asked what is the difference between these two methods, whether solution will be same or different. Everything they have tested. Are you all understanding? So understand both of these are binomial model. So, really speaking, from one only, other one derived. Really speaking, the answer will tally. Both the solution will match, which means the value of the call found out under riskless hedge portfolio method will be same as risk neutral method. But the process is different. How you hedge the portfolio is totally different. Shall we? Okay, now we are going to learn one by one. We will read the question, understand the facts of the question. November 23, very good quality question, comprehensive question. If you solve this one question in practice, that is enough for both the models. Are you all understanding? Say. Now, following is the information available pertaining to shares of Omni Limited. Current market price is given as 420. Strike price. Current market price is what? Spot price. Current spot price. Spot price is given as 420. Strike price 450. Maximum price expected 3 months time 525. Minimum price expected in 3 months time is 378. Continuously compounded rate of interest is 8% per annum. And e to the power RT. 1.0202. This they have given. Directly you can use the e to the power RT. Don't worry about what is the maturity period. 3 months time is there, but they have directly given the value itself. They have given the e to the power RT. Are you understanding now? From the above, calculate the 3 months call option by using binomial method and the risk neutral method. By using binomial method as well as risk neutral method. Are the calculated value under both the models are same? Next question. Next, state also clearly the basis of valuation of options under this model. Theory based question, no issue, I will clarify. These are all the questions that is being asked. So first, calculate the 3 months call option by using first binomial method, risk neutral. Here they have clearly mentioned binomial method, risk neutral. Sir, you only told both are same method. Why you are using different name? Now don't worry. Institute if uses different names for these method, what you should understand, you should solve binomial method using riskless hedge portfolio method. Riskless hedge portfolio method. In this case, clearly risk neutral method is given. So under both the method we will solve and then compare the result. Shall we? The binomial model basic assumption. I'll tell you briefly what it is. Very simple. Binomial model assumes, be it the riskless hedge portfolio or be it risk neutral method, both the method assumes that the share price, from today till the maturity will fluctuate only once. Either may go up or may go down, and only once it will happen. Are you all understanding the underlying assumption? That's why it's called binomial. Binomial, two prices. Which means the share price today, that's why I put it here. Share price today is how much? 420. This is the spot price. Can you all see this? Spot price is 420, which means the share price, underlying asset price is how much today? 420. Now, what they say, it may go up till the maturity. This is till 3 months. Assume this is for 3 months period. Which means this is spot. This is spot after 3 months. After 3 months. Now, what they say, after 3 months, the price may go up to 525, or the price may go down up to 378. Two possibilities given. Are you all understanding where it is given? Given in the question itself. Maximum price expected in 3 months time. This is, I call it as upper FSP. Upper future spot price, upper FSP, lower FSP 378. These are all the two numbers. Why? Sir, whether the share price can go up to 600, yes, possible. But this is binomial model assumption, which means they only, you only should solve taking two numbers, which means you should take a number at upper value and lower value, because only two prices possible as per this model. For simplicity, for valuing some, any theory will have some assumptions. This theory assumes that you have only two sets of prices. Are you all understanding? First step to compute the binomial hedge model. You need to do hedging now. You need to hedge the portfolio. Very simple. What is happening, I'll tell you briefly. Thereafter, I'll discuss the step. How to compute the value of the call using binomial model now. See what they say. You create a portfolio. I need to find the value of the call. VC and value of the call. VC means value of the call. What they say, you need to find out the value of the call. What you do? Bundle with share. You bundle with the share. I don't know what is the value of the call. I don't know. Correct. You take a position today. Create a portfolio wherein the portfolio will have call option as well as share. Call option as well as the underlying asset. Create a portfolio using call option, contract on asset and asset itself. So these two you combine and find out the portfolio. You have the portfolio. Create a portfolio. Then this portfolio, you will have you have created the portfolio now. This portfolio, you need to hedge. You need to create it risk-free. You need to create it risk-free. Sir, how should I create it risk-free? Now, very simple. You create a portfolio in such a way that the maturity date, the spot price will never alter the value of the portfolio, which means the portfolio, the maturity date 525 will be the share price, 375 may be the share price. So two possibility there. Under both the possibility, you make sure that this portfolio value doesn't change. This portfolio value doesn't change. So maturity date, here also the portfolio value, if the share price becomes 525, then also portfolio value will be same. When the share price is 378, then also this portfolio value will be same. Like this, you create a portfolio where future value of the portfolio becomes same. Future value of the portfolio becomes same or risk-free. If the future value of the portfolio becomes same under both the possibility, it means it is risk-free. I don't care what happens to the share price in the future. The value of the portfolio becomes stable in future. Therefore, you discount this portfolio's present value. You discount the portfolio using present value. You bring the portfolio to present value. This portfolio, is riskless. This portfolio, inside it, what you have? Inside it, you have share and call. Correct? Call option and share. Remove the price of the share, the balancing number you get as call option. This is how you do. Full detail I explained in the revision video. You can go through again and again. Don't think I'm not explaining everything here. You will never get clarity if if you have not studied deeply these areas. Correct? So I'm trying to throw some light to make you understand what is happening, what is the calculation involved. That's it. Beyond that, there is no point in going, in the neck of the moment during last week of examination, no point in discussing all this. Are you listening? Now, you should understand. So what is the procedure? Very simple. I create a portfolio using share, and a call option. And what I do, I create a portfolio in such a way, that I make the future certain, and I make the value of the portfolio in future certain, which means the future value of the portfolio will be certain irrespective of the share price prevailing on that day. If I make this, I discount and bring the present value, this portfolio will be riskless. Yes, and I discount it, bring it to present value, remove the value of the share, I'll get the balancing number as value of call. Are you all understanding? Residual value of the call, I'll find out the value of the call using residual method. This is what riskless hedge portfolio method. Now, we will move on to the specific area. See, one by one, I will explain calculation. Now you can visualize. I'll explain what happens here. Now, first, I need to create a portfolio. For creating a portfolio, first step is to calculate delta. Why this I need delta? I'll explain. Delta is nothing but, change in FSP, future spot price divided by change in value of the call. Change in FSP divided by change in value of the call. But 1 second. This is change in value of the call. It should be, well, 1 second. 525. I think there is a printing. 525 minus 378. How much is that? Yes. Sorry. This is 75 divided by 147. This is wrongly typed. Change in FSP, change in value of the call. See, delta is change in value of the call divided by change in FSP. This is wrongly given. Okay, the numerator should have been here. So here is equal to 75 minus 0. See here. Again, I will rewrite. 75 minus 0. Change in value of the call divided by change in FSP. What? 525 minus 378. Are you all understanding? Very simple. What is the change in FSP? What is upper FSP? 525. Lower FSP? 378. What is the change in FSP? What is the difference in FSP? 75. Difference in FSP is 147. What is the numerator? At 525, what will be the value of the call? Very simple. What is value of the call? Value of the call at this point, upper FSP. If the share price tomorrow becomes 525, what is the value of call? Value of call is nothing but, okay, FSP minus acca, value of the call is equal to FSP how much? 525 minus strike price is how much? Tell me children, strike price is 450 for this question. 75 is the value of the call. Are you understanding? When the share price is 375, you will exercise 378, you will exercise a lapse. I will lapse. Are you all understanding? I will lapse. I will never exercise. So value of the call is 0. Are you all listening? So value of the call at the upper FSP is 75. Value of the call at the lower FSP is 0. Okay, 75 minus 0, 75. This is the numerator for the delta. So delta is, okay, the hedge ratio. We studied in the futures, one commodity futures, like the similar. Okay, here, what is the change in value of the call divided by change in FSP is how much? 75 divided by 147 comes to 0.51. Now, what is this delta means? What I say, I told you I will create a portfolio using, okay, this is what this riskless portfolio. This portfolio I'm trying to create now, it will have, okay, what I will do, what is the strategy? I will write a call option, and I will buy delta share. I will not buy one full share. Okay, to hedge this position, I will buy delta shares. Are you all understanding what I'm trying to say? Which means the delta is 0.51, which means assume it is 0.5, which means half the. So suppose, okay, value of the call, what is the total share price? For 420 is the share price. 420 is the share price. I will not buy the entire 420 worth the share. What I will do, I will buy 0.5 of the share. I will buy delta shares. Are you all understanding? Which means, sir, fraction share possible to buy or not? Don't worry. This debate is there. This is, see, in the US and all, you can buy fraction of shares. Here, you cannot buy fraction of shares. But still, in the mutual fund, you can buy the index units. Are you all understanding? Still possible. Now, buy fraction, what is the delta share? How much share I need to buy? I will write one call option. I will write, what is the strategy? I will write one call option plus I will buy delta share, which means 0.51 shares. Are you all understanding? For every one call option I have written, I will buy 0.51 shares. Are you all understanding? If I do this, if my portfolio consists of one call option, I have written one call option, writing of one call option plus delta shares. If this is the case, what happens? I will be, okay, hedged irrespective of the share price tomorrow. Can we check it? Can we verify? Yeah, very simple. What happens? You see, okay, see. So if the value of the portfolio, if price becomes, see, I'm just two option there. Price becomes 520. What will be the value of portfolio? Value of portfolio. How much will be there? If the price becomes 378, lower FSP, what will be the value of the portfolio? VP na value of the portfolio. Very simple. At 525, you tell me, children. The share price is 525. So value of the share will be how much? 0.51, because you don't have full share. 0.51 into 525. How much is that? 0.51 into 525. How much is that? 267.75. And you have written a call option. You have written a call option. Write a call option. Now, a share worth 525 exercisable at 450 strike price. Will the holder exercise? We have written. Holder will exercise or not exercise? Yes, he will exercise. If he exercises, what will be my value of the portfolio? What will be my value of the portfolio? Simple. What will be my writing of the call? Now you will have loss of minus 75. Okay, you will lose. Are you all understanding? Because a share worth 525, you will be forced to sell at 450. 75 rupees you lose from it. So how much is that? 267. 0.75 minus 75, 192.78, 192.75, 192.75. Okay, this rounding off, no issue. 192.75. Now, in case the share price become 378, what happens? Very simple. 0.51 into 378. How much is this number? 378 into 0.51. 192.78. Okay, here also it should be 78. Next, tell me children. Okay, here 0.51 into 378 you got. Next, you have written a call, a share worth 378, exercisable at 450, call option. Will the holder exercise a lapse or lapse? If holder lapse, okay, writer, okay, will benefit from this? No, the value of the call will be 0. Are you all understanding? For the writer, value of the premium received, that is not value of the call. Okay. Now, how much is the total amount? Tell me children, what is the total amount? 192.78, which means my portfolio value will be same under both the option. Hence, this is called as risk plus hedge portfolio method. Are you all understanding? So, irrespective of the share price tomorrow, the value of the portfolio remains same. This is what they have done. Presentation using our method. So, Institute has presented this way. Presentation, now I will explain step by step using our method. Use our method only, you can easily understand. Okay, portfolio value when price goes up to 525, holder will exercise, and since we have written a call, we will lose 75 rupees, hence it is minus 75. Since we hold delta shares, value of that will be 0.51 into 525, it is 267.78. Therefore, total portfolio value, okay, 267.78 minus 75, 192.78. Next, value portfolio value when prices goes down, which is 378. Holder will never exercise, hence value becomes 0, and delta shares 192.78. So ultimately, under both the option, my value of the call will be 192.78. Are you all understanding? This is what I call it as total portfolio value, riskless portfolio, 192.78. But this value is tomorrow or today or tomorrow, which means on the date of maturity, this is the value. Now, what I should do to bring it to today, you need value of the call option today or on the date of maturity today. So what I do, I discount the entire portfolio and bring it to present value terms. Since it is risk-free portfolio, why? It will never change irrespective of FSP. It is risk-free. Yeah? Now I will use risk-free rate and discount the portfolio, bring it to present value terms. What I do, so present value of this 192.78, I will discount using risk-free rate. That is what given e to the power TR is given as 1.0202. Okay, this if you want to compound, you should multiply. If you want to discount, 1 divided by 1.0202, which means 192.78. This is the future portfolio value. Discount it 1.0202, bring it to present value terms. How much it is? Very simple. How much is the present value? 192.78 divided by 1.0202. 188.96. 188.96. What is this 188.96? This is nothing but present value of this portfolio. Now, this portfolio has call option, delta share. So, delta share value, if I remove, I'll get the call option value. Out of the 188.96, what is the delta share value? Delta share value, this is spot or future or spot price. So, spot into delta, are you all understanding? 0.51. So, spot price is 420 into 0.51. How much is the value? 420 into 0.51. I get 214. 214.2. If I remove 188.96 minus 214.2, forget about the sign, 25.24. I get the value of the call as balancing number 25.24. This is what Institute has also done. Value of the call is 25.24. Are you all understanding? Here also, Institute also solved the same thing. Okay, different approach, same up, which means you can't understand this clearly. That's why I've solved. Okay, let P be the option price. Then 214 minus P is equal to, okay, discounted this. They equated. This is nothing but same only. But I have explained in a better manner. Are you all understanding? You can go through. Hence, the value of the call, the balancing number is 25.24. Are you all understanding? Now, step by step, I'll make you understand what we did. One last time we will revise. Very simple. First step, find out the delta. Find out the delta. How much of my share, how much exposure in share I need to take perfect hedge of the call option. What is the strategy? Write a call option, buy delta shares. This is what I will do today. And I create a portfolio. This portfolio value will be same irrespective of the future spot price. It will never change because of the share price. Share price may jump to 525. Share price may go to 378. Whatever happens to the share price, this portfolio value will be same. That is why I computed delta, correct? In such a proportion that it remains same. Now, what do you do? This portfolio value will be same. This portfolio is said to be risk-free portfolio. Now, can I use risk-free rate to discount? Yes, I will use risk-free rate and discount and bring it to present value terms, which means I bring it to present value terms. Now, the value is 188.96. This portfolio present value, out of it, I knock off, I remove the delta share inside the portfolio. What is inside the portfolio? In this portfolio, I have written a call option value is there. Then there is delta share. That delta share I will remove. Now balancing number, I get it as value of the call. This is how riskless portfolio hedge method, okay, calculates the value of the call. Are you listening? So this is how you will compute. Next, value of the call option using risk neutral method. Value of the call option using risk neutral method. Very simple. Okay. See, you have a formula for risk neutral method. Okay. See, the formula is as follows. This formula also you can apply, or you can do it directly. In the next question, I have given the formula itself. See, can you see this? Okay, I'll explain the formula, no issue, very simple. E to the power RT, when the continuous compounding rate of return is given. E to the power TRF, E to the power TRF. RF means risk-free rate of return, time to maturity. So this is nothing but, okay, risk-free rate of return into time to maturity. E to the power T into risk-free rate of return, TRF, minus D divided by U minus D. This is the formula. Tell me children, E TRF minus D divided by U minus D. What is the understanding? Very simple. T here, what, okay, E to the power TRF you already know, this is a compounded value of 1 rupee, no issue. What do you mean by D now? This is downward FSP divided by spot price. Okay, now is equal to how much is the downward FSP? For example, in this question, we have downward FSP of 378, correct? In the previous question, I'm saying, not this question. I have just taken for this for formula. Okay, 378 divided by, what is that? Spot price 420, share price today 420. 378 divided by 420. How much is that? 0.9. 0.9 is the lower FSP. This is lower, okay, value. This is D. D is nothing but downward FSP divided by spot price. Now, what do you mean by U? Upward FSP, okay, divided by spot price, divided by share price or spot price. How much is that? 525 divided by 420. 525 divided by 1.25. This is 1.25. Are you all understanding? So you have 1.25, 1.9. Now I will show you how to apply the formula. See what they say. Okay. E to the power TR minus D divided by U minus D will give you the probability. This probability is nothing but the P. This is P value. Okay, the probability of price going upwards. Probability of upper FSP. Probability of upper FSP. How much is that? Please tell me. What is the probability of upper FSP? Okay. Now, we have found out now E to the power TRF given in the question itself. 1.0202. 1.0202 minus D downward FSP 0.9 divided by U upward FSP 1.25 minus 0.9. Are you all understanding? Substituted 0.0202. Okay. Divided by, how much is that? 0.1202 divided by 0.35. 0.1202 divided by 0.34. 0.34 or 34%. Are you all understanding? So probability of price increase is 34%. Probability of price increase will get P as. This formula is for finding the upper FSP probability, finding the probability for the upper FSP to prevail. Probability of the lower FSP to prevail is 0.66. Lower FSP is 0.66. Balance, because 100 minus 0.34 will give you probability. Now, what you do, you just simple calculation. What you should do, upper FSP, this is the probability. So, what is the value of the call at the upper FSP? Very simple. Here, let me show the, yes, this again. If 525 is the price, what is the value of the call? Value of the call at upper FSP. At upper FSP. UFSP and upper FSP is how much? 75. Value of the call at lower FSP, how much? Lower FSP is how much? 0. Which means if upper FSP prevails, 75 will be the value of the call. What is the probability? 75 into what is the upper FSP probability? Just now we found out, 0.34%, 0.34. Okay, plus lower FSP, what is the lower FSP? What is the value of the call at lower FSP? 0, because this node value of the call will be 0. Okay, the value of the call will be 0 and okay into probability, whatever is the probability, 0 into any number, 66, yes, 66% will be 0. So 75 into 34%, 75 into 34%, 25.5. Are you all understanding? This is 25.5. Now this 25.5 you are getting, this is value of the call, weighted average value of the call on the date of maturity, 25.5 on the date of maturity. This, if you discount and bring it to present value terms using risk-free rate of return, you will get value of the call today, 25.5. Where is this 25.5? Yes, 25.5. 25.5 discount and bring it to present value terms. Discounting, what is the e to the power TR value given? Yes, 1.0202. Discounting 1 divided by 1.02, 25.5 divided by 1.0202. That 24.99. 24.99. Okay, I'm getting 25.24. Here it is given 0.34 into 75. How much is that? 25.5. Yes, 25.5. 25.5. If I discount, okay, 1.0202. How much I'm getting? 24.99. Okay. Anyway, I'm getting 25.24. I'm getting 25.24. Okay. Are you all getting the same value? Okay. Here what they have done. See, 25.24 and we are getting 25.5, rounding of issue, no problem. See, the probability which we computed, we took as 0.34. This actually is 0.3468 or some number. Okay, to be precise, let us recompute this. Just rounding of issue, I'll just show you. Okay, here 1.0202 minus 0.9. How much is that? 0.1202 divided by 0.35. 0.1202 divided by 0.35. How much is that? 0.3434. This is 0.3434. Let's take it fully. 34.34. Okay, 0.3434, right, into 75. Now if you do this, 75 into 0.3434, how much is that? 25.75. 25.75. Instead of 25.5, we are getting accurately 25.75, rounding of issue, divided by 1.0202. Right, this divided by 1.02, getting 25.25. Are you all understanding the rounding of issue? Not a great thing. It is just rounding of 25.24. This, if you notice, this 25.24 under risk neutral method and this method both will give you one and same. Are you all understanding? So risk neutral method, what is the formula for risk neutral method? Very simple. You have to, okay, there are two steps. First step, finding the risk neutral probability. Finding the risk neutral probability. Here, upper FSP probability for the upper FSP to prevail, P is equal to, what is the formula? E to the power TR minus D divided by U minus D. D is downward FSP divided by spot price, wherein D is equal to downward FSP, downward price divided by, what is that? Spot price. Downward price divided by spot price. Whereas U is upward price, upward FSP divided by spot price. Okay. Now, this you substitute and got the P. This P, okay, will be ultimately the upper FSP value. Upper FSP value. Okay. Now, the probability of upper FSP to prevail. The probability of upper FSP, not lower FSP. Now, if you get the P, 1 minus P will be the downward FSP, downward probability. How much is that? See, if this probability is 34%, the downward probability of the lower FSP to prevail will be 66%. This you will apply to the respective value of the call at the lower FSP. You will get value of the call on the date of maturity. That if you again discount and bring it to present value terms, you will get the value of the call today. Are you all understanding? Okay, this is how we did the question. Now, basis of valuation, theory portion. Okay, last portion, basis of valuation option. See, binomial model, both the methods will give you the same answer. But what happens is binomial model uses an approach called as riskless hedge approach. See, binomial model, they usually talk binomial model, both are actually binomial model to find the price of the option by creating a portfolio which will have the same value at expiration irrespective of any price. This is what I told you now. Portfolio value irrespective of any price, the value on the date of maturity will be same. Discount and bring it to present value terms. Remove the delta share value. Balancing number will be the value of the call option. Hedge means to create an equal and opposite position for protecting value of the portfolio. Question arises, sir, why you write a call? Okay, write a call. Why you buy delta share? Why you write a call? Now, very simple. You have written a call. Now, okay, you will sell a call. Correct? If you sell a call, you will have obligation to see. Very simple. Call option buyer will have a right to buy. Okay, call option writer will have obligation to sell. If you have obligation to sell, you have obligation to sell. Instrument which is giving obligation to sell, what you will do? You will buy opposite position, buy the share. Are you all understanding? To create equality, I buy delta share instead of one full share. Are you all understanding? These are all opposite position. Hence, I'm taking for hedging. But to make it perfect hedging, okay, portfolio to be riskless, I make the delta. I find out the first delta value, then I take the position. In risk neutral method, value of the option is based on arbitrage and is therefore independent of risk preference. One should be able to value the option assuming any set of risk preference get the same answer. Okay, this is a vague answer. Okay, detailed specific answer can be given in this case anyway, but no time for discussing all these things. Understand that in risk neutral method, okay, we assume that the probability which we compute is not actually the probability. Nowhere in the world will be computed. Most probability will be only assigned, not computed. So doubt will arise, what is this probability? Are you listening? This probability is risk neutral probability, risk neutral world based valuation. Okay, all this I don't want to confuse you at this moment. Okay, solve the question using the formula. You find out the upper FSP probability. Okay, find out the value of the call. Now, next, risk neutral probability. This you can go through. Sumana, the same apply the formula and find out. Okay, you can simply go through. I've given in the question specifically risk neutral model formula based approach. You can use this and apply the formula and find out the. Here, if you see this question only ask what they say is that, okay, take the risk free. Okay, this is not there. See, she wants to know the probability of attaining the share price to upper FSP. Oh, they simply wants the upper FSP probability for upper FSP to prevail. Upper FSP to prevail, which means she wants the probability, upper probability, okay, which means P. The P 1 minus P, downward probability is P 1 minus P, upward probability is P. This they want to find out. Simply in this question, P is equal to what? E into TRF minus D divided by U minus D. This you apply the formula and find out the upper FSP. Okay, see here, P value, just find out the probability is 0.1418, 14.18%. You are understanding? With this, we are through with the risk neutral model and riskless hedge portfolio method. One single question. I have covered both the model briefly. Okay, you should solve. I believe strongly that this attempt, okay, the valuation model can be tested. Shall we move on to Black-Scholes model now? Question number 33. The share of TIC Limited are currently priced at 415 and call option exercisable in 3 months' time has an exercise rate of 400, which the exercise price is 400. 415 is the spot price. Next. Risk-free interest rate is 5% per annum and standard deviation or volatility of the share is 22%. Based on the assumption that TIC Limited is not going to declare any dividend over the next 3 months, is the option worth buying for 25? Okay, this is the quoted price. If the quoted price is fairly valued is what they are asking. Next, calculate value of aforesaid call option based on Black-Scholes valuation model if the current price is considered to be 380. Okay, both the questions are Black-Scholes only. This also you need to compute using Black-Scholes. Here also they have asked, okay, they have altered the current price, which means same, calculate the value of the aforesaid. All the things remain same, balance, only change in a spot price changes, value the call option. That's what they are asking. Third part, what will be the work of the put option if current price is considered to be 380? Current share price is 380. what will be the value of put? Instead of call, what will be the value of the put? Are you all understanding? Last part, if TAC Limited share price at present is taken as 408 and a dividend of 10 is expected to be paid in 2 months' time, then calculate value of the call option. This is the question that is being asked. Okay, given LN value, given cumulative value, okay, Z value is total cumulative value, area value is given. Now, we will start with the Black-Scholes model. For Black-Scholes model, there are two formulas which are relevant. Very simple. I'll say already we discussed that. Okay, the value of the call on the date of maturity is what? Okay, FSP, future spot price, minus X. Agreed. FSP minus X. Now, if this is the call value on the date of maturity, if you discount and bring it to present value terms, value of the call today ideally should be FSP. The FSP, if you discount, what you will get? You will get spot price. FSP, if you discount, you will get spot price. Spot again, X, if you discount, you will get present value of X. So spot minus present value of X, you get value of the call today. This only, okay, some concept is same. What they had done, they assigned the probability, and okay, Black-Scholes model is formed. See, very simple. What they do is that based on the probability, normal distribution probability, what they do, the formula is spot into ND1 minus present value of X only. Okay, this present value of X, you need to discount the X value, X divided by e to the power TR, X divided by e to the power TR, or it is same as X into e to the power minus TR. X into e to the power minus TR is same as X divided by e to the power TR. Okay, this is present value of X into ND2. Are you all understanding? Very simple. I just did nothing. I did spot minus present value of X, correct? Here I multiply with the appropriate probability ND1, and here I multiply it with ND2. Only question remains, what is this ND1 and what is this ND2? Very simple. For that, you need to understand what is D1. D1, we have a formula, very important. Okay, D1 is equal to, what is the formula for D1? Ln of S by X, Ln of spot divided by strike price. Okay, plus you have, what is this? RF, okay, or simply half into, okay, sigma square, half into sigma square plus RF, half into sigma square plus RF into T. Are you all understanding? Okay, this is, you can also, okay, in some books, it will be RF plus half into sigma square. It may be like that. Or you can also write RF plus, or half into sigma square plus RF. Here, half into sigma square also can be rewritten as in some book 0.5 sigma square. Are you all comfortable? Okay, this 0.5 sigma square plus RF into T. This you should do. Then add with ln of S and X total divided by, okay, sigma root of T. Are you all comfortable? This is the formula. Please tell me, what is the formula again? D1 is equal to ln of S by X plus, okay, half into sigma square or sigma square by 2, simply sigma square by 2 plus RF into T, the whole divided by sigma root of T. Are you all comfortable? Next, D2. D2 is very simple. Once you compute the D1, D2 is nothing but D1, this value, minus denominator of the D2 or sigma root of T. Now tell me, what is D2? D1 minus denominator of the D1, which means sigma root of T. So D1 minus sigma root of T will give you D2. After you found out D1 and D2, you will find out the cumulative value from the normal distribution table, cumulative value of the D1, D2. Are you all comfortable? Okay, shall we start solving? For solving a Black-Scholes model, you need 5 data importantly. So for this formula, okay, and this formula and this formula, to apply all this, we need 5 data. One is the spot price, then there is exercise price, then there is volatility of the share, sigma of the share, then there is risk-free rate of return, RF, which I call it as risk-free rate of return. Then there is term of the option. All this data is available now. Okay, Black-Scholes calculator is also available. Simply put the formula and solve it very easily. Only thing, by heart the formula. Once you by heart the formula, application of the formula, okay, within 5 minutes you can do and solve the problem. So see here they have given spot price given as 415, exercise price is given as So exercise rate 400. This is not 40. This is 400. Make a correction. The exercise price is 400. Risk-free rate of interest 5% per annum. Then there is standard deviation 22%. Okay, and the term of the option is 3 months, I think. Yes, 3 months, which means in terms of year, 1 by 4 or 0.25 years. Are you all understanding? Okay. Now, based on the above, calculate the value of an option based on Black-Scholes model. D1 I will find out. Ln of S by X. 415 by 400. If you have the calculator, please take out your calculator. 415 by 400. 15 divided by 400. How much is that? 1.0375. You see the question here. There are so many ln value given. This is for answering all the three parts one by one. They are changing the spot price now, so ln value will also, log normal value will also change. That is x, s by x will change, spot divided by x, strike price. Here ln 1.0375 value they have already given. Choose it 0.03681. You take it from there and you substitute in the formula. So which means, now how will you compute d1? D1 is equal to ln by s of the number given plus RF, you have RF plus sigma square by 2 or half into sigma square into 0.255. It is not 0.255, it is 0.25 divided by 0.22 sigma root of t. If you solve it, you will get 0.50327727 as d1. d2 you don't need to apply this much, no need of this. d2 is simply d1 minus sigma root of t. Sigma root of t we got as 0.11 na. D1 we got as 0.50327727 minus just 0.11. If you reduce it, you will get 0.3932727. Are you all comfortable? So this you have found out D1 as well as D2. Now you need to find ND1 and ND2. ND1 and ND2. Very simple. Where they have given cumulative value, you will consider cumulative value. I have sold now. One tail is the payoff. Like tail area given, cumulative area given. Now, three possibilities are there. The Z table value, normal table value will be, sometimes they may give one tail area value, two tail area value, or cumulative area value. If they give one tail area value, very simple. Whatever is the value, you will do 1 minus the one tail area value. You will get the cumulative value. Are you all comfortable what I am trying to say? See, one tail area. Next. Two tail area value na, very simple. Two tail area value, some x is given. What you do? Divided by 2. It will become one tail area. Then 1 minus this one tail area, you get the cumulative area value. In this question, fortunately, they have already given the cumulative area. Simply ND1. What is the D1 you found out? D1 you found out 0.50327. So ND1 is how much? Normal distribution table. As per the normal distribution table, if you see that, you will get 0.6928, which is nothing but 69.28%. In percentage terms, it is 69. All these numbers in the normal distribution table are nothing but probability. So 69.28% is the probability I assign to this value. So what is that? Yes, ND1 I get is 0.6928 and ND2, which is n value of 0.39327 given in the question. If you notice 0.39327, 0.6529. So I have both the n value ND1 and ND2. Agreed? This what I do. Value of option is equal to spot what is this? Spot price into ND1. The spot price in first question is 415 into ND1 minus strike price divided by e to the power TR. E to the power TR. I told you discounting present value. Now you should divide it by e to the power TR. E to the power TR means here it is T means 0.25, 0.25, 3 months maturity period into R is risk-free rate of interest. Annual risk-free rate of interest is 5% per annum. So 0.05 into 0.25, you will get the e to the power discounted. Are you all understanding? Spot into e to the power TR into ND2. ND2 just now we computed 0.6529. So this is spot into ND1 minus present value of x, strike price divided by e to the power TR into ND2. If you solve it, you will get 29.6. Are you all comfortable? Just simple mathematics. You solve it, you get 29.6. Since the market price, what is the market price? Quoted market price 25, and this is the fair value 29, which means it is less than 29.6 as per the Black-Scholes valuation model. It indicates that option is underpriced. It is recommended to buy the option. Next question. If the current price is taken as 380, then the calculations are as follows. Simply apply the formula. I need not even discuss. Current price taken as 3. Now spot price you will change as 380. 380 divided by 400, which means LN value will change. 380 divided by 400. 0.95, 0.95, you have a 3 ln value. Here they have given the question itself. Ln of 0.95, which is the revised spot price divided by strike price, will give you minus 0.05129. Okay, if you apply this one, okay, you apply the formula here. Okay, where it is, yes, if it is 380, then ln of SYX plus RF, here RF will remain same, plus half into sigma square, that will be same, into 0.25, all same, into 0.22. What is the 0.2? Yes, the option maturity period is 0.25 na. Yes, this is okay, divided by, this is sigma root of t, divided by sigma root of t. Yes, this is 0.25 divided by sigma root of t. If you do this, you will get, okay, value as minus 0.297636. Are you all comfortable? If you solve it, you will get D1 as minus 0.297636. D2 as how much? D2 as minus 0.407636. Like this, you will get value. Now, you need to find n D1. D1 value minus point, how much is that given in the question? Minus 0.2976. Now, minus 0.2976. Log normal value, cumulative value, minus 2976. 0.3830. So, okay, spot price into ND1 minus E divided by present value of E, X, which means X divided by this E is X, nothing but exercise price. In some books they have given E, some books they will give X. It is nothing but exercise price. Exercise price divided by E to the power RT into ND2. If you solve it, again you will get a value as how much? Value of the option, you will get 10.52. Are you all understanding? Same formula if you apply, you will solve. Okay, I did not discuss the second part. Third part, the value of the option you got is this 10.52 from the second part, because in the third part what they are asking, calculate value of the aforesaid call option based on Black-Scholes valuation model if the current price is 380. This is what they asked in the second part. Third part, what would be the worth of the put option if the current price is considered to be 380, which means at 380 rupees, you have found out the value of the call to be how much? 10.52 or something, 10.52 at strike price of 380, and all the other details remaining same. My value of the call will be 10.52 in this case, second case. What they say, okay, what is the value of the put option? This is the value of the call option. Now, what is the value of the put option? Very simple. Apply that. You need not solve all this. Again, there is a formula for it. No, don't worry. Okay, put call parity theorem you can simply apply and find out the value of the put. Put call parity you can apply and find out the value of the put. Very simple. Okay, see what happens. Put call parity equation is there na. I'll tell you what is the put call parity equation. You need not solve all this. If you adjust in the put call parity, you will find the value. This 18.98. One second. Here, sorry. Here they have given. This is put call parity equation. This is the put call parity equation. What is this? See, I'll tell you. This is the this formula is derived from the equation. What is the equation? Very simple. Value of the call plus present value of X is equal to value of share plus value of put. This is what I call it as, famously called as put call parity equation. Now, you have in the question value of call you just now found out, which is 10.52. Agreed. Present value of X you need to find out. What is the present value of X? 400 is the strike price divided by, okay, the E to the power TR means the E value I will use for dividing it. Are you all understanding? Which means 1.012578. Here I have given na. See here E to the power TR, E power 0.0125. I only use this for discount now. 1.012578. How much is that for 3 months period? How much is the yes, present value of X. This is present value of X. Value of call 10.52. Present value of X is how much? They have discounted it and found out 395.03. This is left hand side. Tell me, children, what is this 10.52 plus 10.52 plus 395.03? Get it as 405.55. This equals to value of the share. What is value of the share at present? What is the value of the share? 380. 380 plus value of the put. Value of put I don't know, which means, so therefore value of the put is equal to 405.55, okay, minus 380. How much is that? For minus 380, I'll get 25.55. This was the solution. They have given 25.55. If you solve the put call parity, you will get the value of the put option. Okay, next, last important adjustment. Last part of the question, they are asking, If TAC Limited share price at present is taken as 408, fine, and dividend of 10 is expected to be paid in 2 months' time. 2 months' time. I've told you where dividend adjustment is comes now. Okay, you have spot price now. The spot price, wherever you come across the dividend adjustment, what do? The spot price should be reduced by present value of dividend. The spot price should be reduced by present value of dividend. Then you should compound. Very simple. This will become the revised spot price. The spot price you would make the dividend adjustment. So dividend, see, option maturity period 3 months. This is the time frame. This is month 0. Now you are starting at present, and this is the 3 months period. Correct? What they say, this is 1 month, 2 months, and 3 months. The second year, okay, the second month end, what they say, they will give you dividend after a period of 2 months. How much is that? 10 rupees. Agreed? And the option maturity period is 3 years. What do? You have a spot price of how much? 408. This 408 is come dividend price. You should make it ex dividend, which means you should remove the dividend, present value of dividend. So 10 rupees, okay, dividend is there. Find the present value of 10 rupees using 2 months period. Discount it for 2 months. Bring it to present value term, remove from 408, present value of dividend, you remove it. Thereafter, whatever is the value you are getting, you should compound it for 3 months. Are you all comfortable? See here what they have done in the fourth part. Okay, first, since dividend is expected to be paid in 2 months' time, we have to adjust the share price and then Black-Scholes model to value of the option. Present value of dividend. How to use present value of dividend? Okay, continuous compounding. Dividend divided by e to the power TR. Okay, here e to the power TR. Now, what you should do? E to the power. Okay, rate of interest is what? 5% per annum, 0.05, but into T, time frame is 2 months, up to 2 by 12, which is 1 by 6. How much is 1 by 6 into 0.05? Okay, 1 divided by 6.05. I get 0.00833. E to the power 0.00833. Whether they have given the value of this, we will see the question itself. Yes, they have given. Can you see this? E to the power 0.00833 is 1.0084. Upper dividend divided by 1.0084. Simply do that. You will get present value of dividend. How much is the present value of dividend? Please tell me, children. 10 divided by e to the power tr. Okay, 10 divided by 1 point. What is the number? 00. 1 second. What is the number we saw just now? 1.0084. 1.0084. 10 divided by 1.08. That 9.917 rounded off 9.91669, like this it is coming. It is routed off to 9.917. Are you all comfortable? Okay, this is what is the price. Now adjusted price from 408, you remove the dividend, present value of dividend, you will get 398.083. 398.03. Now if you find out LNS, this also given value given in the question. See the beauty, 398.083 divided by 400. How much you are getting? 0.9952. You are getting log normal value of 0.9952. They have given, yes, they have given log normal value of 0.9952. Are you all now understanding why they have given so many values? Okay, this is why they have given. You can find out. Okay, so tell me, children, when there is dividend, what you should do? Okay, spot price, you should revise the spot price. Okay, the spot price you should adjust it. Adjust now, remove the present value of dividend. Remove the present value of dividend and find out the revised spot price. Then apply the Black-Scholes model and find out the value. Value will get as 18.98. Are you all comfortable? Apply the formula, you'll get the value as 18.98. Next, question number 34. 2-period binomial model. Last model. I think out of these 4 models, anything can be tested this attempt. Hence, I'm covering all the models for this attempt particularly. Okay, 2-period binomial model on American option. Now, take this question. Okay, this is a binomial tree question. 2-period binomial tree question. Consider 2-year American call option with strike price of rupees 50 on a stock, okay, of which the current price is 50. Which means the strike price is 50, this stock's exercise price is 50. Okay, the spot prices of the share is also 50. Assume that there are 2 time periods for 1 year. Okay, and in each year, okay, 2 time periods for 1 year, 1 year and then 1 more year. So 2 years total maturity period. Out of it, 1 year period, then we have got 1 year, 1 more year period. In each year, the stock price can move up or down by equal percentage of 20%. The risk-free interest rate is 6%. Using binomial option model, calculate the probability of price moving up and moving down. Also draw a 2-step binomial tree showing prices and payoffs at each node. See, First step, what they're asking, just to calculate the probability of price moving up and down. Okay, really speaking, the P and 1 minus P, using risk neutral model, we compute now P and 1 minus P. Okay, the P is nothing but upward FSP, the probability of upward FSP movement, and the probability of downward FSP movement. Agreed? So this first step we will need to compute using what? Risk neutral formula. This is what the formula is. Very simple. See, earlier I told you, what is the formula? E to the power TRF, which is TR minus D divided by U minus D. P is equal to E to the power TR minus D divided by U minus D. D is nothing but downward FSP. Okay, downward FSP divided by spot price. Like this, I have mentioned and solved the risk neutral question. Are you listening? Now, what the issue is, Institute does not give you any E power value, or continuous compounding does not give any adjustment related to continuous compounding, which means they did not mention anything about continuous compounding. What you should do, you should do normal compounding. This R is nothing but 1 plus R raised to the power n. 1 plus R raised to the power n. This is what I call it as R. Okay, so the formula changes. This is nothing but E to the power TR, continuous compounding. If continuous compounding is asked, E to the power TR you should use. If normal compounding, or they have not given any data related to continuous compounding, what you should do? Normal compounding, 1 plus R raised to the power n minus D divided by U minus D. All the other three components will be same. Only instead of E to the power TR, you will change it to 1 plus R raised to the power n. R, your simple compounding you will use, and you will find out. Now, substitute the formula. 1 plus R raised to the rate of interest is how much? 6%. 1.06 raised to the power 1 year. So, this is 1.06 minus D. D is how much? First, up, down, lower, upward FSP is how much? Lower FSP is how much? Very simple. Spot price today is 50. Agreed? This can move up and down by equal 20%, which means 50 can either be 60 rupees into 120% or 60 rupees. 50 if moves by 20% up, 60 rupees. 50 if moves by 20% down, okay, 80% into 50, how much it will be? 40. Are you all understanding? So which means downward FSP is how much? 40 divided by what? Okay, 50. 40 divided by 50. This is the spot price. So downward FSP divided by spot price is how much? 0.8. Now upper FSP 60 divided by 50 is what? 1.2. 60 divided by, how much is that? 1.2. Are you all understanding? So D value is 0.8. Okay, the U value is 1.2. Apply the formula. Okay, the R, 1 plus R raised to the power n is 1.06 minus D 0.8. Okay, divided by U minus D. If you solve it, you will get 0.65. What is the meaning of 0.65? Probability of upper FSP. Probability of upper FSP is how much? 65% or 0.65 or 0.65 is the probability. If probability of upper FSP is 0.65, what is the probability of down FSP? 0.35, 0.35. Are you all comfortable? 1 minus P will be the probability of down FSP. So that is why we're given 1 minus P. 0.35 is the value of the down FSP. So upper FSP value is 0.65, down FSP value is 0.35. Next, the two-step binomial tree showing price and payoff. This you need to understand. First, we need to draw the binomial tree. They have given in the question anyway. I'll just show you here. This is the stock prices using the two-step binomial tree. First, draw the binomial tree to understand what is happening. See, my dear friends, here you start with the spot price of 50. 20% the price may move up. 20% the price may move up. This is move down. This is year 1. There are 2 1-year period. I say this is year 1. Then there is year 2. 2-year period. Okay, 2 1-year period. This is first period. This is second period. Agreed? So 50 rupees can go up by 20%. It may become 60 or it may come down to 40. Are you all understanding? First year end, there will be 2 prices. What they say? Year 2, again the tree's branch will, okay, it will expand. If it expands, now what happens? The 60 rupees again, there is 2 possibility. Okay, for 60 rupees first year became for 60 now. The 60 can go even further up by 20%. Can come down by 20%. If 60 goes up by 20%, it will become 72 rupees. If 60 goes down by 20%, how much it will be? 60 into 0.8, 60 0.8, how much it is? 48 rupees. Are you all comfortable? So this is the variation in the second year. So the upper FSP price also in the second year can go either up, either down. So which means here from 50 up, down. 2 possibilities are there. Next, Next, 40 rupees. First year, assume the price went to 40 rupees. Now again, two possibility. From 40, it can go up to 20% upwards, 48. Below 20%, how much is that? 40 into 80%, 32 rupees. Are you all comfortable? This is what given in the map. 50 rupees, 60 and 40. Then 60 can go up to 72. Here also 20% upwards. Okay, here also 20% upwards. Now, one upward, then downwards, 20%. How much is that? 48. Again, if you go below, now next year, if happens to be 40, it can go up by 20% to make it 48, then can go down by 20% to make it 32. Are you all comfortable? So 72, 48, 32, three different prices are there. Now the important observation, what they say, you will, the one important fact is that the probability you computed 65% and 35%, that will not change for upper FSP and lower FSP, which means very simple. What I do now, I will try to find the value of the call from the year end, which means I will first value the call. I need value of the call today. I need value of the call at this point. I see I'm rubbing this to show you in a better way. Okay, see what happens, I'll tell you. Okay, I think here they have shown their own. Yes, here they have shown. Now clearly understand. Here they have given themselves. No worry. Now this is year 2. This is value of the call at the end of year 2. This is year 1. Correct? This happens year 1. That happens on year 2. Now what you do? Find out the value of the call from the second. You need value of the call today. This is present value of the call. You need to find out this node at this A point. You need find value of the call. But to find it, first you need to start from the year end, which means from the second year end. Okay, this is the point. Assume the D is the point. First you need to value, okay, find out the value of the call here, and then discount and bring it to B, point B. Are you all understanding? Very simple. Assume the 1 year elapsed. Second year, the price may go up by 72, price may go down by 42. Are you all understanding? This is upper and lower FSB. Yeah. Now, the probability will remain same, 65% and 35%, or 0.65 and 0.35. Now, what do you do? Very simple. If the share price becomes 42 at this 72, if the share price becomes 72, what is the value of the call? Value of the call is how much? Value of the call is FSP minus strike price. FSP is how much? 72. That is what share price became after 2 years. 72 minus strike price. What is the strike price? Okay, what is the strike price? 50. So 72 minus 50, 22 is the value of the call. Are you understanding? If my share price appreciates to 72, what will be the value of the call? 22 will be the value of the call. Agreed? This is the upper FSP value of the call. Now, come to 48. If the share price becomes 48, a share worth 48, the call option holder will exercise a lapse. He will lapse. When he lapses, FSP minus strike price, okay, never exercises, so, okay, will be 0. The FSP minus exercise price, anyway, the call option is lapsed. So, you need not compute FSP minus X. What is that? 0. Value of the call will be 0. To put it simply, if the price goes up at 72 and at 48, okay, you will get the value as 22 and 48. And if it goes even below to 32, this node also value is 0. Are you all having the clarity? Now, this you are having at the end of year 2. This is value of the call option at the end of the year 2 or on the date of maturity. But I need value of the call today. I need value of the call today. So first what I do, I have value of the call year end at the upper FSP and lower FSP. I will discount and bring it to present value terms. I will first discount and bring it to this B position. This B position. Are you B node? Are you all understanding? Here also I have upper FSP is 48 and 38. Now I will discount and bring it to C value. I will show you. Very simple. What happens? Here I have 22 value upper value of the call option 22. If the price today, assume the price is 60. Today the price is 60, which means I am standing at the end of year 1. The share price appreciated to 60 from 50. This happened. Okay. Now after I am at the end of year 1. Now the price may become 72 or 48. If price becomes 72, value of the call is 22. What is the probability for upper FSP to prevail? Into 65%. Are you all understanding? So value of upper FSP into value of the call plus value at the lower FSP, value of call at lower FSP, lower FSP into probability of the lower FSP. Are you all understanding? So you'll get the weighted average price. Are you all listening? So 22 into 65%, to put it simply, 22 is the value of the call in the upper FSP into 65. What is the probability? 14.3. So this is 14.3 and this is 0 plus 0 will give you 14.3. Are you are listening? So this is the 14.3 is the value of the call option at the end of year 2. If I discount for 1 year, I will get the 13.49. I will get the value at B point, the point B. Are you understanding how we discount? 1 year discounting rate 0.6 na. So what you do? 14.3 divided by 1.06. How much is that? 13.49. 13.49. I discounted this 14.3 and bring it to present value terms by 6%. 1 year I used the 6% only. Okay, so I brought the value of the call from year 2 end to year 1 end. Are you all understanding? Now at this upper node, now we need to value at the lower node, value of the call option at the lower node. Very simple. This is nothing to be valued, because if at 48 also value of the call is 0, at 32 is also value of the call 0, irrespective of the probability apply. Here the probability is 65% to go up and down by 35%. Okay, which means 35% into 0 plus 60% into 0. Anyway, weighted average will be 0. 0 if you discount, the value will be again 0. No use. Are you all understanding this? So I have got B and C. I have got at B, I have got 13.49 as value of the call. At C point, I got the value of the call as 0. Are you all listening? Now, this is not value of the call today. This is value at the end of year 1. Again, I need to discount for 1 more year and bring it to present value terms. So expected value means 13.49 I have at the upper FSP na, into probability for the upper FSP. Again apply the probability, because you need to bring it here, into 65% plus 0 into 35%. How much is the weighted average price? 13.49 into 65%. How much is that? 8.76. 8.76 plus 0 is simply 8.76. This is the weighted average value at the end of year 1. Value of the call 8.76. Agreed? This 8.76 is the weighted average value. Again, I will discount and bring it to present value terms. How to discount? Divided by 1.76, 1.06. 8.76 divided by 1.06. Okay, which is the rate, risk-free rate of return for 1 year. You will discount. How much you are getting? 8.76 divided by 8.27. This is what they have given. This is the value of the call. 8.27 is the solution. They have solved. Okay, see here they have given 8.272. Can you see this? 13.49 into 0.65 plus 0 into 0.35, 0 divided by 1.06. Again at the end of the year 1, you have found out the value now. Bring it to present value terms. Discount and bring it to present value terms. 8.272. With this, we are through with the chapter. That is, okay, options and derivatives fully. We are through with the chapter called as derivative. Now shall we move on to advanced capital budgeting?